An important concept of banker-customer relationship that you can see here, it's a relationship between the two. So the foundation of banker-customer relationship is actually a contractual relationship. The banker and customer have their relationship, that's a contractual relationship. Contractual relationship means it's a legal binding between the two parties. It's a contract between the two parties. So once their whatever job, whatever service the customer is trying to get from the bank, once the service have been completed, this contractual relationship automatically removes, right? So you can see contractual relationship is what? Binding agreement and mutual obligation from the parties, that is banker and the customer. So one party is banker, that is the provider of financial services, okay, and the second party we have a customer, that is the recipient of banking services. So this is what the contractual relationship is actually means. Hana, this is what the contractual relationship actually means, the foundation of banker-customer relationship we have. Okay, next. So when we talk about the relationship between a banker and customer, they are based on trust. This is very obvious. If the customer do not have trust on a bank, they won't be handing over their cash, their deposits, their jewelry, their valuable documents, because when the customer creates a contractual relationship with the bank, they maintain their money in the bank, they deposit their money with the bank, they put their valuables, can be jewelry, can be important document, valuable documents in the locker, in the safe custody. So if I do not trust on my bank, I don't have trust on my bank, I won't be giving my valuable things to the bank in any situation. So the relationship will be always built based on the trust. And you can see the relationship is divided into two important parts of to understand clearly. The first is the general relationship between the banker and the customer, and the second one is a special relationship between the banker and the customer. The general relationship is related to day-to-day banking activities. Whatever day-to-day banking operations bank is performing for the customers, that's what we can call it a general relationship between a banker and a customer. But when it comes to the special relationship, it defines the duties of a bank, the multiple types of duties of a bank towards the customer, as well as it defines the relationship related to write-off, set-off, related to your mandate, related to your garnishee order, attachment order, related to write-off, appropriation, etc. They all are the special relationship between a banker and the customer. So today in this particular unit, we will be talking about the general relationship. Unit number 1 of your syllabus talks about general relationship, and unit number 7 of module A only talks about the special relationship. Okay, unit 7 talks about a special relationship, unit 1 talks about general relationship. So the special relationship we will be covering in your unit 7. Now let's start with the very first and very primary relationship between a banker and a customer, that is a debtor and creditor. In this relationship is what? Debtor and creditor. The debtor is your bank and the creditor is your customer. Okay, the creditor is who? The creditor is your customer. Whenever the customer opens a bank account in a bank and provides deposit to the bank, that relationship is called as a banker-customer relationship. That is a debtor and a creditor relationship. Why customer is a creditor? Because here customer is giving their money to the bank to deposit in an account. That's why customer is a creditor and the bank is a debtor, because bank is accepting money and customer is giving money. That's why customer is your creditor and bank is your debtor. Clear? Next. So on the opening of an account, the banker assumes the position of a debtor. And that's a primary relationship. The primary contractual relationship between a bank and customer is always a debtor and creditor relationship when the customer opens a bank account in a bank. So a depositor remains a creditor of his banker so long as his account carries a credit balance. Okay, so the depositor is what? It remains a creditor of his banker because he has the balance in their account. Okay. Now the relationship with the customer is reserved as soon as the customer account is overdrawn. Overdrawn means the customer have taken a money, the customer have taken a loan, or customer have taken an overdraft from a bank. In that case, this relationship automatically reverts. In that case, the customer will become the debtor and the bank will become the creditor, because in that situation, bank will be giving deposit to the customer. Okay, so that's a relationship as a debtor and creditor. And you can see here, banker customer financial relationship we have, they have a effective financial interactions. That is important for both the parties. The account balances which determines the role shift. If account is maintained, the balance is maintained by the customer, then the customer is creditor and bank is a debtor. Then we have a debtor role, bank's obligation to repay. Debtor, who is a debtor? Bank is a debtor, because bank have to pay the deposit to the customer. Now creditor role is also there, customer claims to funds, because customer have given that money to the bank, so customer can claim that money. Okay. Next we have creditor-debtor relationship. The second relationship we have creditor and debtor, in which bank becomes the creditor and the customer becomes the debtor. Who is the debtor? Customer is a debtor and bank is a creditor. Now what does it mean? It simply means that the bank have given loan to the customer. That's why bank is a creditor here. So you can see, when the bank lends money to the customer, bank is lending money to the customer. The customer is the borrower and the bank is the lender. Okay, do remember that whenever the bank lends money to the customer is the borrower and the bank is the lender. And the relationship between the banker and the customer is what? That of a creditor and a debtor relationship. Okay, the relationship between the two is what? Creditor and debtor relationship. So bank become the creditor, customer is a debtor. Why? Because bank is giving loan to the customer. So that's why bank is a creditor. Clear? So you can see here, we have a bank, we have a customer. Here bank performs the creditor role and the customer performs the debtor role, because bank is giving loan to the customer. Because bank is giving loan to whom? Bank is giving loan to the customer. That's why bank is a creditor and customer is a debtor. Now, third, belly and beller relationship. The third relationship between a bank and a customer is a belly and beller relationship. So here, bank becomes the belly and customer becomes the beller. Okay, customer is a beller and bank is a belly. So you can see, Section 148 of Indian Contract Act 1872, a bailment is what? It is a contract where one person delivers goods to another person. Okay, one person is doing what? One person is delivering goods to another person for what? For some purposes. And that one person who is delivering goods to another is what? It's a customer. So customer gives their goods to the bank. Okay, and for what? For some purposes, for some specific purposes. So the person delivering the goods is the beller, the customer is a beller, and the person receiving the goods is a belly, that's a bank. Okay, bank is receiving goods, so bank is a belly and the customer is a beller. And why customer is giving the goods to the belly, to the bank? For some purposes, defined purposes. Okay, so after the accomplishment of the purpose, the belly needs to return these goods to the beller or dispose of them according to the direction of the beller. So once that purpose have been achieved, the goods have to be returned. Okay, that's called as a belly-beller relationship. So in the belly-beller relationship, bank is a belly, customer is a beller, and the reason why the customer is giving goods to the bank will be defined, will be specified. Next, so you can see bailment and relationship in banking. So bailer is what? It's a customer. Customer's role in entrusting the goods. Customer is entrusting with the goods, giving it to the bank. Belly, that's a bank's role in safekeeping. The bank, whatever goods have been received by bank, that have to be maintained in what? In the safekeeping. Section 148 defines the bailment and the responsibilities related to bailment. Then Indian Contract Act 1872, that gives us the legal foundation for bailment. And the bailment is what? the core concept of temporary transfer of goods. Okay, so bailment is simply what? The core concept of temporarily you are transferring the goods. So who is transferring the goods? Beller is transferring the goods. To whom? To the belly. That's a bank. Okay, and what will be done? The bailment responsibility will be defined under section 148 of Indian Contract Act 1872. Okay, so this is the bailment relationship in banking. Now, next relationship we have as a trustee and beneficiary. So bank is a trustee here. So the bank performs a relationship as a trustee with the customer when the bank customer deposited his property or other assets with the bank. Okay. So in this case, the bank holds the property of the other document of the bank customer in exchange for the loan provided by the bank. In exchange for what? The loan provided by the bank. So the person who is depositing the property or other document is known as the beneficiary here. So it's not always when the bank is providing loan then this relationship will be there. Whenever a customer is giving any kind of property of its own to the bank to maintain it for the purpose of security, that gives the relationship between a trustee, between a banker and customer as a trustee and beneficiary. So what happens, the bailee and beller, trustee and beneficiary, kind of a similar kind of relationship. The only difference is the reason why the customer giving goods is defined under the bailee-beller relationship, but in trustee the specific purpose won't be defined, the specific reason won't be defined. Okay, so that's the only difference, but in both the cases customer gives some deposit to the bank and the bank will be safekeeping that deposit or that property or whatever valuable document of a customer is with itself. So you can see trustee beneficiary dynamics is what? Customer as a beneficiary will be there. So customer receives benefit from the asset management, and who is the trustee? Bank as a trustee will be there, who manages the assets and fulfills the fiduciary duties that the bank have towards the customer. So it includes your asset management, like oversees and protect the asset of a customer. Bank protects the asset of a customer, oversee over those document or the assets of a customer. Then loan agreement can be there, provides financial support with the condition. On those assets, bank also provide what? Bank also provide the loan agreement, loan provide. Trust, foundation of the relationship here. And fiduciary duties are there, that is the legal and ethical responsibilities of a bank related to the asset of a customer. So it's not like if any customer have given asset to the bank can use it for its personal benefit. No, they have to make sure that the assets will be protected for the customer and it will be used only for the benefit of the customer. Whatever the best benefit will be given to the customer by that property, that have to be maintained, right? Next relationship we have principal and agent relationship between a bank and a customer. So here the bank is an agent and customer is a principal. So whenever we give any order to bank to perform any service on behalf of us, that is called as a principal agent principal relationship. So you can see the bankers provides agent services to their customer, right? The banker does what? Banker provide agent services to their customer. The agent is defined under section 182 of Indian Contract Act as the agent is the person who is employed by a person by giving him the power of attorney to work or deal on his behalf. Okay, so if any standing instructions have been given to the bank by the customer, that's what the agent principal relationship is. So you can see the banker pay taxes, electricity bills, insurance premium, etc. at the command of the bank customer who acts as principal. Okay, who acts as what? Who acts as a principal. So the banker pay the taxes, electricity bills, insurance premium, etc. Okay, on behalf of the customer. So the bank usually charges for these services provided by the bank to its customer. So whenever any standing instruction given to the bank to perform on behalf of customer, that's a part of the agent principal relationship. Okay, so banker customer agency relationship relates what? There is a charges. First of all, agency relationship means core dynamics between banker and customer. Roles and responsibility, the obligation of both parties will be there. services provided, banking services offered to the customers, and then we have charges. The fees which is associated with the banking services will be taken by the bank. It will be taken by the bank. Now, next relationship we have as a lessor and lessee. This we will study also in case of your lease finance. In module D of IEIFS, we will be studying lease finance, and that's also similar kind of thing when we study the lessor and lessee. So lessor is means owner. Okay, it is the owner, and lessee means the tenant. Lessee means what? Tenant. So what is the thing that bank gives on a rent to the customer? That's a locker facility of a bank. So the locker is what? A certain area within the premises of a bank that bank offers to the customer, in which customer can store their money, their cash, their jewelry, their valuable documents that will be secured under the bank security. Okay. So that's what we're talking about here. The lessor-lessee relationship will be created when the customer uses the locker of a bank. So you can see section 105 of the Transfer of Property Act deals with the contract of lease. It is transfer of right to enjoy the immovable property for a certain time with consideration. Okay, so what we are talking about, section 105 talks about what? It talks about the Transfer of Property Act that deals with the contract of lease, and it is a transfer of right to enjoy the immovable property for a certain time with consideration. So you can see this happens in the relationship between banker and customer when the bank provides a safe deposit locker to the customer of the bank to save his important property for a certain period of time. And definitely the bank changes its customer who is taking the benefit of the locker for a certain period of time. Clear? So lessor-lessee relationship defines when the bank provides locker facility to the customer. And you can see, first of all, this is a kind of, in the locker facility, there is a lease agreement between a bank and a customer that will have a central contract for property use. You are using the property of a bank. The lessor is the entity who is granting property use, that in case this we have a bank, and lessee entity using the property that we have in this case is customer. So if I am living on a apartment, I am living in an apartment that I have rented out. So I am the tenant. So I will be called as a lessee. My landlord will be called as a lessor, right? Next we have consideration, payment for property use we have. Then duration will be there for a certain time period. You can have that particular locker. So this is a kind of lease agreement between the both parties. Now next relationship is as a pledger and pledgee. So the bank performs the relationship of a pledger and the pledgee when the customer took the loan from the bank. So what is pledge? Pledge is a kind of security that is movable. Okay, it's a movable security. Whenever a customer takes a loan from a bank, they give the movable security to the bank. That's a pledge. And the possession of this movable property remains with lender. Okay, it remains with whom? It remains with the lender, like the bank. And definitely, for example, you can say gold loan. In gold loan, you can totally talk about this, that bank have done what? Bank have taken the gold and provided the loan to the customer. So it's simply the banker performed the relationship of pledger and pledgee when the customer took the loan from the bank and deposits some security to the banker. And the customer becomes a pledger and the bank is a pledgee here. Okay. So the security of the customer will remain in the custody of the bank until the person repays the money to the customer, to the bank, sorry. So until and unless customer repay the loan to the bank, the possession of the property will remains with the lender, will remains with the bank. Okay. So pledger-pledgee relationship we have. It's a loan agreement, that understanding for both the parties. Protection against the loan default. Then pledgee is simply the bank holding the security, and the pledger is the customer who is providing the security to the bank for taking a loan. Okay, next relationship we have. Similarly, we have a mortgagee relationship, hypothecator relationship, but that we will in detail study in our paid classes. Not everything we will be able to discuss here because we have a limited time frame in the YouTube. Okay, so relationship as a indemnity holder and indemnifier. So indemnity is a kind of word that defines making good the loss. Indemnity means what? Something that is making good the loss. So whatever loss is happening, we are making it good for the person. That is called as the indemnity. So there are various types of indemnity given under the Indian Contract Act. Indemnity is one of the type of contract in which one person promises to save another party by paying his loss occurred due to the person who is making the contract or by the act of any other person. So like the insurance company. With the insurance company, we have our contract with indemnity only not in case of life insurance, because nothing can make the death of a person good. But yes, other financial losses, we can make the other financial losses good for the customer. That's what the insurance companies are doing, right? So similarly, indemnity holder indemnifier relationship is there, in which whenever the customer asks the bank to issue the duplicate demand draft, to issue a duplicate fixed deposit receipt, in that case, the bank asks the customer to sign the indemnity bond. In that indemnity bond, it will be clearly defined, like if in any case any loss occurred due to this duplicate demand draft or duplicate fixed deposit receipt, that loss have to be borne by the customer. And when the customer signs that bond, then only the bank will issue the duplicate document. Okay, that's when this relationship will be created. So in relationship between banker and customer, the banker acts as a indemnity holder if any wrong transaction is done while making the payment by the customer. Okay, so bank is the indemnity holder and customer is the indemnifier here. So you can see here, it is defined under Indian Contract Act, that gives us the legal framework governing the indemnity. It's a practical example of indemnity, that compensation for losses will be given, like promises to cover the financial damage, and specific action or events are what? Triggers for indemnity claims. So if any uncertain situation happens, so insurance company gives us the claim, right? Similarly here happens. If any wrong transactions happen, any wrongdoing of transaction happen, then the customer pays the loss of a bank, right? Next, we have a table in which all type of relationship of a banker and customer is defined here, that you can easily check. Okay, that you can easily check. So first we have debtor creditor relationship, and one type of relationship we have debtor creditor. Second type of we have creditor debtor. Third we have belly beller. Fourth we have lesser lessee. Fifth we have agent and principal relationship. Sixth, we have trustee and beneficiary. Seventh, we have pawner and pawnee. Eighth, we have mortgagee and mortgager. Ninth, we have hypothecatee and hypothecator. These are the 9 type of relationship which in the different transactions will be created. If a customer deposits money in a bank, then the customer is a creditor, bank is a debtor. First one. Second one, if the bank is giving loan to the customer, the bank is a creditor and customer is a debtor. Then if a customer gives certain valuable things to the banks for the safe custody, so the bank is the belly and the customer is the beller. Okay, next, locker. If customer is taking a locker facility from the bank, so bank is a lessor, that's the owner, and customer is a tenant, that's a lessee. Now collection of check. Okay, then you can see standing instructions, the sale purchase of security. I will highlight this with the purple color. Okay, so we have collection of checks. Then apart from that, we have standing instructions. Okay, then we have sale and purchase of securities on behalf of customer. Then apart from that, we have a shares given for sale. These all transactions are some kind of transaction in which customer is giving order to the bank, like perform this activity for me. And in all these conditions, in all these cases, the relationship will be agent principal relationship, because customer is a principal giving order to the bank and bank is the agent who is performing this transaction. Okay. Then in case of purchase of draft, the customer is purchasing the draft, so definitely customer is giving money to the bank. Hana, in that case also debtor creditor relationship will be there, because if I am asking bank to issue a draft, I am giving cash to the bank, and that's why, because I am giving money, I am the creditor, bank is a debtor. Okay. Next, pay of the draft, definitely, but you have went to the bank to make the payment, so bank is a trustee and you are a beneficiary who is getting the payment. In case of pledge, the bank is a pledgee and customer is a pledger, and you can see bank is called the pawner here and the customer is called a pawnee. Hana, do remember this. So this some bankers get confused between this, because this is a pledgee, so they think like pledgee is a bank, that's why they think pawnee is a bank. No, pledgee is a bank and the other name is pawner. Okay, and the customer will be pawnee or a pledger. Do remember this. They are not like ki pledgee and pawnee is the same thing. No. Next we have, in case of mortgage, the mortgagee and mortgager relationship is there. Apart from that, in case of money deposited but instruction not given for its disposal, that's a trustee relationship. Articles left in a bank by mistake, that's also a trustee relationship. In case of hypothecation, security charge, it's a hypothecatee and hypothecator. So these are the transaction in which the different banker-customer relationship is defined under the single slide of yours. Okay, so I hope the relationship between a banker and customer is clear to all of you. All the relationship, debtor creditor, creditor debtor, lessor lessee, belly beller, trustee beneficiary, agent principal. I hope indemnity holder, indemnifier. I hope all these relationship concept is clear to you. So first let me know in the comment section, is till now every relationship between the two parties clear to all of you or not? Let me know. Give me a thumbs up or do write yes so that I can continue. Or if you have any doubt, let me know in the comment section that also. Which topic do you want me to repeat? Okay, done. So now let's practice some questions on the content we have studied. So the first question is talking about, consider the following statement regarding the relationship between a bank and a customer. Okay, and which of the statement given above is correct, that you have to find out. Okay, so first is saying when an account is opened, the bank initially acts as a debtor. Second is saying a debtor is considered a creditor to the bank as long as their account has a credit balance. The relationship between the bank and the customer is reversed, if the customer's account becomes overdrawn. And options are, A is saying 1 and 2 only, B is saying 1 and 3 only, C is saying second and third only, and D is saying first, second and third all. So what do you think, which is statement related to the banker-customer relationship here is correct? A, B, C or D? Which one is correct here? Okay. So right answer is D. All the statement about the banker-customer relationship is correct here. So right answer is definitely D. First, second and third is correct. Okay. Second question we have here. Analyze the following statement concerning the nature of the banker-customer relationship, and we have to find out the incorrect statement. First is saying the banker becomes a debtor upon the opening of a current account. Second is saying a customer holding a credit balance retains the status of a creditor. Third is saying the debtor-creditor relationship between the banker and the customer remains unchanged if the customer account is overdrawn. Let me know which statement is incorrect. A, B, C or D. And definitely third one is incorrect because it's saying debtor-creditor relationship between the bank and customer remains unchanged when the customer accounts are overdrawn. If the customer's account is overdrawn, definitely what will happen? The bank will become the creditor and the customer will become the debtor, no? So that is wrong. Right answer is C. Next question we have here. Consider the following statement regarding the relationship between the banker and a customer, particularly concerning the banker's obligation, and we have to find out the correct answer. Okay, so first is saying a banker is primarily a debtor to the customer, but their primary obligation is to pay the customer's money according to their instructions. If a banker makes a payment on behalf of a customer without their specific direction, the banker is still generally protected under the law. Which of the following is correct? A, B, C or D. The statement about banker's obligation we are talking about. Hana? These statements are about the banker's obligation. So which one is correct? A, B, C or D? A, B, C or D? Which one is correct here? Okay. So first statement is definitely right that a banker is primarily a debtor. Hana, banker is primarily a debtor to the customer, but their primary obligation is to pay the customer money according to the instructions of the customer. That's correct. But the second is not. It's saying if a banker makes a payment on behalf of customer without their specific direction, the banker is generally protected. No. If customer haven't given any instruction, why you would pay the money from their account? This is wrong. This is not the obligation of a bank. So the correct one is only one. It means A option is correct. Hana, right answer will be your A option. Next we have here. Which of the following statement about indemnity and the banker-customer relationship are accurate? First is saying the core purpose of an indemnity contract is to save a party from loss. If a customer makes an error during a payment, the bank holds an indemnity. Indemnity is not recognized as a specific type of contract under the Indian Contract Act 1872. So what do you think? Which one is correct? We have to find out the accurate statement about the relationship. A, B or C? So third one is definitely wrong because it's saying it's not recognized. It is recognized. This is wrong. The first is correct that the core purpose of an indemnity contract is to save a party from the loss, and the second is also correct. If a customer makes an error during a payment, the bank holds an indemnity. So right answer is first and second only. Okay, right answer is what? It's the first and second only. Option number A. Next. Which of the following statement accurately describes aspects of indemnity as presented in the text? So the options have been given to you about the indemnity, and the question is asking which of the following statement accurately describes it. Okay, first is saying indemnity is a contract where the indemnifier promises to compensate for loss. That's true. Hana, like customer is promising the bank in case of duplicate draft and the fixed deposit receipt that I will be making your loss payment. That's first is correct. The loss covered by the indemnity contract must be solely be caused by the person making the contract. No, not required. The third party, the loss occurs because of the third party can also be covered. Hana? The banker-customer relationship can involve the banker holding the indemnity. That's true. So right answer is first and third. It means B option is correct. So AML KYC guidelines unit is very big. Out of that, what we are focusing today, we are focusing today to your money laundering and financing of terrorism risk. Okay, this is what we're talking about. So when we talk about money laundering, what actually the money laundering is? Right, what actually the money laundering is? Money laundering is simply conversion of black money into white money. Whenever a person is earning a money from a criminal activity like drug trafficking, corruption, or something else, whenever they are earning a money from the illegal activity which they cannot show in the government taxation earning sources, which they cannot openly talk about it because that's an illegal source of earning, converting that money into legal money, that's what the money laundering is. Okay, so money laundering is simply conversion of black money into white money. And financing of terrorism simply means that certain terrorist organizations and the people belongs to them, they actually using the banking channel, the financial system channel, to raise the money, to store the money, and to transfer the money. So people are using banking channel for the wrong purposes, right? Or for the criminal activities like the money laundering and financing of terrorism. RBI, not only RBI, but every central bank of a country, every country, and the Financial Action Task Force, the IMF, a lot of international organizations, they all are trying to make sure that no one will be able to use the financial system of a country, the banking system of a country, for such kind of criminal activities. And that's where the AML KYC guidelines comes. Okay, which actually help us to stop such kind of people to use the banking channels in the criminal activities, right? So let's start with the first point, that money laundering is what? It is the process whereby the origin of funds generated from the criminal activities, that can be drug trafficking, gun smuggling, corruption. Okay, so when we are talking about money laundering, it's what? It's a process which origin of funds generated from what? From the criminal activities. Hana, that can be any one of them. So it is concealed and these funds are infused in the financial system, appearing as if these originated from the legitimate source. So the people have earned the money from the illegal activity, but they are entering that black money into the legal financial system to show that they have actually earned that money from the legitimate sources, from the real earning sources. Okay, like nothing is wrong with the way they have earned the money. That's what we call as a money laundering. Okay, that's what we call as a money laundering. Now, next we have, often such funds are deployed in the legal activities or legitimate assets. We are doing what? The people who perform money laundering, or the people who have actually get earning from the criminal activities, they start deploying that money in the legal activities, or we can say the legitimate assets. Now, the corruption, tax evasion, Ponzi scheme and other financial crimes, cyber crimes are closely connected with what? With the money laundering. Okay, they all are closely connected to what? They all are closely connected to the money laundering. So you know the corruption, you know the tax evasion. What is a Ponzi scheme? The scheme that is not true. The scheme that is actually attracting people for the better returns, but that actually done fraud with the people. So you can see funds from these crimes now form a substantial portion of money laundering. Hana, like a lot of people who are performing money laundering, who are converting their black money into white money, they are earning that money from the corruption, from tax evasion, from the Ponzi schemes. Okay, the cyber crimes. So financial crimes, now they constitute a significant part of your criminal activities. Okay, they all criminal activities are involved in the financial crimes now. Also, the third component of triad today is a terrorist financing. So we have money laundering, we have financial crimes, we have terrorist financing. These three are the ways by which we can say people are using to hide their criminal activities. They are using the banking channels. Okay, so with the growth of several terrorist organizations in the world, the big or small, the terrorist facing financing has assumed a large proportion. So terrorist financing has deployed linkages with money laundering as for both purposes, that is similar modalities are used. So we are simply saying that the people are using terrorist to the people with the terrorist organization, they are using the banking channel to perform their financing purposes of terrorist activity. So the money laundering, terrorist financing and financial crimes, they all are interconnected now, because they all are using the banking channel, the financial channel to perform their activities. And you can see another aspect is that the certain criminals have organized into what? The organized crime groups. Right? They have what? They have organized crime groups. They have a professional money laundering, like Hawala. I guess everybody of you have heard about Hawala. They perform the money laundering activity in a very right manner, so that nobody can easily find out that this is the money which have been earned from the criminal activity, from an illegitimate activity. Okay. So this is what we are talking about, that the money laundering, terrorism financing and financial crimes, they all are interconnected now. Apart from this, RBI is doing focus on money laundering, terrorism financing and financial crimes activity. Apart from RBI, we have seen FATF is also there. The task that RBI is performing for Indian economy, the similar thing will be seen performed by FATF for the global economy. So FATF is what? It is the global organization set up for evolving measures to be taken by the financial sector businesses and certain non-financial businesses and the professions for prevention of money laundering. So FATF issued certain recommendations that serve as an anti-money laundering. Okay, then combating of financing of terrorism. They are known as what? FATF Standard 2012. Okay, so what we are saying, that way RBI is trying to stop money laundering, terrorism financing in India from their banking channels. Similarly, FATF is doing the same. FATF, Financial Action Task Force, is also trying to make sure that we won't be facing money laundering, terrorism financing kind of activity at the global level. So it is providing us anti-money laundering, combating financing of terrorism activity. That's a standard that FATF provided. So money laundering and terrorism financing are what? They are considered as a criminal activities across the world. So it's not like only India is facing such kind of issue. All the countries are facing this money laundering, terrorism financing issue, in which people are using their financial system to fulfill their requirement of criminal activities. So you can see when we talk about FATF's roles, it actually focus on terrorism financing and stopping the terrorism financing. So funding terrorist activities globally. To stop that, FATF is working. It's trying to do what? It is trying to combat the financial crimes, which one covers the financial terrorism financing. Okay, so FATF is a core organization which is combating the financial crimes at the international level. Global implications are there. International impact of financial crimes will be taken care by the FATF. FATF provides us the standards also regularly. So the FATF AML CFT standard given in 2012. Then money laundering, that's a criminal activity undermining the financial system of every country. So FATF is trying to combat the financial crimes that involves money laundering, that involves terrorism financing also. Okay, so this is what the Financial Action Task Force is doing. Next we have money laundering stages. We have 3 stages of money laundering that covers placement, layering and integration. So placement is the stage in which first we enter. We means the people who are performing money laundering, they actually use the placement stage to enter their illegal money to the legal financial system. So while you are reading these statements, I will let you know what is the placement, layering and integration. So when I talk about the placement, what is placement? Placement is simply means where the people who are trying to perform the money laundering, they enter their fund in the legal financial system by using the banking channels. So they actually deposit their illegal money in the banks or in the different bank accounts in the different banks, and that's how the illegal money will be entered in the legal financial system with the help of placement stage. As you can see, in this stage, the funds from criminal activities are introduced into the financial system. Okay, and this is done through deposits in multiple bank accounts. That's a placement. Entering money into the legal financial system. Second, layering. Layering helps to hide such money that have been entered with the banking channel by performing, I can say, the complex network of transaction. So in the layering stage, they by knowingly create a complex network of transactions so that it won't be easy to find out that from where the funds actually came. That's what the layering means. So you can see next, those funds are passed through the numerous financial transactions in these accounts, creating several layers of funds transfer, and these helps in what? In hiding the source of these funds. Then we have integration, the third stage. So we are doing what? In layering, we are creating a complex network of transaction, like we are creating a layer so that it won't be easily find out from where the actual money came from. Third, we have integration. The next step is collecting the funds lying in multiple accounts in one or few accounts that are then deployed for investing in some legal business activity or for having some assets. So now in the integration stage, what will happen? The people who have created a complex network of transaction, they will be getting their money out of the transaction, those multiple transaction, and try to create their own personal assets. Such assets which will help them out to show that this is a legal money. Like they can buy a luxurious house, they can buy a luxurious car or anything else, they can start their own business. And if somebody asks from where you have got this money, they can simply say, I earned that money from the share market, from the bank deposit interest, from the multiple transaction or whatever transaction they have created as a layering. Okay, so they will be talking about that as a legal source of funding for them. That's the integration. Next, we have some stages of money laundering. As you can see, the first is placement, introducing illicit funds into the financial system. Second stage, we have layering, that talks about concealing the source through complex transaction. And the third, we have integration, integrating the laundered money into legitimate economy. So these are the three stages that we talk about as stages of money laundering. Okay, now apart from that, next we have here prevention of money laundering. So the main objective of measures for prevention of money laundering are what? The first one is to prevent the criminal elements from using the financial system. For what? For laundering activities. Hana, we are trying to say that we want to prevent the criminal elements from using the financial system for the laundering services. Then we want to prevent the spread of criminal activity in the society. We do not want that everybody will do that. So we want to stop the spread. Third, we safeguard the economy from financial crimes. Okay, and fourth, we want to prevent the terrorists from gaining access to financial resources. Okay, that's what the objective of preventing the money laundering. Now we are financing of terrorism. So there are numerous terrorist organizations in the world. They are using the financial system of our country for their benefit of raising the fund, of storing the fund, and for transferring the fund. So we have 4 stages in financing of terrorism. The first we have is raising. Raising is simply the sympathizers of such kind of terrorist organizations, the sympathizers of their actually focusing on raising the fund, like the terrorist organization actually focusing on raising the fund from their sympathizers, those people who have sympathy with them. Okay, so they try to raise money from such kind of sympathizers, and that can be in any part of the world. Okay, so that's why the raising stage is there, from where they raise the money. So they source fund from their sympathizers. That can be individual person or an organization, and they can be anywhere. Okay, the second stage is moving. Moving is simply you have raised, the terrorist organizations have raised money from different parts of the world. So now they will be moving that money to the one part of the world, and one city or one state or one country we can talk about, in which they are actually established. Okay, so that's a moving the fund. Third stage we have is storing. After moving, third stage we have is a storing. So after moving fund from multiple parts or from the various parts of the world, we have the terrorist organization have actually transferred their fund into one location, and that one location Now at their location they will be storing that fund, and for the storing purpose, for moving purpose, and for raising purpose, they all are using banking channels. Okay, and the last stage is using it. So whenever they will be performing their terrorist activities, they will withdraw the money from the bank account, from the any financial system they have entered the money in, and then they will be performing the using activity. Then they will use the funds. Okay, so you can see now we have a financial operation of terrorist organization, that is, as you can see, first is raising funds, initial acquisition of fund. Second, we have moving funds, that transferring funds across the network. Third, we have storing funds, securely holding funds for future use. And fourth, we have using the funds. That is final utilization of funds for their operation. That's how they are doing the financing of terrorism. So there are measures to mitigate the money laundering risk that we can say in the Prevention of Money Laundering Act. A lot of measures have been given by Government of India. RBI also keep giving us such kind of things. So first is to know or understand the customer and their financial dealings better. First we have to do what? So banks are required to take the appropriate measures while they are creating any contractual relationship with any person. So first they have to know and understand the customer and what are their financial dealings. Okay, then the bank should detect and report if they found any suspicious transaction about that any customer of their, and they should inform that to the FIUIND, that's a Financial Intelligence Unit. Okay, so they should detect and they should report such kind of activities. Then they should compile with the applicable laws and regulatory guidelines. Right, what they have to do, they have to compile with the applicable laws and regulatory guidelines that have been given by RBI, that have been given by FATF or the Prevention of Money Laundering Act. So they have actually also have adequately trained the staff about the KYC and AML procedure, and that's why the KYC AML certification course is very much in demand, and that's why every bank perform the AML KYC training programs also, for their employees. So this is how the money laundering risk can be mitigated. Okay. Now there are some practice questions. The first is talking about here. Okay, answer is also visible, sorry. Objective of KYC is to ensure appropriate customer identification, to monitor transaction of suspicious nature, to ensure that the customer would not deceive the bank. Fourth, to ensure if loan is given, it would not become an NPA. And the fifth is A and B both. So definitely we want to ensure that the customer identification will be done properly with the KYC, because as it says, know your customer. Then monitoring the transaction of suspicious nature. If any transaction looks like suspicious, we should monitor it. Then ensure that the customer would not deceive the bank. And the fourth one is to ensure if loan is given, it would not become a NPA. So right answer is definitely A and B. These are not the objective of having a KYC. So right answer is E option, that A and B is correct. Okay, next question we have. Okay. Which of the following is not the stage of financing of terrorism? First we have raising, second we have moving, third we have storing, and fourth we have allocating. So financing of terrorism have four stages. Raising is there, moving is there, storing is there, but allocating is not. So right answer will be your D option. Okay, next question we have. Okay, next question we have here that says, consider the following statement regarding the objective of measures for prevention of money laundering. Which of the following statement are incorrect here? So you have to answer this. Read these statements and let me know the answer of this question. Read these statements and let me know the answer of this question. So I guess now the answer is not visible, right? So let me know. Read it once, a statement based question is there, and answer the question. So there are four statements have been given. We have four statements here. Which statement is correct? Okay. So first is saying here that to prevent criminal elements from using the financial system for money laundering activities, that's true. Second is saying is spread of criminal activities in society. No, we do not want to spread the criminal activities. We want to prevent it. So second is wrong. Hana, first is right, second is wrong. To safeguard the economy from financial crime, that's correct. To prevent terrorists from gaining the access to the financial system, that's also true. So right answer is D. Okay, right answer will be your D option. That first, third and fourth is correct. So right answer we have is a D option. Talking about that a banker deals with the different types of customer. Like we have individuals, we have partnership firms, we have companies, we have cooperative societies. They all are the individual type of customers of a bank, and they all have different requirements that they want to have a bank account. Okay, so while opening and in the conduct of account of these persons, the banker has to comply with the law applicable to each of them. Okay, so what we are saying simply, while opening the account in the conduct of the any kind of person, Hana, so bank will be compiling with the different law that will be applicable on the type of customer. So as we can say, the bank have to make sure that each and every rules and regulations which have been given for a dedicated type of customer will be fulfilled. Like if any individual person is coming, they have to fulfill the different set of guidelines. They have to give the different set of documents to the bank to open a bank account. Similarly, if a company is coming to have a bank account, the company will be requiring to submit the different kinds of documents, and that's how we can differentiate the account type also. Okay, so let's start with the very first type of account, that is accounts of individual we are going to talk today. So first of all, individual means any person. It can be you, it can be me. Any individual person is having a bank account. That's a part of account of individual. So you can see an account can be opened for a single individual or for two or more individuals in the joint account. Okay, so a single person can have a single person can have a bank account. Apart from that, the group of people, it can be two or more than two people, can also have a bank account. That will be called as a joint account. So an individual should be major by age. Now how we will define that the person is major or not? On the basis of the age. If the person have age of 18 and more, or 18 plus, 18 and 18 plus age is there, that means the person will be called as a major. Okay, and the person have to be of a sound mind. It means no mental issue or any kind of mental disability should not be there to the people who want to have a bank account. So any individual who is a major and also of a sound mind, they can have the bank account. One more condition is there: the person who wants to have a bank account, they should not be undischarged, insolvent or disqualified from contracting by any law which he is subjected to. Okay, so no such kind of cases, no such kind of guilty a person should be there if they want to have a bank account with the bank. If any person found guilty or any person have been discharged, insolvent and disqualified from contracting by a law, then they cannot open a bank account, because the law have said that these person cannot be participant of a law or any contract. So definitely you can have any account in the bank, because it's simply when you are having any kind of relationship with the bank, that's a contractual relationship. And if from your bank or if any law have disqualified you to become a participant or to become a party in a contract, then definitely you cannot have a bank account. Okay, the next point is saying the account opening form should be signed by individual in whose names the account is to be opened. Okay, it also have been said that the account opening form should be signed by the individual who want to have the account. And if the joint people are there, like let's say two or more than two people are opening a bank account, then they also have to fill the signature. So in certain situations, like when an individual is not sound mind or is a minor, the form may be signed by her court appointed guardian or natural guardian, as the case may be. So definitely if the person is minor means what? Minor is the person who have the age of less than 18 years. Okay, so the person who have a age of less than 18 years, that person will be called as a minor person. Okay, and that minor person is not allowed to enter into any kind of contract. The minor cannot enter into any kind of contract because the law have said that minor is not eligible to enter into any contract. So definitely on the behalf of minor, the guardians, natural guardians or the court appointed guardians will be dealing with the documentation and all the responsibility of the account opening form. Okay. Now next we have a joint account holders. Like we know, individual person can have a bank account. Apart from that, joint account holders can also have a bank account. Now what type of bank account they can have, you can see here. A joint account is an account opened in the names of two or more individuals. Okay, what is a joint account? Joint account is simply an account opened in the names of two or more individuals. So these are opened when the funds belong to more than one person and they desire to exercise joint control on their use. Okay, so let's say more than two people are there who want to maintain one particular account so that they both can have a easy control over the money. So that's why they have a joint account. Although the funds are earned by one person, but for convenient access to another person or to provide easy access to the fund in the event of death of the person owing the funds. So what we are saying simply here, that a person, whoever, whatever the condition is, whatever the cases is, if any person wants to have a joint account with the other party, that will be allowed to them when they are both maintaining their earning together in a one account, or if they want a easy access to the money on each other's money, then they can have this kind of account. Okay, now you can see the next point is saying when a joint account, okay, next point is saying here that when a joint account is opened, the relationship among the joint holder and the purpose of having a joint account should be ascertained. So those people who are having a joint account, who are opening a joint account, they have to tell the bank that why they want to have this kind of account, why they require the joint account. So the reason and the relation between the parties who are having a joint account, you have to tell the relation, you have to tell the reason why you want to maintain a joint account. The next point is saying it is also advisable to know the nature of expected funds inflow in the account. Like it also have been said to the bank that when you are opening a joint account of a customer, do ask the customer from what source of income or from what way they will be maintaining a money in this particular account, like from which transaction, from which source of money the flow of funds will be there in this account. So this have to be informed to the bank in the joint account, okay, by the joint account holders. It means, let's say for example, there are two people who are a joint account holder, and these two people have to tell the bank that they are earning money from which source of what is their source of income, from which particular contract, from which particular area they are earning the money, just to check that they are not doing money laundering or terrorism financing. That's why bank asks that inflow of funds will be from the which particular area and by which particular transaction. So that's why you have to inform the bank like the flow of funds comes from which particular area. Okay, next we have the illiterate person's account. We have seen the individual's account, we have seen the apart from that joint account of individuals. Now we have an individual person who is an illiterate person. So the rules relating to account to have to be clearly explained to an illiterate person in a language understood by the person. So the illiterate person, whatever language they are comfortable with, that language have to be defined to them, and they have to be told by the bank that what are the rules and regulations that follows in their account. Okay, every detail of related to the account have to be informed to them in whatever language they are capable of understanding. So they have to be there. She should be advised that for withdrawing money from the account, she has to personally come to the bank with the passbook. Every time a current account should not be opened in the name of illiterate person. So like let's say for example, if I want to withdraw my money in from the bank account, I can withdraw the money from the ATM. I have no restriction that I have to go to the bank only and then I will be able to withdraw the money. No, I can withdraw the money from ATM. Okay. But if any illiterate person is going and asking to open a bank account, the illiterate person have to come to bank to take the withdrawal. They cannot go to the ATM and withdraw the money. Also, illiterate persons are not eligible to open a bank account. Okay, illiterate persons are what? They are not eligible to open a current account also. Okay, so they can have a savings account, they can have a RD, they can have a FD, but they cannot have a current account. That's the one other condition. Now, checkbook should not be issued to her under any circumstances, even in case of joint account. Okay, the illiterate person won't get any checkbook from the bank because they are not capable of reading and writing or something, because they are illiterate, so they are not eligible to take the checkbook. Apart from that, also a left hand thumb impression of the account is obtained on the account opening form in the presence of an authorized bank officer and a person well known to the bank who will attest her thumb impression on the account opening form. So what we are saying here, that simply the left hand thumb impression of account holder have to be taken while opening a bank account. In the bank account opening form also the thumb impression have to be taken, and the thumb impression will be taken in presence of the authorized bank officer, and one person that is well known to the bank should be there as an witness. Okay, apart from that, passport size photograph of a customer have to be obtained, one to be attached with the account opening form and another to the passbook. Okay, so it's important that the customer will be asked to give their passport size photo. The passport size photo will be attached to the account opening form, as well as it will be given to the passbook, like it will be added to the passbook. Every withdrawal should be orally confirmed by the account holder to the authorized official. Okay, so authorized official who is performing the withdrawal from the account of the illiterate person, they have to orally ask the customer that this is the amount they want to withdraw, because customer is illiterate, and when the customer is illiterate, you have to confirm the amount before allowing them to withdraw the money. Okay, that have to be confirmed. Now the next type of customer we have is a blind person. The blind person can also have the account, but definitely there are some challenges that bank have to face while maintaining an account of a blind person. So first of all, it's saying that there is no legal bar for a blind person to open a bank account. Okay, also due care must be exercised in the account of blind person, as there may not be consistency in their signature. Hana? So it's very important that whenever we are going, the particular due care will be taken of a blind person. So as they always depend on someone, the chances for their being cheated is great. Hana? Because they are what? They are dependent on someone else, and that's why their chances of being cheated is very greater, and that's why we are saying that a due care have to be taken. Also, the account holder may send a messenger for transaction whose reliability may not be known to the bank. Okay, the account holder can do what? They can send a messenger for the transaction whose reliability may not be known to the bank. Why we are doing so? So that the customer won't get cheated by the bank employee and the person they are sending them to bank for the messenger. So passport size photograph of blind person will be taken. It will be attached to the account opening form and to the passbook as well. Okay. Next we have account of blind person says another point, that the signature and thumb impression of the blind person has to be attested by a person well known to the bank. Okay. So the signature as well as the thumb impression have to be taken of the blind person before allowing them to have a bank account. Okay. So where the branch manager is satisfied, he may allow a blind person to operate the account by themselves or by next of kin. Next of kin means the next relative of the blind customer are taking proper letter of authority from the blind customer. So first we are saying that where branch manager is satisfied that the customer can perform the transaction by themselves and customers are capable of maintaining their reliability as well, then the branch manager allow them to operate their own account, and also the branch manager can allow them that your relative can maintain your account also. Hana? But obviously there is very important that you have to give the proper letter of authority to the bank, and then only bank will allow someone else to maintain your account. So whenever inconsistency in the signature of blind customer is noticed, her left thumb impression also may be obtained. Hana? Because obviously the blind person will not be signing every time similarly. So whenever the bank feels that the signature is different, then they at the same time, before performing any transaction request of a customer, they have to take a thumb impression of a customer also, okay, to confirm that the customer is actually come by it herself to take the transaction. Okay, now account of minor. Who are the minors? Minors are the persons who have not attained the age of 18 years. So if any person is only one day less than their 18th birthday, then they all will be called as a minor. So whatever the duration, if you are 4 hours left only in your 18th birthday, still you will be counted in a law as a minor. Okay, so the major person will be simply the person who attained the age of 18 years. So minor is simply, as per the law, the person who have not attained the age of 18 years yet. So according to Indian Majority Act 1875, every person domiciled in India, including a minor for whom a guardian for the person or property is appointed by a court, attains the age of majority on his or her completing the age of 18 years. Okay, so before completing the age of 18 years, the person is not eligible to enter into a contract, and that's why the person is called as a minor, and that is defined under the Indian Majority Act 1872. Also, as per section 2 of Indian Contract Act 1872, when the age of maturity has been provided by law to be 18 years, any person less than that age, even by a day, would be a minor in law. Okay, so if any person is actually going to be 18th tomorrow, then today that person will be counted as a minor only. In the law, the person will be minor even by a day he is less than the 18 years age. Okay, now there are certain rules have been given for the maintaining of the account of a minor. The first rule is saying the minor's account should not be allowed to be overdrawn. Okay, the minor account are not allowed to be overdrawn. Overdrawn facility will not be given to the minor. Now section 26 of Negotiable Instrument Act 1881 provides that a minor may draw, endorse, deliver and negotiate a negotiable instrument, and as such a minor can draw a check. So section 26 of Negotiable Instrument Act 1881 says that minor is allowed to use the negotiable instrument. We have a negotiable instrument, promissory note, bill of exchange and check. So it is saying that a minor can draw a check because section 26 of the NI Act on Negotiable Instrument Act 1881 simply says that minor is allowed to use the negotiable instruments. Also, on the minor attaining majority, the guardian is not allowed to operate the account any further without confirmation from the minor. Okay, so when minor attains the age of 18 years and become major, the guardian, if want to perform any transaction, they have to confirm with the major, the person who become major right now, and then only they can perform the transaction in the account. Now banks are free to fix the minimum age at which they will allow the minor to operate savings bank accounts independently, and this age was set by SBI first time, and that is 10 years. So any individual, any minor can operate their own account by themselves once they attain the age of 10 years. Okay, so this have been decided already. Now ordinarily balances in such account are subject to a maximum amount as decided by bank. So if minor have an account, the minor's account will be maintaining a certain amount of balance, and that will be decided by their bank. Now in the event of death of the minor, the guardian has to close the account. If the minor death happened, then the guardians have to close the account. They cannot continue the account of a minor after the death of a minor. Also, on attaining the majority, the minor should confirm the balance in her account, fresh operating instruction for operation by the guardian, fresh disbursement signature of the minor should be obtained and kept on record. Because the minor become major now, the major will be maintaining their account only. So now they have to give their signature to the bank, because by using their signature transaction will be conducted, and also they will be giving the instruction like who can maintain the account, who can withdraw from the account. Okay, so a fresh instructions have to be given to the bank. And if the guardian dies due to the minority of the account holder, then the balance can be paid to the minor after his attaining the majority. Okay, so when let's say the minor have not attained the age of 18 years, but before that their parents, their guardians died, in that case the minor will get the payment, the minor will get the money in the account, but only after obtaining the age of 18 years. Okay, not before that. Now, this was the type of account that we have discussed of individuals only, है ना? So we have discussed individuals account, like we have discussed individual account, joint account, minor account, blind person account, illiterate person account. These type of accounts we have discussed. The conditions of these account we have discussed. Apart from that, we also have a company's account, limited liability partnership account, partnership firm account, and the account of, we can say, companies, cooperative societies. So they all have a different kind of guidelines. They all have a different types of set of documents that have to be submitted. Now all of that in detail we will be covering in our paid classes, in our comprehensive batches. That's a success batch we have already started. In success batch from 16th of June we are starting PPB subject. So in that batch we will be discussing each and every detail related to the type of customers and account opening conditions in the class. Okay, so now whatever we have discussed today, let's practice some questions on the same. So first question is talking about here, which statement is incorrect in terms of, one second, yeah, now let me know the answer. Which account is which statement is incorrect in terms of the bank account of for blind? Like which terms and conditions here is wrong for the bank account of your blind? The first is saying no open bank account for blind, they have to get permission from the courts. Second is saying due care must be exercised in account of blind person, as there may be not be consistency in their signature, as they always depend on someone. The chance for their being cheated is great. Then the account holder may send a messenger for transaction whose reliability may not be known to the bank. Third is saying passport size photograph of the blind person have to be obtained, one to be attached to the account opening form and another to the passbook. The signature or thumb impression of the blind person has to be attached by the person well known to the bank. And the fifth statement is saying where the branch manager is satisfied, he may allow a blind person to operate the account by herself or by a next of kin of the blind customer after taking proper letter of authority from the blind customer. So what do you think? Which statement is correct here? So we are talking about the incorrect statement. We have to find the incorrect statement of a bank accounts for the blind. So always focus on one thing, what the question is asking for. Here the question is asking incorrect statement about the account for the blinds. So first is saying no banks open bank account for blinds. Is it true? Obviously not. This is incorrect. This is a wrong statement because banks are allowed to open the account for a blind person. So first is wrong. The second is correct. Due care have to be taken and the signature might change. So that's why the account holder may send a messenger for transaction also. And the consistency won't be there in the signature. So that's why the left thumb impression have to be taken. Now passport size photograph will be taken. One will be attached to the account opening form and the another to the passbook is correct. Signature or thumb impression of the blind person has to be attached by a person well known to the bank. That's also correct. And also when the branch manager is satisfied, he may allow the blind person to operate the account by themselves and the next of their kin can maintain the account. Okay. So it means only one statement is wrong here. That is the statement 1. So right answer is only 1. Okay. So right answer of this question will be only 1. That's the A option. Because all the other statements are correct here. Okay. Now next question we have here, that's talking about which statement is correct in terms of Hindu undivided family. So now Hindu undivided family is also one of the type of customer we have that the bank maintain the account with or bank maintain a contractual relationship. So which statement do you think is correct about Hindu undivided family? The details about Hindu undivided family account we will be discussing in our comprehensive batches. There you will study about the Hindu undivided family accounts. Now you can see the first is saying the elderly male member of Hindu undivided family is known as Karta. What we are saying, the elderly male member of Hindu undivided family is what? It is known as a Karta. Second is saying the Karta is also known as a manager. Third is saying all the other members of family including a married or unmarried daughter of family known as co-pensioners. And fourth is saying eldest female member of Hindu undivided family can also be a karta. So what do you think, which statement is correct? First, second, third or fourth? So now we have to find out the correct statement. Okay, related to Hindu undivided family, we have to find out the correct statement. So which statement is correct here? A, B, C or D? A is saying only one, B is saying 1 and 2, C is saying 2 and D is saying all. And the right answer will be your all option. Because yes, the eldest female, if she wants, she can become the karta. The karta is also known as manager, and the elderly male member will be the karta of a family, of Hindu undivided family, and all the members of the family, whether they are married or unmarried daughters, they will be called as a co-pastlers. So right answer will be your D option. You can see here the right answer, we have a D option, all of the above. Next question we have, which statement is are incorrect in terms of bank account for the illiterate person. Now we have to find out the incorrect statement about the illiterate person account. So first is saying here a current account can also be opened in the name of an illiterate person. Second, checkbook should be issued to her under any circumstances, even in case of joint account. Third is saying passport size photograph of the customer have to be obtained, one to be attached to the account opening form and another to the passbook. Fourth is saying every withdrawal should be orally confirmed by the account holder to the authorized official. Fifth is saying no illiterate person account should be opened with operations facility of either or survivor or by illiterate person only. So which of the following statement about the illiterate person is correct? A, B, C or D? The incorrect statement. So see, first is saying that a current account can also be opened in the name of illiterate person. So illiterate person can have a current account? Obviously not. So this is wrong. First is wrong. Okay, now if the first is wrong, we can say that C cannot be the right answer. Why? Because C do not include the first, and the question is asking about incorrect. So definitely the answer will include the first statement. Second is saying checkbook should be issued to her under circumstances even in case of the joint account. No, the illiterate person won't be having a checkbook. So definitely the first is also wrong. Why the first is wrong? Because it do not include the second statement. Now it can be either B or D. Now third is saying passport size photograph of a customer have to be obtained, one to be attached with the account opening form, another with passbook. This is true. Every withdrawal should be orally confirmed. That's also true. No literate person account should be opened with operation facility, either or survivor or by literate person only. That's also true. It means only second and fourth statement is wrong. So right answer we have is what? B option. Only second and third statement, first and second statement is wrong. Okay, only two statements are wrong, and those two statements we have as a first and second statement. So right answer we will be having a B option. Okay. Now next question we have, minor's account can be opened in the guardianship of. First is saying mother and father, second is saying mother or father, third is saying grandmother, or fourth is saying elder brother. So minor, we know the person who have not attained the age of 18 years yet, that person will be called as a minor, and his account will be maintained. In what case? Like the account will be opened in the guardianship of whom? Mother and father, mother or father, grandmother or elder brother. So it means the right answer will be definitely mother or father. Individually also they can become a guardian, and they are guardian of a minor, and they can maintain the account, they can open the account. So right answer is B. Okay, now next question, a minor for whom the court has appointed a guardian attains majority on completion of dash years. Is it 21 years, 18 years, 15 years or 17 years? So when a minor become major? A, B, C or D? And definitely a minor becomes the major once they attain the age of 18 years. So right answer will be again B option. Okay. So this is a module A, in which total we have a 21 units. As you can see here, we have total 21 units in module A. Out of this 21, unit number 1, 2, 3, 4 and 5 have been completed. Today we are discussing unit number 6, that is operational aspects of handling, clearing, collection or check. Okay, and you can see total unit you will find here 21 units are there in the module A. Okay, so let's start with the operational aspect of handling, clearing, collection or check or cash, sorry. So in this, the first concept that comes here, that is your check truncation system. I guess everybody is very much aware about this check truncation system. This was introduced by RBI after MICR. So first we used to have a MICR, magnetic ink character recognition, and that have been changed. That was discontinued and the CTS was introduced. CTS stands for check truncation system, in which the truncation actually represents to stop the physical movement of check. It represents to stop the physical movement of check. Okay, so we are trying to stop the physical movement of check. That's what the truncation actually means is, and this is what the CTS actually have done. Now we do not have to, we means the bank do not have to exchange the check in physical form from one place to another. What the bank can do directly, bank can simply take an electronic image of a check and share it with the other branch or the bank from where the fund have to be transferred. And this is how the check truncation system stops the physical movement of check and helps us out to perform our check clearance process. Okay, so check truncation, do remember, it means physical movement of check have been stopped. So you can see RBI actually introduced this check truncation system, CTS, for interbank clearance of check without their physical movement. So without the physical movement of check, we will be capable of changing the funds, or we will be capable of making the payment of check. That is what the objective behind the CTS is. Next thing, we have the checks are paid based on their electronic images, and 3 electronic images will be taken to make the check clear. With suitable amendment to the Negotiable Instrument Act 1881, the Information Technology Act 2000, and the Bankers Book Evidence Act 1891, the legal framework for check truncation and e-checks was put in place in 2002. So CTS was introduced with effect from 1st February 2008, and it is now fully operational in the country. So we are simply saying that when we talk about the check truncation system, this is the way in which we are performing physical movement of check. Okay, what we are performing a physical movement of, we are stopping the physical movement of check in the CTS, but before that we were performing the physical movement of check. It means to clear the check, check used to be physically transferred from one bank to another or the clearing house, but it have been removed in the amendment have been done in NI Act, IT Act and your BBE Act. In these 3 acts, amendments have been done and the physical movement of check have been removed. And with the introduction of CTS, the MICR based check processing also been discontinued. MICR stand for magnetic ink character recognition. That is a 9-digit code. Actually, MICR code is a 9-digit code which represents the city, bank and branch. And first we used to have this technology, MICR, magnetic ink character recognition based technology we used to have to clearance of the check, but now it have been discontinued once we have introduced the CTS. So now we are using the check truncation system. Now, what are the characteristics of check? The first characteristics is that it is an electronic image of a paper check. So it's simply, that's the checkbook that you find. Earlier we used to have the same pattern of checkbook we have, with the more security feature, with the more better features, but still the physical check have a same kind of appearance. Now this physical check or paper check is in an electronic image. That's the first characteristics of CTS. Only the banks involved and the clearing house can truncate a check. Truncate a check means they can only, the bank which is involved and the clearing house which is involved, these are the parties only who can convert the physical check into electronic form. So converting check into electronic form into an electronic image is actually called a truncate a check. So who can truncate a check? The bank and the clearing house only. The drawer or holder of a check cannot truncate the check. Like if I am the drawer of a check, I cannot make it electronic image. I cannot convert the physical check into electronic image. And the beneficiary, the payee who is receiving the fund, is also not able to convert the check into electronic image. Okay, it can be done by the bank or the clearing house only. Next, So the electronic image of a check truncation substitute the physical check from the point and time of truncation onwards. So because we are taking electronic image of a check, so the physical movement of check have been removed and it have been substituted. So truncation is done, as you can see here. Truncation is done only during the course of clearing cycle to reduce the time taken for the realization. So truncation means the check will be converted into cash only and only when we are talking about the changes will be done in the course of clearing cycle. Okay, then only the changes in the physical form to electronic image will be done. The paper check after truncation is kept in the custody of the bank clearing house that truncated the check. Okay, so what we're talking about, the paper check, once it have been truncated, it means it have been converted into electronic image. The physical check will be in the custody of a bank or a clearing house who have performed the function of truncate. Okay, so they will be holding the physical check. Next we have that says that the addition to the digital signature of the truncating bank clearing house to the electronic image of the check truncation is optional. So what we are saying, the addition of the digital signature of the truncating bank or the clearing house to the to the electronic image of the check truncation is what it is optional. Okay, so this is what the characteristics of your CTS is, and this is how the CTS actually works, and very beneficial now for the bank as well as for the customer, because it clears the check with a very minimum time period and gives a very better result. The customer is happy and the bank is also happy in that. Now CTS images we are talking about, because CTS in India uses a combination of grayscale and a black and white images. Okay, grayscale will be utilized and a black and white images will be taken of a check. So total 3 images need to be taken of each check. That first image will be of a front grayscale, second will be front black and white, and third will be back black and white. So these 3 images, electronic images, have to be taken to perform the truncation of a check, or to use the check in the CTS format. So for that we have to perform the conversion of physical check into 3 electronic images. One will be front image of a check with a grayscale, second the front image in a black and white, and third the back image of a black and white. Okay, so images of checks are taken using the specific scanner, and the presenting bank has to digitally sign the images and the data at the point of origin itself. So images do not meet the specifications that are rejected. Okay, so those images who do not fulfill the specification of the image, they will be rejected by the bank to make the payment. Okay, and to get the payment, the next again the new image have to be sent. Okay, now there is a rigorous quality check process with image quality assessment at different level. So images quality will be also checked at a different level, that will be called as a image quality assessment, IQA. It will be performed at a different level, and paying banks, if not satisfied with the image quality or for any other reason, they can demand for the physical check before making a payment of the instrument. So let's say whoever the paying bank is, the paying bank got the electronic image of a check, but they are not satisfied with the electronic image. Like they feel like something is wrong with the image, something is missing in the image. So they can demand that I need a physical check, then only I will be making the payment of this check. Then they will be getting the physical check also from the bank or the clearing house who actually had custody of that physical check. They have to transfer it to the paying bank. Also, the security, integrity, non-repudiation and authenticity of the data image transmitted from presenting bank to the paying bank through clearing house are ensured using a public key infrastructure. So this is how the security to the check clearing process will be given, by having a public key infrastructure. So throughout the entire cycle, that covering capture system, the presenting bank, the clearing house and the paying bank, all this will be going through with the public key infrastructure that provides the security, integrity and everything that will be helping you out to clear the payment of a check. Okay, so this is how the actual CTS works. That's how the CTS works. That's how the platform of CTS works. Now, Next we have here, that is CTS positive pay system. Now when I talk about CTS positive pay system, this was introduced by RBI on 1st January 2021. It was introduced by whom? RBI. It's a positive pay system that is introduced by RBI on 1st of January 2021. When we talk about positive pay system, like I guess everybody of you are very aware about this. Earlier, a lot of frauds used to happen with the check. People used to rewrite the check, or overhand writing have been done. Sometimes they were not easily been identified. Let's say you have given the check to someone of 60,000 rupees. But in words and figures, when you have mentioned your amount, you have left a certain space there. So what the another person have done, what the beneficiary actually have done, they have added 1 lakh before 60,000. So in the words, they have added 1, and in the figures, they have added 1, and in the words, they have written 1 lakh, let's say, for example. So you check that you have given of 60,000 rupees become 1,60,000 rupees. Now, when the beneficiary goes and submit that check in the bank and your account have 1,60,000 amount, then the total amount will be paid to the beneficiary. And if your account don't have such kind of money, in that case, it's very simple that your check will be bounced because there is insufficient balance in the drawer's account. Then you as a drawer have to pay the penalty on that. So such kind of issues used to happen in the check system, and to remove such kind of frauds, positive pay system was introduced by RBI in 2021. So in this positive pay system, RBI said if the check value is above 50,000, then that's the optional value. Above 50,000 is optional, and 5 lakh and above will be the mandatory value. So if any check values above 50,000 and above 5 lakh, in that case, the drawer, this involves the process of reconfirming the key details of a large value check. You are reconfirming the details of a check that you have given to someone else. So the issuer of the check, it means the drawer, submits electronically via SMS, mobile app, internet banking or ATM the certain minimum details of a check. Details like date, name of a beneficiary, or that is also called as a pay, and the amount you have issued check of. So these 3 details you have to submit to your bank related to with the help of SMS, mobile app or internet banking or ATM, right? Now the drawee bank, details of which are cross-checked with the presented check. Now any discrepancies flagged by CTS to the drawee bank and presenting bank who would take redressal measures. So if any changes, let's say you have given the detail, I have issued check to Mr. A of 60,000 rupee on 10th of June, for example. This detail you have given to your bank and the amount is, let's say, 10 lakh rupees. But somehow when the check actually appear to the bank, it is, let's say, for example, 10 lakh 80,000 rupees. So now bank will cross-check both the details given by you via SMS, mobile app or something, and the check have been presented in a bank. If both details are same, then the check payment will be done. If not, then the payment won't be done and the check will be dishonored. It means it will be returned back without payment. So bank will first confirm with the drawer and then only make the payment. Okay. So National Payment Corporation of India is managing the CTS system, has evolved the facility of positive pay system in CTS, and bank have to make such a facility available to all the account holder issuing check for amount of 50,000 and above. But this is an optional value. It is optional. If any customer want, they can use this. If they don't, there is no mandatory condition. Now the customer has discretion whether to avail this facility in the amount of 50,000 and above. But banks have the option of making it mandatory in case of checks for the amount of 5 lakh and above. If the check value is 5 lakh and above, then the bank will make it mandatory to perform the CTS, CTS positive pay system. It means you have to give the details, the date, amount and the beneficiary's name to the bank via SMS, mobile app, internet or ATM. That becomes mandatory when the value of check is 50,000 or above. Now, only the check complaint with above instructions will be accepted under dispute resolution mechanism at the CTS grid. So what we are saying, only the checks compliant with the above instruction, it will be what accepted under the dispute resolution mechanism. And bank should make customer aware about the positive pay system through the SMS alerts display in branches, ATM, website or via internet banking. So bank have to make the customer aware about the CTS, or we can say check truncation positive pay system, so that whenever they are giving check to someone, they will follow the positive pay system facility. Okay, now let's move. Which of the following are not the characteristics of CTS? Which of the following is not the characteristics of CTS? So first is saying it is an electronic image of a paper check. Second, banks and financial institution can involve and the clearing house can truncate a check, like create an electronic image of a check. Third, the electronic image of a check truncation submits the physical check from the point and the time of truncation onwards. And the fourth is saying truncation is done anytime. Reduce the time taken for realization. And your option is only 3. Second is saying here only third and fourth. And third is saying second and fourth, and D is saying all of the above are correct. So which of the following is correct, you have to tell. Which of the following are not the characteristics of CTS? Not the characteristics of CTS. So first is saying it is an electronic image of a paper check, and that is true. Hana, definitely this is a characteristic. Second, banks and financial institution can involve and clearing house can truncate a check. No. The bank can create an electronic image of a check. Truncation will be done by the bank or the clearing house. Hana, we are saying it will be done by the bank or the clearing house. Clear? So this is definitely wrong. Now, the electronic image of a check truncation substitute the physical check from the point and time of truncation. That's true. Truncation is done anytime, reduce the time taken for realization. No. Truncation will be done in the case of cycle, Hana, on the basis of the cycle. So definitely second and fourth is actually wrong. Hana, second statement and the fourth statement is actually wrong. So right answer will be your C option. The right answer will be your C option. Clear? So this is how we have to find out the answer. Now the second statement should be bank and the clearing house which are involved. They can perform the truncation. Not any financial institution can perform this. Now the banks which receive the image and data from the clearing house for the payment processing, which is done on the same day. The bank also generate the return file for unpaid instrument known as the presenting bank, the paying bank, the sender bank, or the receiver bank. Which bank it will be? A, B, C, or D? So banks which receive the image, Hana, and data from the clearing house for the payment processing, they will be done on the same day. Now the bank will also generate the return file, Hana, for the unpaid instrument. That bank will be named as what? The presenting bank, the paying bank, the sender bank, or the receiver bank. A, B, C, or D? Which one is correct? Okay. So definitely the right answer is paying bank. The paying bank will be there who will make the payment at the same day once they have received the electronic image of a check. So right answer will be paying bank. Okay, right answer will be your B option. Now, which of the following cash held at branch is not required to be under the dual custody? Now, in this particular chapter, we also have to study the details about the cash and its holding, the custody of cash in a bank branch. Who will have the custody of a cash in the branch? That also have to be covered in this particular unit. Like this question. In this question, we should know who will have the custody, Hana, and we are talking about the cash that is held in a branch that do not require to be in the dual custody. Dual custody means the custody of a branch manager and the officer. So in this case, which one is it? The cashier hand balance, the notes of less than 100 rupees denomination, or the cash balance in the form of coins, or all of the above? So which one is correct? A, B, C, or D? So definitely the cash which is in the hand of cashier, or the cash that have been given to the clerk or the cashier, we can say, that do not require the dual custody. It will be under the custody of a cashier only. So right answer will be your A option. Okay, right answer will be, we have a option. Now, next we have RBI has introduced the positive pay system for CTS with effect from which particular date? Definitely it is 2021, so you can eliminate the fourth option. Okay, but is it December, January or March? And the right answer is it's December. So 1st January 2021 is the right answer. Okay, so under the CTS process, dash images are to be taken of each check, 2, 1, 3 or 4. How many images have to be taken? Sunita ma'am, in Hindi, classes are also going on in Officers Under 24/7 channel. Hindi medium classes are going on at Officers Under 24/7 channel. Okay. So how many images will be taken? 3 images. 1 front grayscale, 2nd front black and white, 3rd back black and white. These 3 images have to be taken. Okay, so right answer is C. All cash remittance in transit are covered under which insurance policy obtained by the bank? So when we are talking about the all cash remittances that will be performed by the bank, what kind of insurance will be taken for it? Is it a raincoat insurance? Is it a pillow insurance? Is it a blanket insurance? Is it none of the above? So it's a blanket insurance which cover multiple types of transactions. So right answer is your C option. Okay. Now, which of the following action is proper in handling counterfeit notes? Counterfeit notes means the fake notes we are talking about. First is saying a teller refuses to accept counterfeit note detected by her at the counter. Second is saying during checking of bulk cash of a customer, counterfeit note is detected. The customer comes and replaces it with a genuine note and is given back the counterfeit note. Third, the teller detect a counterfeit note at the counter, keeps it against receipt given to the customer. The note is destroyed by the head cashier. Fourth, the counterfeit note detected at the counter is impounded by the teller and the brands it with counterfeit stamp. So if any counterfeit currency is received in a bank, what should be done by the cashier or by the bank branch? A, B, C or D? Okay, so definitely first is saying the teller refuses to accept this counterfeit note. No. During the checking of bulk cash, a customer counterfeit note is detected. The customer comes and replaces it with genuine note. No, definitely no. The teller detects a counterfeit note at the counter, keeps it against the receipt given to the customer. The note is destroyed. No. So the counterfeit notes detected at the counter is impounded by the teller and brands it with the counterfeit stamp so that it will be given to the RBI and informed to the nearest police station also. So the fourth option will be utilized, or the fourth option will be performed to make sure that the counterfeit currency transaction will be performed. Okay, so this will be done. As you can see here, out of these 21 units, we will be covering today the 8th unit that is talked about foreign exchange remittance facilities for individual. So this is what we are going to talk about in today's session. So let's start. And when we talk about foreign exchange, let's understand first what actually the foreign exchange is. When we talk about the foreign exchange simply means the exchange of currencies. Okay, foreign exchange means the exchange of currencies. So whenever we perform the exchange of currencies, that is called as a foreign exchange. Exchange of currencies means dollar to rupee, rupee to dollar, dollar to euro, euro to yuan, any currency exchange if we are doing, that's a part of your foreign exchange. Now, foreign exchange remittance means we are transferring foreign currency in the other countries. Let's say NRIs, non-resident Indians. These are those people who are citizen of India, but they are living abroad for the period of 182 days or more than that in a one financial year. So if any Indian citizen is living more than 182 days in one financial year abroad, that particular person will be called as a non-resident Indian. And those non-resident Indian, they are living there, they are working there, they are earning there, but they are transferring their fund to India. Okay, they are transferring their fund back to India to their family for their medical purposes, for their taking care of purposes. But yes, they are transferring their earning from USA or Japan or any other country they are living in, from there to India. And that is called as the foreign exchange remittance. And definitely it's not freely allowed that without any purpose you can perform the foreign exchange remittance, or without any proof you are allowed to perform the foreign exchange remittance. Definitely not. So foreign exchange remittance will be done on the basis of the rules and regulations which have been given under the Foreign Exchange Management Act 1999. So Foreign Exchange Management Act 1999 talks about what are the rules, regulations are there to perform the foreign exchange transaction, and that we are following in the remittance as well. Okay, so let's start with the understanding of what actually the foreign exchange is. So foreign exchange means foreign currency. Foreign exchange means foreign currency, which includes deposits, credits, balance payable in any foreign currency. Second, we can say it includes drafts, traveler's check, letter of credit, bills of exchange expressed or drawn in Indian currency but payable in any foreign currency. Then third, we are saying draft, traveler's checks, letter of credit, bill of exchange drawn by banks, institution or person outside India but payable in Indian currency. This is the foreign exchange. So foreign exchange simply means the exchange of currencies from one to another. Foreign exchange actually means exchange of currencies. When you convert dollar into rupee, rupee into euro, euro into yuan, yuan into renminbi, or sorry, yuan into let's say peso, then that all transaction are foreign exchange. So whenever you have to perform the exchange of currencies, that is called as a foreign exchange. And now you can see here, in every transaction, in every statement, actually here it is exchange of currencies happening. You can see foreign exchange is what? Foreign exchange is foreign currency, and it includes deposit, credit, balance payable in any foreign currency. So you have any deposit, you have any credit, any balance, that payment have to be done in the foreign currency. Again, you are exchanging your currency. That's why it's a part of foreign exchange. Second, also same, the draft, traveler check, letter of credit, bill of exchange, they are expressed or drawn in Indian currency, but you have to pay in a foreign currency. Definitely conversion of currency is happening here. Third is also same, these documents are issued outside India, but they have to be payable in Indian currency. So again, the conversion of currency have to be done. And that's why this is called as a foreign exchange, because the conversion of currency is happening in this transaction. That's why they are called as a foreign exchange. Okay. Now, next, let's talk about evolution of FAMA. So whatever transactions, whatever remittances of foreign exchange is happening, or foreign currency is happening in our country, they all go with the rules, regulations of FAMA. But how FAMA came in our country, how we have introduced the FAMA in our country. So first of all, for a long time after independence, foreign exchange in India was treated as a controlled commodity because of its limited availability. So India used to be a socialistic economy. Socialistic economy means the economy which is run by the government. And when the government was running the economy, it was called socialistic, planned, or you can call it a command economy. And definitely because the government was running this economy, it was a very strict rules, regulations in the economy. There was a very strict rules and regulations were there in the economy. But at that time, these rules and regulations were very important, because we were at a kind of, at least we can say we are a type of a closed economy, which were doing export, import, but of a very limited commodities, right? So that's why we had a very limited foreign exchange reserves. So a lot of rules, regulations have been introduced in the foreign exchange transaction. So now exchange control was introduced under the Defense of India rules on September 3rd, 1939. So first time exchange control in India was introduced with the Defense of India rules, and that have been done on the 3rd of September 1939, before independence. Okay. Then the statutory power for exchange control was provided by the Foreign Exchange Regulation Act 1947. Then after 1939, we have got the Foreign Exchange Regulation Act 1947, which was actually controlling the foreign exchange transaction of our country. But soon it was also replaced by more comprehensive Foreign Exchange Regulation Act 1973. Okay, so more comprehensive act have been introduced. that is the Foreign Exchange Regulation Act 1973. After this, we have seen that a significant development in the external sector resulted in a changed environment in our economy. So in 1991, we have LPG, we have liberalization, privatization and globalization reforms that we have discussed yesterday in IIFS session of ours. So LPG reform was there. Because of the LPG reform, the environment of the economy and the external sector totally changed for India. And at that time, regulating the foreign exchange was not the solution to promote the globalization, liberalization or privatization. And that's why, keeping this in view, the Foreign Exchange Management Act was enacted to replace the FARA, which became effective from 1st June 2000. So Act became in 1999, but it became active from the 2000 year. Okay, so this is how the foreign exchange have been managed in our country. So it brought a new management regime of foreign exchange consistent with the emerging framework of the WTO. So the first 1939 was the year when Defense of India rules have been introduced, in which the control of foreign exchange used to happen. Then this was replaced by Foreign Exchange Regulation Act 1947. Then it became more comprehensive as a Foreign Exchange Regulation Act in 1973. So this is also replaced. 1947 FARA was also replaced, and then the 1973 FARA was replaced with the Foreign Exchange Management Act 1999. Okay, so now in the FAMA we are managing the foreign exchange. We are not putting a lot of restrictions on the foreign exchange. We are just trying to manage the foreign exchange in the Foreign Exchange Management Act. Okay, so this is how the evolution of FAMA started. Now sorry, because we are talking about foreign exchange remittance, so there is a liberalized remittance scheme which is allowed to perform the outward remittance. Now what does outward remittance means? Outward remittance means the funds will be transferred from India to abroad. Okay, from India to abroad, the fund transfer will be done. That is the outward remittance. Okay, this is what the outward remittance have been called. And for the purpose of outward remittance, RBI have introduced liberalized remittance scheme in the year 2004. Okay, who have introduced this? RBI have introduced the liberalized remittance scheme in 2004, and this liberalized remittance scheme is for the resident individuals, including the minors. Minors means those people who have not attained the age of 18 years. They are called as the minor. So all the resident individuals, including minors, RBI has eased the restriction for outward remittance under the liberalized remittance scheme introduced in 2004. Then this scheme has replaced the provision of current account transaction for the individuals, and the liberalized remittance scheme have a certain conditions like who are eligible for this. First of all, the eligible party is it is available to the resident individuals, including the minors. Okay, minors means below 18 years age. Okay, they are called as the minor. Now, second, we have that it is not available to corporate, partnership firms, Hindu undivided family and trust. Okay, what we are saying that this scheme is not available to anyone else apart from residents. So only residents, individuals, that we are saying subject to individual family members compiling with the terms and conditions. Clear? So simply we are saying here that when we are talking about the remittances, it can be consolidated in the respect of family members subject to the individual family members who are compiling with the terms and conditions. Then we have for the capital account transaction, clubbing is permitted here. Only if the other family members are co-owners or co-partners of the overseas bank account, investment or property, then only the clubbing will be permitted to perform the outward remittance. Now the permissible amount is $2.5 lakh in a year per head. In one financial year, $2.5 lakh can be transferred from India to abroad or can be remitted from India to abroad. It was earlier only $25,000. It was earlier the $25,000 per head, but now it have been changed to $2.5 lakh per head in one financial year. And there is no restriction on the number of transactions. Unlimited number of transactions can be performed by the people, but definitely only $2.5 lakh in a year can be remitted, not more than that. Okay, so this is the silent features of liberalized remittance scheme we have in the LRS scheme, introduced by RBI. So do remember that liberalized remittance scheme is very important. These basic silent features are also very important. Okay, so do remember them. Also do remember that it's not like only $2.5 lakh will be allowed, more than that won't be allowed. $2.5 lakh are allowed as per RBI conditions without any condition or something. But yes, if anybody wants to transfer more than $2.5 in a one financial year, you have to go and take a RBI prior permission. If RBI gives you the permission, you can go with the beyond the limit as well. But definitely permission have to be taken. Okay. Now this is the understanding of foreign exchange. Then apart from that, we have discussed FAMA evolution and we have discussed liberalized remittance scheme basic functions. But apart from this, a lot of things are there that you have to cover in this particular chapter. Like for example, in the liberalized remittance scheme, you have to cover the current account, capital account transactions, schedule 1, schedule 2, schedule 3 transactions, authorized dealers, we have to cover inward remittance rules. Apart from that, we also have to cover the multiple definitions related to foreign exchange regulations or Foreign Exchange Management Act that we have to cover in this chapter. But that we will be covering in our comprehensive classes. Okay, and the detail of the comprehensive classes I will give you in the end of the session. Now let's start with the first question. Purchase of foreign currency from resident person is allowed up to or equivalent which amount? $1,000, $2,000, $3,000, or $4,000. So what is the amount of foreign exchange purchases allowed? That is from resident. It is $1,000, $2,000, $3,000, or $4,000. And the right answer will be your simply A option that talks about the $1,000. Okay, this is the amount that is allowed to be purchased from the resident person. Second question we have, which of the following is not the feature of FAMA? Not a feature of FAMA we have to answer. So first is seeing FAMA empowers the central and the government to impose restriction. Second, the transaction in foreign exchange should be made only through an authorized person. Then third is saying payment to or receipt from any person outside India, as also other deals in foreign exchange and foreign security are restricted. Fourth is saying foreign exchange transactions, foreign security dealings, or owing or holding immovable property abroad by people living in India are restricted. So you have to answer which of the following is correct. A, B, C, or D. Question is asking not the feature of FAMA. So read the whole statement and then let me know the answer. Which of the following is not the feature of FAMA? So second is definitely correct. It should be made only through an authorized person. Third is also correct. Foreign exchange transaction, foreign security dealing, or owing or holding immovable property abroad by people living in India are also restricted. This is also true, but not the first one. First is saying FAMA empowers the central government to impose restriction. No, FAMA do not impose, or it do not empowers to impose the rules and regulations. It used to be done in the FARA. Like FARA was there, which used to empower the central government to impose restrictions on the foreign exchange. But FAMA is doing what? It is managing the foreign exchange. So it do not put any restrictions on the foreign exchange transaction. So right answer is C. That is not the feature, is only one statement. Okay, so right answer we have is a C option, that it is not the feature of FAMA. Next, the ceiling on the amount permitted to be remitted under liberalized remittance scheme was. So what was the initial amount of remittance under the liberalized remittance scheme? So right now it is $2.5 lakh in a year. But what was the old amount? What was the earlier amount? It was $25,000, that we have discussed. So right answer is definitely D. In one financial year, $25,000 were allowed under the liberalized remittance scheme. Now it is $2.5 lakh. Now, as per FAMA, the basic criteria for a person to be considered as resident in India in the stay in India during the preceding financial year, which must be for a minimum dash days. So if any person want to be called as a resident in India, how many days they have to live in India in one financial year? So in the starting of the session, I have told you that if any person wants to be called as a NRI, they have to live abroad 182 days or more than that in one financial year. Same goes with the foreign residents. If they want to be called as a resident in India, they have to stay in India 182 days in a financial year, and that's the minimum. Okay, that's the minimum. So next, remittance under Indo-Nepal remittance scheme are made under the DAS system. So I guess everybody is aware about this. This we study in the IIFS syllabus as well as PPB both. Like remittances will be done from India to Nepal. It's a one-side transfer only. It's a one-side Indo-Nepal remittance in which from India to Nepal the funds can be transferred. But from Nepal to India it cannot be used, right? And it will be allowing the Nepalese laborers who are working in India to transfer their fund to the Nepal to their family, whether or they have account or not, doesn't matter. If they have account, they can transfer the fund. If they do not have account, still they can transfer the fund. Okay, so which particular facility is it? It is National Electronic Fund Transfer, NEFT is the system by which they can transfer the fund from the India to Nepal. It is B, not D. It is National Electronic Fund Transfer. With the help of NEFT, they can do the Indo-Nepal remittance. Okay.
So the agenda for today is your KYC. You must know what is KYC. Being a banker, most of you must be aware of this term also. Know your customer. What is KYC and why do we need this particular exercise to be performed in the banking sector? First of all, you must be very aware that what type of customer is there in your bank, what kind or what type of customer is there who is presented in front of you as a customer for a particular service. He or she wants a particular service, but what you need to identify is the type of that particular customer. Whether you can accept the particular individual as the customer or not, it will highly depend on the KYC, know your customer guidelines. Along with that, KYC norms are also being taken very seriously by the RBI so that we can identify the AML activities, anti-money laundering activities, along with terror financing. So AML along with the TF, as we call the terror financing. So these are the two most important roles what KYC plays in a particular banking sector. Today, we will be talking about 3 such policies, or you can say procedures, via which you can align your bank's policy with the KYC norms as being prescribed by the RBI. We will be starting off with CAP, that is Customer Acceptance Policy. How and when and which customer you will accept, which individual you will accept as your customer. Customer identification procedures, via various mechanisms you can assure the particular bank that yes, we can keep this individual as our customer because of 1 or 2 identity proofs. Customer due diligence process, how we will ensure that all the background checks have been done, and finally we will be accepting a particular individual in our banking system. So this is the agenda for today's lecture. First of all, KYC operational norms, where is this written? Whether it is in the Banking Regulation Act or the RBI Act, or Government of India has enacted some different act, or it is specifically in your board policy. Respective banks have their own board policy. So whether it is written there only, let us just see. The RBI has laid down the certain operational norms for banks and other entities regulated by it. Fine. And under which direction? Under the Master Directions KYC, Know Your Customer 2016. And what is the specific section it is mentioned? It is mentioned in Section 35A, Banking Regulation Act 1949. The provision of these directions also apply to the branches and majority owned subsidiaries located abroad. Now some people will ask that whether it is applicable for the foreign banks which are located in India. Then again, yes, because they are located within the territory of our country. So the law of our country will be there to govern their activities. In case there is a variance in KYC AML standards prescribed by the RBI and the host country regulates, the branches or subsidiaries of the bank are required to adopt the more stringent regulation of the two. If your particular bank, supposedly SBI, is there in Frankfurt, now one question will be there in the minds of those bankers who are posted there, that whether the RBI norms will be applicable for AML KYC or the Frankfurt's norms will be there. So answer would be that more stringent one, whether it is the foreign lands law or your country's own law. Branches or the subsidiaries in India of foreign incorporated banks may adopt the more stringent regulation of the two standards prescribed by the RBI and their home country regulation. Again, vice versa, it is applicable. Now, next thing which is to be dealt is the CAP, Customer Acceptance Policy. One thing you must be very clear in your mind, that once you start PPB, once you start studying the principles and practices of banking, you will start from scratch only. You should not be very much having the background, whatever you have studied in your, you can say, banking life. But you should start from scratch, as in you must be very aware that what all topics are important for my exam, not keeping any kind of inhibitions in your mind that we have studied in our training that these are the norms, but in the PPB subject we are studying it differently. No, whatever is being written in the book, that you should follow. So customer acceptance policy, CAP, although being a banker you are there in the practical application of this particular exercise, but again these norms you must know. So CAP, the first thing which you must know is that no account is opened in anonymous or fictitious or Benami name. What is Benami name? Whether it is just a term coined for the anonymous entities or something else. If anybody who is watching this lecture wants to share his or her opinion, you can also share that. So let me just be very clear that Benami is nothing but a particular type of entity or a company where you do not know about the owner. Fine, his or her name, what is the occupation, how the background is being checked, everything, nothing you know about that person. Financial transaction or property holding where the beneficial owner, the person who actually owns the asset, is not a registered owner. That is the keyword, registered owner. The registered owner's name, all the details are not present with you. It's a transaction conducted under another person's name, often a friend or family member, to hide the actual owner. These transactions are illegal in the India under your Benami Transaction Act 1988. Now these types of information are very important for the exam. Question can be directly asked that under which act we prohibit any Benami transaction, any Benami person who is there to open an account. So the act will be Benami Transaction Prohibition Act 1988. Next thing which is important to know here is that no account is opened where appropriate customer due diligence measures cannot be applied. Now there are two types of you can say measures which can be taken. One, in the case where you do not know about that person, then some other mechanism will be followed. Second, you know about the person, but for XYZ reason the due diligence cannot be carried, like the customer or the individual which you want to accept as the customer, he or she is not willing to disclose the information. Fine. So whether it is any of those two cases, you cannot just accept the individual as your customer. No transaction or account based relationship is undertaken without following the customer due diligence procedure. That is the most important one. All of you who are working in the operational side, operations in the banking operations, they must be knowing that there are various segments while opening the account, and you have to check all these. CAP is one of them, customer acceptance policy and the customer due diligence. The report, where does this report goes from your branch? Can anybody tell me? if you are watching this in the recorded format, you can just answer in the comment section that this CGD report is generated to send where, whether it is the regional office, the zonal office, the head office, local head office, or the corporate office. Do let me know in the comment section. Fine. The circumstances in which a customer is permitted to act on the behalf of another person or the entity is clearly spelt out. Now, what do we mean by this? This is again a very important scenario where there are certain circumstances where the customer is permitted to act on the behalf of some other person. Fine. But he or she is not available in front of you while opening the account or while maintaining such type of account. You must be pretty much cautious that whether this can be accepted or not. To ensure that the identity of the customer does not match with any person or entity whose name appears in the sanction list circulated by RBI. RBI keeps on updating this sanctions list. What is this sanctions list? Nothing but the terror financing activities are being put under one particular domain, and that particular domain is just a name away. That is the sanctions list of the individual suspected of having the links to the terrorist activities. Then you have to verify the PAN obtained through the facility of issuing authority. Who is the issuing authority? Your income tax department under the ITA Act. Then to verify the digital signature of e-document given by the customer. You should be able to verify every e-sign, every e-document via the signature. Otherwise, they are not valid. To mandatory information should be obtained for your KYC purpose during onboarding or periodic updation should be specified in the KYC policy. So not only while opening the account but also maintaining that account or updating the account details, you must have the KYC details of the customer. In case of joint accounts, CGD procedure is to be carried out for all the joint account holders. Question can be asked from this particular statement that while updating the joint accounts in a particular bank, whether we need to update a single individual's KYC or the entire joint account holder. So the answer will be all the joint account holders. Next is your CIP. The next one under the KYC norms, the KYC guidelines is your CIP, Customer Identification Procedure. How you will be identifying that a particular individual will be a fruitful customer for your bank, long-term customer for your bank. It includes identifying and verifying the identity by using the reliable independent source documents, data, information. Customer identification is required to be done in the following cases. How you will ensure that the information which is available is independent? Via various documents. You have n number of documents via which you can prove that you are this particular individual. All those documents will be used under the CIP. So what all cases are there? While opening an account or establishing the account-based relationship, you must establish the CIP procedures. Undertaking the international transfer for the non-account holders. If a doubt arises about authenticity of an existing customer or adequacy or correctness of information about the customer. So whenever you feel that certain transactions are being done in the name of the particular individual and he or she is not directly linked with any kind of such transaction, then you must be very cautious, you must be very alert and look into the matter via CIPs. Selling any product including third-party products, loading, reloading of the prepaid or travel cards for value of over rupees 50,000. This question can be asked. The limit that is your 50,000. So just wait a second. Okay, so selling any product including the third party products, loading, reloading of prepaid or travel cards for the value of over rupees 50,000. What is the limit? Beyond 50,000. Less than 50,000, it is not necessary. Carrying out a transaction or series of connected transactions valuing over rupees 50,000 for a walk-in customer. So 50,000, you can say twice or thrice this particular limit will be there under the CIP process. when there is a doubt that a customer or the account based or walk-in customer, whatever you want to study, is intentionally structuring transaction below the threshold of 50,000. Now some customers will be very aware about this limit of 50,000. They will do what? They will try to surpass or bypass this particular amount via multiple transactions amounting to more than 50,000. So all these cases must be studied under the lens of CIP. Okay. Any kind of doubt you can just ask me. Any doubt, any doubt. Fine. Next is your CDD, that is your customer due diligence procedure. It includes the customer identification, also obtaining the information about the customer's location. All these services, the location, the activity, they are a part of your CDD, customer due diligence, and the purpose for which the banking services will be used. These 3 or 4 core areas will be defining your CDD process. Depending on the risk perceived from the customer, information on the nature or business activity, what kind of business activity he or she is taking up, the location of that particular individual, mode of payments, whether it is cash or not. Once you see that majority transactions are being held under cash or are being given via cash only, then you must be very cautious. Volume of the turnover. What is the turnover? What is the amount of that turnover for a particular individual? Social and financial status also you must factor in. But most importantly for a banker, mode of payment will redirect you to the CDD process. All these collected completing the profile of your customer. Now what are the documentation? Now see, this particular documentation is important for the examination. Question can be asked from here. When we talk about for the individuals, what is the documentation? First and foremost, the Aadhaar number. If any benefit or subsidy from the central government you want to receive these benefits, then you must be providing the Aadhaar number. That is a must do. You cannot skip the Aadhaar number if you want to enjoy the benefit of a particular subsidy via central government. A certified copy of any OVD containing details of the identity and your address. So any OVD, what is OVD? Can anybody tell me that whether PAN card is under the OVD section or not? We will be looking into that also, don't worry. Next, an equivalent e-document of any OVD e-document, plus you must verify the document as well. The customer signature, digital signature must be there when we are seeking the e-document. Do remember that. For certified copy, original documents are to be verified, and self-verified copy duly authenticated by the officer of the bank stating verified with original is to be obtained. Now many of you might be working in this particular profile only, wherein you are the teller, and the another person will be the authorizer of account opening. So the authorizer must put a stamp in which it is written verified with original and sign thereon. Now this verified with original is also required for any loan. Fine. If a particular loan is being sanctioned via the branch visit, then you must authorize via verified with original stamp on the KYC documents, all those documents which you have taken from the customer for the purpose of KYC. Okay, so do remember, this is also important for your daily banking plus for the exam as well. In case of NRI or the PIOs, the persons of Indian origin, copy of document certified by any of the specified authorities are listed below should be obtained in original. So these are the authorities, the authorized officials of overseas branches of the SCBs, scheduled commercial banks, that is all the branches or the branch heads of these branches which are located abroad, registered in India. Branches of overseas banks with whom Indian banks have relationship, all those tie-ups, there also this particular documentation will be taken. Notary public abroad, then court magistrate, judge, Indian Embassy, Consulate General, because they are the representatives of whom? Of our country only, where the non-resident customer is there. For e-document, again, digital verification must be there. That is the norm. That is the most important norm, I would say. Again, this is for the individuals, for the individual entities. Now, there will be some sole proprietor, some proprietor, and one person company will also be there. For our examination, what is important is the documentation of for individuals and the sole proprietors. We will see that also. Next, under the documentation only, what all must be included? One recent photograph where an equivalent e-document is not submitted. So one recent photograph, if you want to take, then you can. But nowadays in the banks, we see that under the online services, photograph is being taken by the camera in real time. Earlier, it used to be a norm, a very important norm, where the photograph you must paste it on the account opening form. But now it is not that important. But that does not mean that you should not take it. You must have it. Permanent account number or Form 60 as defined in Income Tax Rules 1962 or its equivalent e-document. Again, PAN is important when we talk about the documentation for the individuals. Such other documents, including in respect of the nature of business or financial status of the customer or equivalent e-documents thereof as may be required by the regulated entities. So, any document which is being prescribed by the regulated entities, and they cannot just freely say that I want your ration card. No, not like that. They must be backing their claims with the RBI guidelines. If they feel that yes, RBI has told us that you can seek this particular application form or this particular documentation, then they can ask the customer. What all regulated entities are there? One is your scheduled commercial banks, excluding the RRBs. Then SFB, small finance bank, payment bank, large urban cooperatives. This is very important. Normally we think that REs are not there when we talk about the urban cooperatives, but they also fall under the REs. Large non-banking financial companies, NBFCs, then credit information companies, the CICs are also there, and AIFI, that is your All India Financial Institutions. One more thing, that only the large NBFCs are there, not all. Do remember this fact as well. Large urban cooperatives as well as large SCBs. So this was the documentation for your individuals. Now what is the OVD? Fine, what do we mean by OVD? Following documents have been notified as the OVDs for your KYC purpose. Now the question which I asked you was whether PAN is included in this particular list or not. So the answer is in front of you only, because OVDs include what? Passport, DL, then Aadhaar number, voter ID, job card, and your NPR, that is National Population Register. They will be issuing one letter. That particular letter will fall under the OVD. So PAN is not there under this particular list. And who discloses this list? RBI keeps on updating. And right now, when you are seeing this video, passport is under the latest guidelines, that you can seek passport as OVD, and many customers are now willing or happily providing the passport as well. Fine. Now CDD for the sole proprietary firm. I hope that from whatever we have studied, you are making sense that all these things are important for your examination as well as your banking, the daily banking. Okay, now let's move on to the sole proprietary firm. Here the documentation will be somewhat different. Why? Because we are talking about the proprietorship. We are not just talking about the individuals. So any two of the following documents must be obtained under the KYC norms. Under which head? Under the customer due diligence. So there are various documents which you can obtain, but while opening up the account or establishing a formal relation with any sole proprietorship, you must have two of the below. Fine. Minimum two you must seek, you must have any two of the below mentioned documents. First one being the registration certificate of the firm. Then you have certificate or the license issued by the municipal authority under Shop and Establishment Act, that is SEA. sales and income tax returns. So normally in the banks we take what? Registration certificate, the RC, and your sales and income tax return, and we just maintain the relationship with the proprietorship firm. Otherwise you can take the certificate from your municipal authorities also as the official document. Then CST, VAT, GST certificate, provisional or final. Now mostly we try that we can have the final certificate, but if the customer is credible, the individual is credible, we can think of taking the provisional as well. Certificate or the registration document issued by sales tax, service tax, professional tax authorities. Then you have the IEC. Now here the importer exporter code, normally in the banks this particular document is not being taken. Why? Because most of the people are very I would say they do not want to share this particular document, but in the list it is provided. Importer exporter code issued by the proprietary concerned by the office of DGFT, or your license certificate of practice issued in the name of proprietary concern by any professional body incorporated under a statute. So law must be backing this particular authority who is issuing this code, IEC. Complete income tax return, not just the acknowledgement. No acknowledgement letter will be acknowledged while you are maintaining the relationship with the bank, in the name of your sole proprietor, where the firm's income is reflected, duly authenticated or acknowledged by the income tax authority. That is very, very important. See, this income tax return which is mentioned here also, you must have the complete income tax return, not the acknowledgement letter. Utility bills like your electricity, water, landline, telephone bills, all these things are acceptable. Any two, not one, any two. Do keep this thing in mind. So in total we have what? 1, 2, 3, 4, 5, 6, 7, 8 documents. Out of these 8, any two will do, any two. Okay, it will be revolving or hovering around these 4 topics. First of all, will be understand the different types of deposit accounts. We learn about various deposit options available, plus the operational instructions. The real life examples can be asked in the examination from this particular topic. IIBF has this habit of asking case studies in PPB exam. So directly operational instructions can be asked by the IIBF via certain case study. So to gain insight into the procedures for dealing with deposit accounts, these are the operational instructions. Next we have legal norms and interest rates. In order to understand these legal framework and interest rates applicable to the deposit accounts, we must be very serious while studying the unit number 5. Lastly, as I was telling you, the unclaimed deposits is also one of the topic, but the most important part will be the DEF account. What do we mean by DEF account? We'll be studying under the unclaimed deposits, and the objective of this unit, why it is discussing the unclaimed deposit, to familiarize yourself with handling of cooperative accounts and unclaimed deposits. Okay, so basic objective of the entire unit number 5 is this, but we will be specifically focusing on the deposit accounts, and that too only the current accounts in this particular lecture. Then we'll be shifting focus towards the nominee facility and some unclaimed deposits also. First of all, let's start our discussion with the salient features of deposit accounts. Now, as you know that the types of accounts are only 2, that is your demand and term deposits. When I talk about demand deposits, as the term suggests, that you can demand them anytime. Anytime, I don't mean that 24 hours, but any business hours, any time between the business hours of the bank. So demand deposit can be withdrawn on demand. And what types of accounts are there which are holding these demand deposits? The current account and your savings account. Next we have term deposit payable after a fixed period, a fixed time period. It can be fixed deposit or your recurring deposit, or the RDs as we know them. Fine. Next is deposit forms. Accounts can be individual, joint, proprietorship concern, companies, trusts, many accounts can be there. Many kinds of deposit accounts can be there. Then operation the operational aspects are directly linked to this particular topic of operation. The accounts are operated by single users or multiple users with specific instructions for operation. Whether you require the signature of all the participants in that particular account or only the karta will be signing. KYC compliance adherence to your know your customer policy norms is mandatory. So these are the certain salient features of deposit accounts. For our examination, what is more important? The salient features of current account and your saving accounts. So let's start with the current account. Who all are the users when we talk about the current account? So primarily it is used by the traders. In your branches also, you must be knowing that the businessmen, they prefer this type of account, that is current account. Business people, entrepreneurs, they maintain the current account. Generally, there is no interest paid on the current account balances. Generally, the operations, large number of transactions are permitted. That is the only reason why businessmen often they go towards current account rather than the savings account, because transactions are huge and they are permitted here. Account holders, they can be opened by individuals or the business firms, business companies, the trusts, associations and societies. Whether ATM facility is available for all of them? No, it is available only to the individuals. Now there are certain restrictions also. Not all the individuals or not all the parties can open current accounts. Which are those parties who are restricted for opening the current account? Minors, they cannot open. Illiterate persons, generally not permitted. Then blind persons, directly not permitted. And pardanashin women. So basically, if you cannot ensure the KYC of a particular individual, that is pardanashin woman, there you need to have two witnesses always. Blind person, again some assistance is required. Illiterate person, the signature is an issue. Minor accounts, the age factor chips in. Next we have withdrawal restrictions. No restriction on the amount to be withdrawn or the number of times withdrawal can occur. There is no restriction at all. Minimum balance, the banks, they often stipulate certain minimum balance requirement. So overall, when we talk about the current account, what is important for our examination? What IIBF can ask? You must see all the topics which you are studying with the lens that what IIBF can ask. So when we are discussing this, what are the points where IIBF can create a question? Question can be created here. ATM facility for individual account is available. Fine. It can confuse you by giving n number of options, but the correct answer will be only individuals. Restrictions in the current account, for 4 options will be given. 5th option will be all of the above, like that. So not only you should just attend the session, in your mind you should play a picture that if the examiner is to set a question from this particular slide, then what all type of questions he or she can set. Next is TOD, that is temporary overdraft. Specific provision exists in current account rules permitting ODs. So OD limit is there in current account. Temporary or irregular OD or the overdraft, they are given to good and trustworthy customers against their written request. Normally the banks refrain from this, but in the books you can say yes, it is one of the mechanism which is set up for current account holders. P notes, promissory notes, a written request for TOD and demand promissory note should be furnished by the account holder. So these are the requirements if you want the temporary overdraft in your current account. Now let's see, after the current account you will have the savings account, you will have the basic SBAs plus some term accounts will also, term deposits will be also discussed in the book. But now we will be focusing on the inoperative accounts. One type of deposit account we have seen, that is your current account. Now we will be focusing on the unclaimed deposits, because the guidelines which are there for your unclaimed deposit, the inoperative accounts chances are high that question can be asked from there. So an annual review of both the saving bank account and the current account in which there are no operations. If nobody is operating that particular account, you should know, being a banker. So annual review is there. Mark this, highly important. Question can be directly asked. The saving bank and current account should be treated as inoperative or dormant if there is no transaction over 2 years. Greater than 2 years, it is inoperative. Debit as well as credit transactions induced at the instance of customers as well as third party should be considered. Okay, so normally as a customer, what we think that you have to debit only or you have to do the credit transaction only, but what is the actual norm when we are studying this inoperative accounts mechanism? Debit as well as credit transactions induced at the instance of customers as well as the third party will be considered. Mark this, very important. Then service charges levied by the bank or interest credited by the bank should not be considered. Okay, debit credit in the form of service charges or the interest credit will not be factored in when we are specifically mentioning or specifically saying that this particular account is inoperative or not. There are instances where the customer has given a mandate for crediting the interest on TDs to saving bank account. So obviously it will not be considered while having the final definition that whether this particular XYZ account is inoperative or not. Okay, so once we have created the base that this particular type of account will be inoperative, then you have to display the list of inoperative accounts or the unclaimed deposits as well for the banks. As a general proactive measure, the banks are required to display on their respective websites the list of accounts which are inactive or inoperative for 10 years or more. Okay, not beyond 2 years but beyond 10 years. So this type of data can be asked in the examination. The publication of these particular accounts on the website will be done after how many years? So 10 years or more. It must contain only the names of the account holders, obviously, and the address. In case of the entities, the name of individual authorized to operate the account should also be indicated. So who all can operate the account? This is another, you can say, subtopic of your operational guidelines chapter, but for today we will be sticking to the inoperative account or the unclaimed deposits subtopic only. No other details should be included in the list, be it the account number or you can say the SIF number. No, nothing like that. The information on the purpose of claiming the unclaimed deposit or activating the inoperative account and the necessary forms, documents for claiming the same should also be given. So online mechanism must be established so that the customers can have a convenient method to again reoperate their accounts. Now under these unclaimed funds, one important fund is your DEF, that is Depositor Education and Awareness Fund. Recently, this year only, I think that RBI has released the data that maximum DEF funds have been inculcated within its own setup by the public sector banks. So why it is important? In 2014, RBI established the DEF fund under the provision of Banking Regulation Act 1949. Do remember this. The banks are required to transfer the credit balance in any account or any deposit in a bank remain unclaimed or inoperative for more than 10 years. Okay, this particular amount will be transferred to this DEF fund. Fund is intended to be used for the purpose of education. Educating whom? Let's see. The amount is credited to the fund within 3 months from the expiry of your 10 years. So 3 months is the time period within which the amount which is held in that particular bank account will be transferred to the DEF fund. utilized for promotion of depositors' interest as specified by RBI from time to time. The depositor can claim the funds deposited or any other unclaimed amount to operate the account even after the amount has been transferred to the fund. The bank will pay the amount to the depositor or the claimant and claim the refund of such amount from the fund which is being held by RBI. Okay, now next important point is the nomination facility. So we have picked, or you can say hand-picked, only those important topics which will act as the first instance for all of you who are starting your unit number 5. So all the topics are being covered, but with an overview of that particular topic, not in-depth analysis is being made. For that, you can always join our sessions which are held on the learning portal of Adda 247 or the application that is Adda 247 again, and thereon you can join those sessions while by enrolling in various courses. Right now we are conducting the PPB classes in our success batch which is live. Today we had one orientation class which is live on YouTube also. If you have not seen that video, you can gauge the level of interaction we have in the actual classes by watching that particular session and make up your mind that why you should join our classes, the live classes, the paid classes, I would say. Fine. So nomination facility, the Banking Regulation Act 1949, it was amended by section 37 of the Banking Law Amendment Act 1983 by introducing new section 45 ZA to ZF. Now these sections are highly important. Question has already been asked in the previous cycles, okay, and again IIBF can ask certain questions. Now this particular section was added for nomination facilities to the bank's customers in respect of the deposit account, safe deposit and your safe vault lockers. The relevant rules framed by the central government with reference to the above sections are termed as Banking Companies Nomination Rules 1985, which will determine the nomination facility in the banks. So there are three terms which you must remember. One, Banking Regulation Act 1949, it will ultimately lead you to the nomination facility, but how it was amended? It was amended by the section 37 of your Banking Laws Amendment Act of 1983. That is the second important thing. Third important point is the introduction of the sections 45 ZA to ZF. So in the nomination facility, there are certain forms. Okay. So three forms are of interest for our examination. So form DA1, what does it pertains to? It pertains for the nomination by depositors. So depositors, if they want to nominate somebody, form DA1 is used. Then DA2 for the cancellation of the nominators or of the nominations by the depositors. Then form DA3 for variation of the said nomination by the depositor. So one, you initiate the nomination process, DA1. You terminate or cancel that process, DA2. DA3 for certain modifications. Fine. Okay. So in the nomination facility, there are certain salient features in front of you. One by one, let's discuss them. So the nominee shall, on the death of sole depositor or all the depositors, entitled to receive the money in the account of the depositor. That is so obvious that once the death of sole depositor is there, nominee will be having the amount in his or her account. Nominations are not permitted in respect to the depositors held in any representative capacity, such as director, secretary, partner, karta of HUF. So all these designations, they cannot claim the funds and say that we are the nominees. No, because it is not permitted. If any customer does not wish to make nomination for any personal reason, an endorsement may be made in the nomination form. If there is no nominee added, then the process will start from scratch only. Nomination can be given only in the favor of an individual and not a firm. Do remember this, very, very important. There are n number of cases lying in the courts. Only one individual can be made a nominee for the particular deposit account, then separate nomination in respect of each deposit account must be made. So if there are separate deposit accounts of one particular individual or under one CIF, then for every deposit account you must have separate nominations. Now, once you know the type of deposit accounts, you know that what do we mean by the unclaimed funds, you know about the nomination facility. Now let's move on to the missing customer. If a particular individual is missing, then what to do? The FIR and the non-traceable report issued by the police authorities along with the letter of indemnity must be forwarded to the respective banks. And the claims, the unsettled claims will be done in respect of missing person. It will be governed by the provision of section 107, 108 of IEA, India's, or you can Indian Evidence Act 1872, dealing with the presumption of continuance and presumption of death respectively. Fine. So continuance and death, if we talk about, so 107 talks about the continuance and 108 will be talking about the presumption that the person has died. Death can be presumed only after the lapse of 7 years. Mark this, very important. In the missing customer, if you want to say that a particular customer is missing and now he or she has died, that particular claim you can make only after the 7 years have lapsed from the date of reported missing. That is this particular report. Nominee or the legal heirs have to raise an express presumption of death of the depositor before a competent court. So nominee or the legal heirs, if they want to have those funds which are there in the presumed dead customer, then they must go to the competent court and make their claims. Starting off with who can open these accounts. Okay, we will be indulging into the discussion from who can open these accounts. That is the simple eligibility, who all are eligible for these accounts. Fine. NRE account you can have for the NRIs, for the persons of Indian origin, or the OCIs. Individuals, entities of Bangladesh, Pakistan nationality ownership require prior approval of RBI. So if you are an entity, or for that matter an individual from Bangladesh, or for that matter in Pakistan, then you require the approval of RBI. That you must know. For NRO account, any person resident outside Indian land, or for that matter the country, other than the person resident in Nepal and Bhutan. So that is one first norm. Individuals or entities of Bangladesh, Pakistan nationality or ownership, as well as erstwhile OCBs, they require a prior approval from RBI. So if the individuals or the entities are having certain connection with the Bangladesh or Pakistan, be it the citizenship for that matter, or the occupation is going on from those countries, then definitely RBI's approval is required. Similar pattern for FCNR account is followed as of the NRE account. So same eligibility is there. Nothing has changed for FCNR. When we talk about the deposit, what kind of deposit is there in NRE account? It is foreign currency. For your NRO, it will be Indian currency, and the FCNR account will be having the US dollar, then you have the pound, then Australian dollar, SGD, and so on. Japanese yen is also there. So a gamut of various, you can say, currencies are there when we talk about the FCNR account. Next, what about the withdrawals, or you can say from the Indian land to the foreign land? What kind of withdrawal can be made? So Indian rupee is the you can say withdrawal denomination for the NRE and NRO account. For FCNR you will have the foreign currency. Simple. Why? Because directly the basket of currency is there in the FCNR account. Next, the taxation in India. When we talk about the NRE account, so it is not taxable in the country. Interest income is taxable, which is there in the NRO account. And when we talk about the FCNR account, again, not at all taxable in your country. So whatever denominations are there, they are free from tax. Repatriability. So whether you can repatriate a particular sum of the money or not from the NRE account. So deposits and interest earned are fully repatriable. When we talk about NRO account, up to 1 million USD per financial year. So there is a cap for the repatriability of the accounts when we talk about the NRO account. What is that limit? 1 million US dollar. For your FCNR account, the deposits and the interest earned on them are fully repatriable. So you can use directly, fine. Exchange rate risk. When we talk about the foreign exchange risk, so due to the currency fluctuations, that particular risk is there. When we talk about the NRO account, there is no foreign exchange risk as such, and similar thing happens for your FCNR account. But when we talk about the joint account, whether NRE account holders can have this facility or not, so they can use this facility of joint account for all the three, be it the NRE account, for the NRO account, or for that matter your FCNR account. Next, when we talk about the type of account, so what kind of accounts or what types of accounts can be opened under the NRE category. So savings account, you have current account, term deposit, as well as your RD, that is recurring deposit. Same pattern is followed for the NRO accounts. And when we talk about the FCNR account, only term accounts will term deposits will be there. So whenever you are studying the different types of accounts for the foreign entities, or for that matter, if you want to learn the operational guidelines, you must start from the difference. So various parameters are there via which we have studied these three accounts, and automatically the questions are coming in the examination from these difference points only. Okay, nobody will be asking you beyond the difference points. Max to max, what can happen? One case study can be there based on various you can say types of accounts. Okay. So permitted accounts in India for NRIs and person with Indian origin. You have the NRE, that is non-resident external rupee account scheme. So NRE account. Then you have foreign currency non-resident account bank scheme, FCNR. Lastly, non-resident ordinary account scheme, that is NRO. The difference we have just seen. When we talk about a further elaboration in your non-resident external or the NRE account, you will find the same things which we have just discussed, that the types of accounts will be saving bank, current account, or for that matter RD, or you can say term deposit. Joint account for the two NRI, one NRI and one RI FNS. The resident relative can operate only as a power of attorney holder. So when we talk about the joint account, so two NRIs can have one account, and when we talk about the other category, it will be the NRI will be clubbed with RI, F and S. Operating mode, the residents are allowed to have the transaction through the power of attorney. We can say the withdrawals, remittance, and you can say the investment also, they are permitted via POA. The resident POA holder is not allowed to do some activities which are, you cannot open the NRE account. Repatriate, the repatriability of this account is restricted to the holder only, not the POA. Make the payment as gift to the resident, that also the power of attorney holder cannot do. Funds, if you want to transfer to another NRE account, again the power of attorney holder is having the prohibition on that particular activity. So transfer of funds is also not permissible. Fine. When we talk about the permitted transaction in the saving or the current account, so all those important you can say parameters are being discussed here. Most importantly, what kind of remittances? So remittances to India in any permitted currency can be done. The interest payments, your current income in India, transfer from any other NRE or FCNR account can also be done. But when we talk about the refund, this is a common question in the mind of bankers, that whether refund of application or the earnest money purchase consideration made by the house building agencies or sellers can be done or not. Yes, this refund is applicable, or it is fully permitted in the case of credits. What about the debits, local disbursements? Then you have the remittance outside India. Okay. Along with that, the transfer to NRE or FCNR account of any person eligible to maintain such account. Now there are certain schemes like fixed deposit tenor. Fixed deposit is there. What about the tenor here? The minimum tenor is 1 year. When we talk about the interest on deposit, so the rate of interest for the saving bank account will be the domestic rate, and when we talk about the term deposit, it will differ as per the tenor. Okay. So I hope that NRE account, along with that the basics of other two accounts, are clear to you till now. Next, when we talk about the tax exemption, so NRE deposits are exempt from wealth or income tax. Payment on death of the depositor, the primary holder or the depositor, you can say, on the demise of an account holder, the balances can be transferred to a non-resident nominee. So nominee must be there in any type of account, be it your individual account or the entity. Remittance by a resident nominee outside India for meeting any liability of the deceased or similar other purpose requires RBI approval. So these kind of activities will require the approval of RBI. You can not just assume that yes, you are permitted to do that. You must have the approval by the regulator. Loans against the NRE deposits. The loans can be granted in India by the AD against the NRE deposits, but lien is not allowed on NRE saving bank account. Okay, so lien is not allowed, that you must remember. But yes, the aggregators can have the loans distributed to the NRE deposits. Prohibitions on the use, they cannot be used for re-lending or agricultural or plantation activities, or for that matter investment in real business, real estate business. Why it is prohibited in real estate sector? Reason is simple: in order to prevent the money laundering activities. So basics first, the cash management, it refers to what? It refers to the collection, concentration and disbursement. So you will be collecting cash from the cash hubs, as we call them, or for that matter the chest branches. So collecting from there, but ultimately the first disbursal of the cash will be from the regulator, that is the RBI. Fine, RBI, then you will collect it, concentrate it, whatever amount you want, and keep in the bank, in the bank's branch. After that, you will be disbursing that particular cash. So management refers to all these steps. Only then you will say that we are talking about the management of the cash. It encompasses the level of liquidity, management of cash balance, and short-term investment strategies as well. So whenever cash is flowing across the market, across the financial sector, it involves certain inhibitions from the financial intermediaries. Certain regulations will be stipulated for that particular cash flow by the regulator, and certain profit motive will be there from the various institutions. So everything is being clubbed together and formed as the aim towards managing the cash. Next, when we move on to the fundamental objective, it is optimization of this liquidity through improved flow of funds. So cash flow is happening, and the regulator will be regulating this particular flow of funds while sitting in the offices, but it has already created one mechanism via which these funds will be regulated, or these funds must flow. Only when they are following those rules, regulations, it will be allowed by the regulator to do so. Otherwise, you won't be able to transact any kind of business which involves cash. Objective of cash management system is to improve the revenue, maximize the profit, minimize the cost, and establish efficient management system to assist and accelerate the growth. Growth acceleration of what? Growth acceleration of the GDP. Fine. Whenever we talk about cash, it is an instrument via which you can create various assets. Ultimately, so it's a capital. Na? You have the capital in the form of rupee. If you have it in the form of cash also, you will be doing what? You will be investing that money. Once you invest that money, then only you will reap the benefit. Otherwise, so if you are talking about money itself, you have your salary on a stipulated time period, on a stipulated day of every month. You are just spending that cash. You are not saving, you are not investing that. So long term benefit you cannot reap of the cash, or for that matter money as well. Next, when we talk about the development in the cash management, so the cash management has changed significantly over a few decades with the various reasons, but majorly two reasons are stipulated by the banking institutions. First, there has been added upward trend in the interest rates that increase the opportunity cost of holding cash. You want to hold the cash, why? In the bank accounts, because you will be earning certain interests. But right now, when we talk about the Indian markets, they are highly volatile. Fine. Nobody wants to keep the cash in the bank account because the awareness, the level of awareness is rising as compared to the previous decade when it comes to the investment opportunities. Second, the technological developments, particularly computerized electronic fund transfer mechanism. So cash management overall, now you do not need not to manage the cash per se, you have to manage the funds. That will be a better way to put it out. So the companies in such as IBM, General Motors, and you can say HP, Hewlett Packard, all, even the manufacturing plants are having various motives to hold the cash. The big companies, why we are telling you these names, because they refer to the big companies, and most of the payments are made from the cities where manufacturing occurs, or else from the head office. What is the reason why we are discussing this? So that you can understand the cash flow. Somebody sitting in USA, fine, they are remitting certain amount in, let's say, not Russia, USA won't remit the amount to Russia, but somewhere in the European nation, fine, European or Western Asia, fine. So this particular mechanism is ensured via the amount which a particular party wants. This party won't be able to have a particular profit for which it is transacting with this party if it is not holding any cash. So cash, or the value, if it is zero, if it has been nullified by various activities, you won't be able to maintain the profit. And when the similar system is being replicated by the big companies here, it applies to them as well. So in short, when you talk about the development in the cash management, it must include the inflow as well as the outflow of the money, and profit maximization must be happening via this particular activity. Next, when we talk about the cash management system, let's quickly see the types of these services. Cash collection service is there, direct credit by the fund transfer is also there. Let's see the cash collection service. Banks have implemented various customized cash pickup solutions to meet the specific requirements of the customers, and it will do what? Why it is being preferred? Minimization of the operational risk. You just want the cash, here you go, here is the amount you wanted. Reduction in the cost. Security is there. Earlier it used to be secure, right now so you don't know what will happen. Increased efficiency is also there. You need not to wait for your payment, you just can have it right now, right away. Direct credit by the fund transfer. This offers management of payables in respect of supply chain management, overseas remittances, salary payments, and statutory payments. Mostly when we talk about the exact benefit, who has the exact benefit or the most beneficial, you can say, owner or the entity for the direct cash transfer or the direct remittance is the international party. Nobody can ever imagine the fact that the payment has been made digitally in 1900s. In 1900s, 1910s, nobody was even thinking of that particular mechanism, that cash can be the source of funds and you can have it right away within a few minutes. But now when we talk about the overseas remittance, they can happen within a blink of eye. Next we have check or demand draft, these types of arrangements. So when you talk about the DDs, payable at par, checks issued by the CMS, the clients are by branches across the country on presentation for the payment. So cash not only in the form of physical money, not only in the form of your digital transactions, but from paper also. Fine. Check is what? It is a paper currency. So DD, check, all these services are being ensured via various instruments. NEFT payment, electronic channel, again digitalization is there for the bulk disbursements as well. Not only for the individual but the bulk disbursements, you can use these electronic channels. Next, when we talk about some other aspects of your cash management system, you have the check collection system also. Somebody has given you the check, now you want to clear that check. So local and upcountry clearing solutions are also being inculcated over a period of time. NACH payment facility for periodic dispersal. You do not want to have any kind of worry when it comes to the monthly payments. From here you will be having the periodical disbursements or the receipts of various amount, whatever is being ensured or is written in a particular contract. Auto sweeping facility, pooling of funds at desired locations. So various norms are there when we talk about in the banking system. Supposingly somebody is there having a particular saving bank account and wants to inculcate a particular habit of saving. So they can give you an intent that after rupees 50,000, if more is being credited in my account, then kindly make an auto sweep and give that particular amount as a FD, as a fixed deposit. First of all, you must know that the NIA, it deals with what? So Negotiable Instrument Act 1881, it deals with three kind of instruments. That is very important to know, and along with that, what is the further bifurcation that we will be seeing in this particular lecture. So it deals with the P notes, that is promissory notes, then bills of exchange. The process flow from bills of exchange is very important. Mark this, quite important, because direct question has already been asked, and when we talk about this particular examination for November 2025, we can expect one question directly from bills of exchange, plus the checks called the negotiable instrument. So check, P note along with your bills of exchange form the negotiable instruments. Starting off with check, in the CTS chapter, the previous chapters, we have seen that what is truncation. When you talk about the English language meaning of truncation, it is to reduce certain process flow, and specifically for check, the electronic payments are being enabled via the CTS system. That is the brief background of your truncated check or check truncation system. So check, everybody knows, being a banker, you guys deal in checks mostly on daily basis. So check is a bill of exchange drawn on specified banker and not expressed to be payable otherwise than on demand. Definitely it is a demand note, I would say, and it includes the electronic image of truncated check and the check in the electronic form mentioned specifically in section 6 of your NIA 1881. Fine. For all of you who are having any kind of doubt, you can just ask me in the live chat, and if you are watching this in a recorded format, do let me know your doubts in the comment section. Next, what we need to know about the check in electronic form. So it is drawn in electronic form by using any computer resource and signed in secure system with digital signature. When you talk about specific checks in used in net banking, mostly by the CC limit owners in the revolving fund, they have the access to a particular check which is digitally signed, and they can make payment using those checks as well. Specifically, when I talk about the CTS system, it is a particular system for a branch wherein you will be mapping all those physical checks into the electronic form only in the gray scale. That is the important point which we must know. Truncated check is truncated during the course of a clearing cycle immediately on generation of the electronic image. Why it is done? It is beneficial for both the parties. Let's just face it. Firstly, for the bank, if you are using these images, they are helpful that yes, in order to establish that yes, we have done or completed the transaction from our end. For the customer, why it is beneficial? It is easier that way, that the transaction time has been reduced drastically as compared to earlier. Next, when we talk about the promissory note, another negotiable instrument, it is an instrument in writing, fine, not being a bank note or currency note, containing some undertaking, some type of undertaking will be there on this type of note. Basically, you can say that it is a note. Initially, so it is a note. Promissory note, it becomes afterwards. All the documentation has been done. So, containing an unconditional undertaking signed by the maker who has made this undertaking to pay a certain sum of money only to or to the order of a certain person, whosoever is the beneficiary. It will be signed by the person who is paying, and the person's name to whom it has been redirected will also be mentioned here, or to the bearer of the instrument, mentioned in section 4 of the NIA again. So NIA 1881, a very bulky act, I would say. If you have time after your banking hours, you can just download the act from your official website also, that is whatever bank you are working in. From there you can see a particular website is dedicated to all the important circulars. There definitely NIA Act will be there. So I promise to pay B or order rupees 500, like that you will find a promissory note. I acknowledge myself to be indebted to B in rupees 1000 to be paid on demand for the value received. Whatever language is there, it will be known as promissory note. Next, when we talk about bill of exchange, what is the basic definition? Let's see that first, and then we'll be talking at length about the bill of exchange. It is an instrument in writing containing an unconditional order signed by the maker directing to a certain person to pay a certain sum of money, or to the order of the person to the bearer of the instrument. Same, exactly the same language of P note. But what is the difference here? In bills of exchange, some parties, specific parties will be involved, and the mechanism is different. Let's see. So there are parties: drawer, drawee and payee. I hope that from the name itself you are able to gauge that drawer will be the person who creates the bill, fine, who is creating. So the creator is the drawer. Drawee, on whom the bill is drawn, usually the debtor. Okay, so you are providing some amount to this particular drawee. Then we have payee, the person or entity who receives the payment. So when we talk about bills of exchange, most important thing to know is that your drawer is a bank. Okay, I hope that it is visible to everyone. Okay, so bill of exchange transaction, it involves up to 3 parties. First of all, you will have a drawee, an individual, you have a drawer, that is a bank, and a payee, again one individual. So mostly the foreign transactions which are happening via the bill of exchange, they will involve some importer trader. So international trade, the drawee is the importer or the buyer. For the payee, when we talk about under the international trade, he or she will be the seller, or for that matter the exporter. Bank being the drawer in the international trade, the drawer is usually a confirming bank. In LCs also you might have seen some part of this type of setup, not exactly the same, but yes, some you can say steps are similar in LC as well. So the drawee is the party that pays the sum, fine, they are paying this sum specified in the bill of exchange. The payee is the one who receives the sum, so that is the debtor. Here this is the creditor. The drawer is the party that obliges the drawee to pay the payee. Basically, the financial institution which is intermediary between the drawee and the payee, they will be very essential in order to ascertain this transaction for the international trade. Okay, so I hope the mechanism is clear. The drawee, then drawer, and then we have payee. When I talk about the specifics of drawee, drawer, or the holder in due course, all these terms are again important. So drawee we have seen. Holder, the holder of P note, basically bill of exchange or check means any person that is entitled in his own name to the possession and to receive or recover the amount. So whosoever is receiving the amount, the holder. Holder in due course, it is the holder as payee or the endorsee or the bearer. In case of check payable to the bearer, who for consideration became the possessor of the P note, the bill of exchange or the check, and there is no sufficient cause to believe any defect exists in the title of the person from whom he derived his title. So in due course, the final bearer of that particular check, in case of checks, will be known as the holder in due course. Negotiation, a P note, bill of exchange, check transfer to any person to make the holder thereof is said to be negotiated. So negotiation, if it is happening in any of these negotiable instruments, it is known as negotiation. Next we have payment of check. So very simple aspects are there whenever we are talking about payment of check, or for that matter the mechanism which is involved in bill of exchange. Mostly so mostly we will find that the negotiable instruments have a common format. Like for check, we know that this type of reference will be there, date will be there, amount is here, here we have the signature, name of the bank, the particular branch, and here we have MICR. So all these are not that important for the exam, but yes, certain important definitions we must know. So the branch on which it is drawn, the check, with CBS, banks are providing anywhere banking. So a check can be presented for payment at any branch of the bank. No doubt there are certain limits to this, but yes, any branch they can present. Date must be mentioned along with the payee. A check may be made payable to single payee or joint payees, or you can say alternative payees as well. When I talk about the order check or bearer check, the bearer will hold that particular amount whatever is mentioned in the check. Amount stated in the word and figure. So specifically you must remember the section. So section 18, it says that if the amounts in the words and figures differ, amount in the word shall be paid. So figures versus words, words will be preferred. But in practice, these are returned unpaid with the reason amount in words and figures differ. There is a mismatch and penalty will be also levied in certain cases. So in effect, when we talk about the practical banking, the things are done differently, but via a particular negotiable instrument act section, you will say that it will be paid regarding the amount in words. If amount in words is supposingly 20,000, fine, it is written 20,000, and in the figure it is written like this, 2000. So 20,000 will be paid. That is mentioned in section 18. But normally, being a banker, you can also acknowledge this fact. This type of check is unpaid and returned. Okay. Next, when I talk about if the check is all having certain alteration, it is mutilated. So any alteration, any material alteration of negotiable instrument renders it void. Any material alteration should be authenticated under the full signature of the drawer. So whosoever is signing the check again has to sign along with acknowledgement of the alteration. Mutilation, if a check is accidentally torn by the drawer, he may confirm the mutilation and the check can be paid if otherwise in order. It can be paid definitely, but again in practice, in practical banking, we try to avoid such circumstances. If accidentally torn by the collecting banker, he should put an endorsement as mutilation granted on the back of your check. Okay, so mutilation guaranteed, that is from our end it has happened, and we acknowledge our mistake. So mostly the mutilation is taken very seriously in the banks. If you are a new banker, do have this thing in mind while collecting any kind of check, that mutilation should not be done. Otherwise, some bankers are reprimanded because of that also. Fine. Signature of the drawer. So when we talk about the signature specifically, what happens here? Signature of drawer is an authority given by the account holder to debit his account with the amount of check, whatever is written there. What is important under this signature is this: Section 89 of NI Act provides protection to the paying banker for the forged endorsement, but not if the drawer's signature is forged. So Section 89 specifically, it will be providing the protection to the paying banker. Okay, if the endorsement is forged, some falsified endorsement is there. But if the drawer's signature is forged, Section 89 cannot help you. Stop payment instruction. So if a particular party is not having the funds, or for that matter, mistakenly the check has been produced, now they want to stop that particular payment, what can be done? Before paying a check, the bank should check for any stop payment instruction from the drawer returned with the reason payment countermanded by the drawer itself. So the check will be returned in case of stop payment instruction has been instated. For joint accounts, stop payment instruction can be given by any of the joint account holder. For partnership account, cancellation of stop payment may be given by all the partners. So partnership accounts, that's why people think that let's not indulge in partnership accounts, because everything is a liability on all the partners. Limited companies, cancellation of stop payment instruction must be given by all the authorized signatories. We have seen in the previous chapters, there are what? 2 authorized signatories. They will be acknowledging, not all, fine, as there was in partnership accounts. Other aspects, what all other aspects are there while making a payment via check? At the time of making payment, the bank should also verify that the balance in the account is sufficient. Account balance, important. No garnish order. The court order is not there pending for that particular account, or recovery has to be made from that account. Income tax attachment is there, the attachment order by the income tax department. Again, recovery will be done. Prohibiting the payment has been received. No notice of death, insolvency or insanity of the drawer has been received. So all those important points: no garnish order, no income tax attachment order, no insolvency, bankruptcy or insanity against the particular drawer must be there, and you must check the balance. It must have the sufficient balance. Simple things again while payment of a check is being done. Okay, now payment in due course. Right now you are not paying the amount. In due course it will be settled. So paying bank gets the protection. Due course is defined under the section 10 of the NIA Act. It means payment in accordance with the apparent tenor of the instrument in good faith, without the negligence to any person in possession thereof, under circumstances which do not afford a reasonable ground for believing that he is not entitled to receive the payment of the amount therein mentioned. So basically a particular protection has been provided to the paying bank if the bank has been held accountable for a XYZ transaction amount. So it is defined under which section? Section 10. Then liability of the paying bank defined under section 31. Here you will find that sufficient and adequate funds are available, and if the sufficient funds are not available, then what? they are not properly applicable when the payment of check is stopped. So you have stopped the payment of a particular check, funds are still available, liability of the paying bank. When the drawer is dead and the intimation has been received, still you have provided that yes, you can go through, or you can say go ahead with the particular amount which is mentioned in the check, liability again. Funds are attached under the garnish account, income tax office, or attachment, all these which we have discussed in the previous slide, that you cannot go ahead with such things, otherwise you will face a liability. When I talk about the basics, I hope that most of you might be knowing it, but let's revisit the basic. Whenever a particular customer, supposingly Mr. A is there, and he or she is trying to remit certain funds via his or her bank, then they will be presenting one check in front of their own bank, and the check is presented in a particular, you can say, banking institution. Let's suppose it is your Punjab National Bank. Let's just suppose this is the scenario. Fine, PNB is the bank where it has been presented. Now the funds are to be transferred to Mrs. B, okay, in the Canara Bank. The process will be initiated by which bank? By the PNB, and it will be transmitting or transacting the particular amount to the Canara Bank. The beneficiary will be Mrs. B from the Canara Bank. The amount will be debited from the account of Mr. A. Simple things. Here you can say that the banks may be the similar ones, like from PNB you are transferring the amount to another PNB branch, but in that particular case check is mostly not required if the amount is a limited one. When we talk about interbank transfer, then the debit must be done via a particular negotiable instrument, mostly that is check. Okay, so these are the basics. We will be focusing on the specifics also, like which section of NIA will be governing such types of responsibility of a bank. So when I talk about the important points, duty of a particular bank to honor his customer's mandate is laid down in the section 31. So do remember, the duties of a particular financial institution, that is bank, is being mentioned in section 31 of your Negotiable Instrument Act. When we talk about what are the specifics, what are the bare minimum things which a particular customer must ensure, they must ensure sufficient funds in their particular bank account. Along with that, they must be properly available. What does properly available means? Supposingly a particular customer is having a loan account with the same bank and EMI is due. Okay, so one SI charge will be created if the amount has not been debited yet, and if the similar amount of fund is to be transferred via a check, then we will not treat as a properly available fund. So irrespective of whatever the negotiable instrument you are using, you must have the funds properly available with you. When duly required to do so, it means that the check must be properly drawn and signed by the drawer. So sign is also one of the aspect which is taken very seriously in the banking parlance. And when we talk about the previous unit, in the last lecture only we have seen what all is required while remitting the funds via check. So sign is also there, then amount in words as well as your amount in the digit format. Okay, if there is certain confusion between digit format and the words, that is the amount is mismatching between these two, then according to the Negotiable Instrument Act, words will be considered, but normally the banks return such type of checks. So as we move further from today only, you will see some integration is required from previous units as well. Like the previous unit involved some specifics about check, we will be implementing those in this particular video also. Some other important points when we talk about the compensate, to compensate the drawer, in case the banker refuses the payment wrongfully, then he is liable only to the drawer of the check and not to the endorsee or the holder. So there are certain exceptions to this also. except when the bank is wound up, in which case the holder becomes a creditor entitled. So when we talk about the funds, if wrongly remitted by a bank, then liability lies on that particular bank only. We have seen that in the previous lecture also. To make a claim, when we talk about if the check is paid disregarding the crossing, the true owner can hold the bank liable. So if the check has been cancelled due to any reason and the customer has informed the bank regarding the same, still the amount has been debited, you can be held liable by the customer. Next, when we talk about the default, so loss or damage caused by a default. A banker is liable to draw for any loss or damage due to the wrongful dishonor of the customer's check. Now, such type of errors, are they common in the banking industry? Answer is yes. Mostly the accounts involving CC limits, the revolving funds, their chances of these types of mistakes are very, very huge. And when we talk about the CC limit, there the funds are revolving, like today at 2 p.m. some fund will be credited in this particular account, CC account, and within 10 or 15 minutes only, so 2:15 p.m. the fund will be revolved and debited towards another party. In such cases, what will happen, even if you have this timeline between 2 p.m. to 2:15 p.m. that your funds are there in the particular bank, let's suppose 50,000 is there, and one customer holding this CC limit, they have produced a check of rupees 25,000 to be debited from this account. So as soon as the funds are coming in, within 15 minutes, they are being debited and credit has been made to another party. So although the funds were there in today's date only, but you cannot debit it in real time. You cannot just say that, okay, within 15 minutes, I'll be debiting the amount. And what will happen after 2:15, supposing you debited this check of 25,000, it will be what? A negative balance in the CC limit. Like that, things can happen. But mostly when we talk about the ground reality, most of the customers, they are very understanding in this part that okay, if the revolving fund is involved, then definitely they will be informing the bank that this amount has been credited, so that time and again bank need not to check it that whether the payment has been made or not. Fine. And that also comes under the customer banker relationship. I hope that you have revised the initial units where customer banker relationship, specifically the trustee beneficiary relationship, is the most important one in case of CC limit. Next is liability of paying banker when customer's signature on the check is forged. We have seen in the last lecture that if the signature are forged, chances are there that the re-endorsement will be done by the particular owner of that account, and they can sign again and acknowledge that yes, it has been done by mistake. Otherwise, the check will be you can say returned to the particular bank. Mostly these things happen, and when we talk about the old age owners, they have various inhibitions that their sign or their signature will be forged. That's why they also sometimes do not know that what kind of sign they have made. So as a banker, it's our responsibility to be very serious while handling such cases. Otherwise, the liability lies on you. When the customer signature on the check is forged, there is no mandate to the bank to pay. So you are not liable until and unless you have paid the amount. In a joint account, if one of the signatures is forged, then there is no mandate and the banker cannot make the payment. If there is no mandate, the customer has not acknowledged the mistake, you need not to pay the amount. Okay, so in case you have any kind of doubt, you can just ask me in the comment section also. Fine. Next, the payment to be in due course for the bank to seek protection. Here there are certain judgments of Supreme Court. Various high courts have also made judgment pertaining to this type of issue, and for our examination, the case study type of question can be asked from this particular topic. So the Supreme Court in Bank of Bihar versus Mahabir Lal, 1964 is the case listing in Supreme Court, held that banker can seek protection under Section 85 only where payment has been made to the holder, his servant or agent. That is, payment must be made in due course. The entitled person must have received that particular payment, and the customer's account which has been debited, he or she acknowledges this fact. Then only you are free to go. Otherwise, the liability will be lying on you. The expression payment in due course has been defined in Section 10 of the NIA. So NIA automatically becomes the sole act which you need to read also the important sections of NIA 1881 if you are very serious about your learning in the cash department, cash and check department, all the negotiable instruments department, I would say. To mean payment in accordance with the apparent tenor of the instrument in good faith and without negligence to any person in possession thereof. So if there is a negligence, but obvious, your liability will be held. Otherwise, what will happen? The particular bank can hold the customer liable for their own mistakes under circumstances which do not afford reasonable ground for believing that he is not entitled to receive the payment of the amount therein mentioned. So the third party where the amount will be credited, they can also be questioned for any false information provided, if any. Next, when we talk about Section 89, it gives protection to the paying bank of a check which has been materially altered. In the last chapter, you must have seen there are two scenarios, one mutilated notes and one soiled note. Something you must have seen in the previous chapters. Mutilated notes per se, they are what? You cannot use them. Soiled, they are old, fairly old. But when we talk about the checks, materially altered means certain description has been changed, and mostly the connotation is negative one here, nothing positive about it, but does not appear to have been altered if payment is made according to the apparent tenor at the time of payment and otherwise in due course. So Section 89 will give you protection only when the particular customer has received the payment in due course. Section 10 defines the payment in due course to mean the payment in accordance with the apparent tenor of the instrument in good faith without any negligence. So these sections, question can be asked directly from them. In the examination, we have seen that NIA Act, mostly in the RBWM also, plus in PPB also, questions have been asked in the previous cycles. Section 31, it obliges the drawee bank having sufficient funds of drawer in its hands properly applicable to the payment of such check to be made when duly required to do so. So when we talk about Section 37, it is for the drawee bank. An obligation has been stated on the drawee bank while holding a particular check for whatever transaction is there. So these sections, be it 89, 10 or 31, mark them very important. Question can be asked in the examination. Fine. So this was it for your entire unit. This unit is a very small unit, and if you know all these important sections, you are good to go. There is nothing more which is to be done beyond these particular sections. Fine. Otherwise, when we talk about the case studies, they are very general, not like in module B or for that matter like module D, which have specific case studies. Here, if the case study is being asked, it is fairly general in nature. First of all, when we talk about the basics, that is the DD and the banker's check, here whenever most of you will be facing the customers, and mostly the customers have a specific query regarding the demand draft, it creates some kind of disintegration from the normal cash services which we normally tend to do in the banking sector. But why these are important, the demand draft or for that matter banker's check? So that the customer faces certain convenience and certain authenticated payments will be done using these modes. So that is why they are very, very important. When we talk about the definitions of these, so bank draft is a negotiable instrument and an order drawn by one branch of a bank instructing another branch. So basically two branches will be there as is the case with most of the transactions. Within the branch, the transactions can happen in the form of term deposits, but when we talk about the inter-branch relationships, there are many. To pay a certain sum of money to the order of a certain person. So basically, in the older times when we used to say that money order has arrived, it pertained to one particular person. Similar is the case with your negotiable instruments, specifically the demand draft. So it cannot be payable to the bearer, as it would amount to a currency note and will be violation of section 31 of the RBI Act. This section is very important. Question can be directly asked in the exam, that which section prohibits this type of transaction. So section 31 of the RBI Act 1934. When I talk about the banker's check, when they are generally used, so at the request of the client, definitely the client wants the bank to perform a particular ancillary service in the form of banker's check. Payment of the balance amount of the deceased account to its claimant or the legal heirs. A specific mention has been there when we talk about the case of deceased person. From whatsoever branch you learn this particular fact, it is a well-known practice that mostly the claims are settled via the banker's check whenever the legal heirs or the claimants are involved in the deceased person's account. Payment of the bills on realization received or presented for payment by local banks other than the branches of your own bank. So when we talk about different branches, they have a specific you can say function for their own customers. But when we are moving towards the banker's check concept, you will find the branch role has expanded, and this expansion leads to the transaction to the another branch as well in case of banker's check only. Deferred payment, the DPGs will be paid from banker's check. Then payment to various contractors, service contracts, various purchases made by the bank. So bank is also buying certain things because obviously it is also a customer. Bank is also a customer in various transactions. So all those transactions where bank is a customer, banker's check comes into play. Then we have payment of statutory dues like electricity bills. For the bulk payment, this particular banker's check will be allowed. All other local payments to be made by the check other than the cash. So local payment, what do you mean by a local payment? It pertains to specific fee which you need to deposit to the government account or for that matter any particular institution. Next, when we talk about some more specifics of banker's check or the demand draft, the issue and payment of banker check or DD in cash across the counter is subject to income tax provisions and your prevention to money laundering regulation. And the DDBC for rupees 50,000 and above is to be through the banking channels only. Below 50,000, yes, via cash the transaction can be conducted, but beyond 50,000 it is not permissible in cash. Payment of DD or banker check of 20,000 should not be made in cash. Again, one stipulation is there for rupees 20,000 as well. DD and BC should be issued with account pay crossing if the amount is 20,000. Specifically, if it is 20,000, then crossing is mandatory on that particular instrument. Effective from September 15th, 2018, name of the purchaser should be mentioned on the face of DD or your banker check. Both are valid for 3 months and can be revalidated by the issuing branch. So, revalidation, is it possible? Answer is yes in both the cases, be it the banker check or the demand draft. Now, when we talk about the revalidation for DD, a DD is revalidated only once within 1 year from the date of issue. This particular figure you must remember, that is 1 year, because directly question has been asked once in the examination that what is the time limit for the revalidation of a particular demand draft. It is 1 year. After 1 year, it is cancelled. Purchaser of DD or BC has no authority to countermand its payment after its delivery to the payee. That goes without saying because the transaction has been completed. Now we cannot do anything, neither the bank nor the person. The bank shall exercise caution if the purchaser reports a loss or theft of DD or BC if not already paid. And let me remind you that most of the branches has this practice of maintaining a DD register. so that they can record all those DDs which they have either issued or the customer has submitted it to them. Refund on the cancellation of DD or BC is made only if the original instrument is tendered without any signature of, or you can say any special crossing or any traces of negotiation, and on proper identity of purchaser. So the bank must ensure that this particular instrument, this particular negotiable instrument belongs to this person, this individual, and they are carrying out the transaction based on the customer's behalf, because we are talking about what? We are providing certain service to the customer, the ancillary services. Next, when we talk about duplication, so can a duplicate DD or banker check be issued? So whenever, always remember, whenever we are returning it, so duplicate DD, BC in lieu of the lost instrument can be issued subject to the payment not already have been made, furnishing the indemnity by the purchaser or the payee. So the information whatever has been communicated to the bank from where the customer has issued a particular DD or BC, that particular information will be it will be furnished to that bank where it has been revalidated. So revalidation, if it has been done and the negotiable instrument is now no longer with the particular person or the bank, then again we have to go through the process. RBI has advised that duplicate is to be issued with a particular time frame, that is within fortnight. So within 15 days you must again issue the duplicate DD or BC. For the delay beyond this stipulated period, banks have to pay interest. Fine. So normally banks do it within a week only, because they also know otherwise the penalty will be levied at the rate fixable applicable for the FD of corresponding maturity, in order to compensate the customer for such delay where the request has been made by the purchaser. So always remember, being a banker, if the special case is there when the DD or BC has been lost or stolen and you have agreed to reissue the demand draft or for that matter banker's check, you must complete such kind of transactions within 15 days. Next, when we talk about some other ancillary service, first of all NEFT, then we will be moving on to the safe deposits also. So the major ones will be covering here, and if you are interested to have a comprehensive discussion of all the units of PPB or for that matter other subjects also, we have dedicated batches which are ongoing right now. We have increment batch, we have success batch specifically for the English medium audience. So if you are very serious about this examination, which will be held in within a time span of what, 4 months, less than 4 months now. 2nd of November is the examination date for the first exam, that is IIFS. I would highly recommend you to just go with the timetable which you are having right now, whatever timetable you have made, and stick to that. If not, then start making certain time slots in the morning or for that matter in the evening. If you are unable to make that, unable to have that consistency which is required to crack this exam, I would highly recommend that you should go through the curriculum of these courses which we are providing on the website. You can see that. So NEFT, that is National Electronic Funds Transfer System. Everybody knows NEFT and RTGS are the two major you can say tools in front of bankers for the transaction to be made in either real time or for that matter in batches. So NEFT is remittance system of RBI in operation since 2005. November 2005, NEFT is operational since then. Now in November this year we will be celebrating 20 years of this particular system. Nationwide interbank secure and trusted electronic funds transfer system operates on deferred net settlement DNS basis with transactions settled in batches. So for batches we have NEFT, for real time we have RTGS. The transactions which are included in the next settlement batch, for each batch a single net credit debit entry is passed. So a single, always remember, each batch will have a single debit or credit entry, and there are no multiple net credit or debit. So question can be asked in the examination by manipulating this statement. Instead of single they will write multiple, but that is a wrong statement. The transactions under NEFT may be made for any amount, any kind of amount you can do it. Each bank's branch participating in NEFT has been assigned a unique IFSC code, Indian Financial System Code. So every branch has a unique IFSC code. And when we talk about the IFSC code, what is the difference between the IFSC code of private banks and the public sector banks? Is there any difference? And what about the number of digits which are used in IFSC? Do let me know in the comment section. NEFT system also facilitates one-way fund transfer from India to Nepal. In the previous chapters, we have seen the specific scheme for Indo-Nepal remittance we have for your, you can say, remittances which are going to the Nepal bank. Fine. So thus, like we have the State Bank of India, the largest bank here. Similarly, in Nepal also they have the largest bank in the name of Nepal Bank. So Indo-Nepal remittance facility scheme has been instated for transferring the funds from India, all those people of Nepal who are working in India and remitting the you can say their salaries or funds to their family back in Nepal. They are using which system? The NEFT system. When we talk about the RTGS, again it is electronic payment environment where the payment instructions are processed on a continuous or real time. Always remember, this is the basic difference. Batches for the NEFT, real time is for the RTGS. Okay, and settled on gross or individual basis without netting the debits against credits. So single net credit and debit is there in one batch of NEFT, but here there is nothing like that. You are not singling out any kind of debit against credit. The transactions are processed continuously on a transaction by transaction basis. And when we talk about RTGS, it is mostly done by the individuals. For the parties, when we talk about the CC limit or the revolving fund, they prefer NEFT only until and unless there is urgency. RTGS is available round the clock on all the days and allows transfer of fund on almost instantaneous basis. When we talk about some other aspects of RTGS, the receiving bank has to ensure that the beneficiary account is credited within 30 minutes of receiving the RTGS message. Minimum amount 2 lakh, no upper ceiling is there. Fine. So again, no upper ceiling, but minimum amount is there, that is 2 lakh. Next we have EBT, and why EBT is important for our discussion. Simply stating, when we talk about the social inclusion, or for that matter financial inclusion via the Jan Dhan account, Pradhan Mantri Jan Dhan Yojana, from there this concept has been a very popular one since 2014-15. Why? Because directly you are transferring the benefit of the beneficiary which is supposed to get one particular amount from the government without any interference from the intermediary. And the similar structure, you can say, is via EBT, that is electronic benefit transfer. So when we talk about EBT, it is a product for financial inclusion through which payment reaches the beneficiary's bank account. The success of any welfare scheme or the state benefit transfer must ensure timely disbursal of the benefits without any leakage. What kind of schemes are there when we talk about the types of schemes in our nation? Mostly the social inclusion schemes or the social incentivized scheme like your NREGA. So NREGA, then you have National Old Pension Scheme, insurance scheme also, and some benefit will be directly transferred via your PMAY as well. So all those schemes which are there for the social inclusion as well as the financial inclusion objective, they will be covered under the EBT system. It functions on one district, many banks, one leader bank model. So various banks will be aligned via one district. In one particular district, you have many banks. One leader bank will be there, and this particular model will be finalized in every district. State government deals only with one leader bank in a district designated by the consultation of RBI's regional office in that particular state and for the district itself. When we talk about the SLBC, the state level bankers committee is also there, and the lead bank scheme having the purview over the entire banking system in one particular district is also involved in this setup. Leader bank makes the arrangement with other banks in the district or the revenue sharing contract. Nodal department is designated in the state government to deal with the leader bank for all these schemes. So nodal department, whatever department is there for which the scheme has been implemented, like the department for agriculture and farmer welfare is there. Then you have for the education ministry, various departments are there. Then for health ministry, we have various departments. For women welfare, for the health and nutrition of the babies, the infants. So various departments will be involved with respect to the specific scheme which they are implementing via the EBT. Okay, so participant banks, they will enroll all the beneficiaries, open their bank accounts and issue smart cards to them. Every month what will happen? One leader bank which was assigned, it will receive the funds from state governments in the saving account opened by the nodal department with it, and transfer funds to other banks for credit to the accounts, and ultimately the final beneficiary will be having or receiving those funds. The participating banks credit the funds to the accounts of respective beneficiaries on that particular day only. So same day transaction will be there when we talk about the EBT scheme. Fine. So this was it for the ancillary services. As you know that PPB is a huge subject, the most bulky one, and module A and B, they cover the largest chunk of your syllabus in PPB. But always remember, do not ignore module C and D as well. If you are preparing on your own, start with module C and D so that you gain certain confidence that yes, I have covered 2 modules out of 4, and ultimately in the examination hall also you will carry out that particular confidence. So when I talk about financial inclusion, normally we feel that it is more of a rural settlement or semi-urban settlement kind of thing where they are more prevalent. Why? Because these are the areas which are being targeted by the government. But as we move and dig deep into the financial aspect of a country, we will find that many people living in urban settlements, or for that matter urban areas also, they are also not availing the institutional credit. And for that matter, you must also know that an entire nation's wealth will be determined only if everybody is included in the financial net of that particular nation. So why it is important, financial inclusion? I hope you got to know the crux of it, because then only you will be able to define what is the credit growth of your nation, how the GDP is working, how the salaried class is evolving, what about savings, and then investment. After that, the production level of the country will be rising. So starting off with the basics, what do we mean by financial inclusion? So financial inclusion, it means provision of affordable basic financial service with payments, remittance facilities, savings, loans, insurance products by the formal financial system to those generally which are excluded. So all those segment of society which are being excluded till now, you want to include them in the financial net of your country. And it does not include only the banking services, it also has the other financial instruments into it, like insurance. So when we talk about the life insurance, we talk about the health insurance, all these financial instruments are also part of your financial inclusion. That is why I was saying that most of the people living in the urban areas also, they do not fall entirely into this financial net thanks to the lack of insurance penetration in the urban areas as well. Next, when we talk about the extension of banking services specifically, because we will be focusing on these services. Insurance we will be taking up in the other subjects, like IIFS will be talking about insurance products also. But for PPB, you should restrict your concept of financial inclusion towards the banking system only. So first of all, use of BF, that is your business facilitators, and BCs, that is business or banking correspondents. Why they are important? See, whenever we talk about a banking system, we only find a mention of a physical branch, and along with that, some staff members of that particular bank are sitting there delivering certain services or the banking products of that particular bank. It is just one part. When I talk about the internet, how the internet banking is functioning, how the banks are providing the digital services to the customers. That is also one of the part of financial inclusion. Along with that, when we talk about the facilitators, the people who are reaching those places where the bank's branches cannot reach. So the business correspondents, the banking correspondents, or the business facilitators, they are being hired by the banks and they are being directed by those banks to deliver the services which are not so easily delivered in those areas, especially the rural areas or high terrain areas. So when we talk about BF or BCs, RBI has permitted to use the services of NGOs, SHGs, microfinance institutions, MFIs, and other civil society organizations as intermediaries in providing the financial and banking services based on business facilitator and business correspondent models. You will be surprised to know that RBI is very serious when it comes to BCBF model. Why? Because the financial inclusion must have a specific instrument within itself, that is the disbursement of money. The people who are living in rural areas, normally what we have heard of or what we have learned over the past few years, that now they are not so dependent on the private money lenders. Earlier they used to be dependent on them even for the simple cash which belongs to them only. They just want to deposit their cash to a private money lender. For that service also, they used to charge the customer. But now, since the BCBF model is there, since the banks are proactively opening up the branches in also the remote areas, we are having a particular financial net where you will find most of the services are being delivered in real time by the institutional lenders only. And what are who are the institutional lenders? They are the banks. Fine. BF model, that is your business facilitator model, the eligible entities and the scope of activities. Normally we think that only the agencies, from various agencies, we tend to hire the BCs and BFs, but there is a list to which the customers can have these services via all these particular individuals or for that matter entities. So NGOs can act, SHGs can act as the BF, that is business facilitator, farmers club, the cooperatives. Here you won't be having the cooperatives like urban cooperative bank or the state cooperatives. No, they are not included because they provide the services under the branch model. Community based organizations, and in this community based organization only we find the mention of SHG also. SBLP, that is your SHG bank linkage program of the NABARD. Somewhere down the line it is based on this model again. IT enabled rural outlet of corporate entities, post offices, insurance agents, well functioning panchayats. So the Zilla Parishad will be directing the panchayat, the gram sabhas, the gram panchayats to follow the business facilitator model so that financial inclusion will be ensured in the particular village. Village knowledge centers, agri clinics, you have agri business centers also. Now what about the clinics and business centers? See, when we talk about agri clinics, the knowledge is being imparted to the agricultural areas where rural credit is required, or for that matter the services pertaining to banks is required. So these two clubbed together, you will be having specific agri clinics or agri business centers. Then we have KVKs, that is Krishi Vikas Kendras, normally a tele service which is being implemented by NABARD under the aegis of NABARD, but nowadays not that you can say lucrative for the rural people. Why? Because now they have the digital instruments in the form of mobile. Khadi Village Industries Commission or the Khadi Village Industry Board units, KVIC, you can say is one of the implementing agency for various schemes in rural India, and that is why RBI has permitted it to follow the BF model. Next, when we talk about certain implementation part of your BF model, identification of the borrowers and fitment of activities is one of the part or the initial portion from where the business facilitator will be running their business and providing the services. Collection of preliminary processing of loan. So when we talk about providing money or the credit in rural areas. Specifically, it was in the domain of RRBs, but nowadays all the particular banks, they are having tough competition. Somewhere down the line, competitiveness has been imbibed in RRBs as well, and the focus which was earlier there only for the farmers, it has been wavering. In that particular scenario, you will find the BFs to fill in the gap for loan or the credit delivery. Application including verification of primary information, creating awareness, educating, debt counseling. See, this is one of the major concern in the rural credit. When I talk about rural India, the major issue is only one, that is lack of awareness. People there are already reeling under stress thanks to the distress of farming. The farmer distress is known to everybody. But if you create awareness there, more or less they will not be following the path of private money lenders, and they will avail the institutional credit. What in turn it will do? It will provide certain leverage to these farmers so that they can re-deposit or re-enter into a particular contract which will not create further stress. Education should be done. Debt counseling is also one of the part of BF model. Processing and submission of applications to the banks. So when we talk about dairy loans which are given on the, you can say, collateral for the buffaloes in banks. So buffaloes are kept as collateral, and against the buffaloes you will be provided certain loan. When I talk about the entire village, the banks cannot reach each and every house. So what they do, they follow the BF model, and they hire certain agents who will be collecting the forms from all those households in the rural areas who are interested to avail the institutional credit from the banks, giving the money for your dairy unit, keeping the buffaloes as the collateral. So there you will find the submission of applications and processing of the applications by the BFs. Promotion and nurturing the self-help group, JLGs, post-sanction monitoring. Although it is not taken so seriously right now, but the business facilitator model which has been finalized by the financial institutions, it includes the post-sanction monitoring as well, and it must be done. See, when we talk about NPA management, why do we need to manage NPA when we can just have the post-sanction mechanism where you will ensure that no NPA happens? Monitoring and hand-holding of SHGs, JLGs, credit groups, etc. Follow-up for the recovery. If the restructuring process, rehabilitation process could not be done, recovery is the last option, and follow-up for this recovery is also under the business model of BFs. Next model is your business correspondent model. Who all are eligible here? See, individuals are eligible in the BC model, like retired bank employees, teachers, retired government employees, or ex-servicemen. Then individual owners of various shops, be it the kirana shop, fair price shops, or for that matter medical store also. We have the PCOs, that used to be there in all the areas, now no longer available, but in certain remote area or the most remote area of a particular district, they still have this particular PCO, that is public call office. So whoever is operating this PCO, they can also become the BC. Agents of small saving scheme of Government of India or the insurance companies, then individuals who own petrol pump. So basically, when we talk about the business model of BCs, you will find all those entities or the individuals are eligible to participate in this particular setup if they are residing or they are located in the proximity of that particular village. All these are what? Either you will find the retired teachers of that particular area only. When we talk about the shops, again, proximity must be there for that particular area from where the institutional credit will be started. Authorized functionary of well-run SHGs, any other individual, including those operating the common service center. So CSCs, a fair bit amount of, you can say, workload has been shifted towards the CSC centers, whenever we talk about the cash disbursement of lesser amount, or for that matter, you want to open an account and want services from the bank. So bank employees being very, you can say, busy, and they are unable to render the service as they should have. So here comes the rescue mission from the CSCs, and they will be providing you with all the information, all the necessary information which you require. So BC model, these were the eligible activities or the scope of activities. When I talk about the business correspondent model, some other activities can also be performed, or the eligible entities from where this particular setup will be coordinated. NGOs or the MFIs set up under the Societies or Trust Act, Section 25 companies under the Companies Act. Cooperative societies registered under Mutually Aided Cooperative Societies Act or the Cooperative Society Acts of states. See, here also again I am reiterating the fact, the state cooperatives, district cooperatives, they are not a part of this particular setup. Only those entities are a part which are defined in the respective acts. We have post offices plus companies registered under the Indian Company Act 1956 with large and widespread retail outlets other than NBFCs. Commercial banks excluding the RRBs because they already perform this particular function of financial inclusion, providing the services for financial inclusion in the remote areas. They are also permitted to appoint non-deposit taking registered NBFCs as BCs. So appointment can also be done from the commercial banks of what? Of all those NBFCs which will be ultimately working under the model of business correspondent. Next we have the NBFCs. The condition for engaging these NBFCs to ensure there is no mixing of bank funds with those of NBFCs which you have identified which will be providing the services under this model. Specific contractual arrangement for all the conflicts of interest to be adequately taken care of. So you must be knowing that whenever there is multi-party involved in a particular setup, you will find conflict of interest. Yes or no? When we talk about the NBFCs, they are being hired by the commercial banks to perform the activities under the BC model. So whatever activity is being performed by NBFCs, it must be having certain rules and regulations to be followed from the model of that particular commercial bank. It might involve conflict of interest. Bank, to ensure these NBFCs does not adopt any restrictive practices, that is offering the saving or remittance functions only to own customers, forced bundling of services, or you can say bank. So always remember, NBFCs, the non-banking financial services or the companies, they have this model that they will be having a net of customer, and whenever the tie-up is happening between a commercial bank and the NBFCs, you will find certain favoritism going on in that particular area, be it in the form of loan or for that matter opening up the account. This is prohibited by the BC model. Next, what else we can learn about the scope of activities? The scope of activities of BC may include the following activities: identification of borrowers. You are identifying that these particular segment of society, they need some money. Collection and preliminary processing of loan applications, including verification of primary information as well as data. So the KYC, we won't be saying that eKYC will be done by them, but yes, the physical KYC, or for that matter Aadhaar card, PAN card, or the Kisan Vikas Patra, all these things will be checked prima facie by the BCs. Creating awareness about the savings and other products and educating them. Processing and submission of application to the banks. So banks will also be participating in the, you can say, loan process, loan processing, but the initial step, that is collecting the application, collecting the loan applications, will be done using the BC model, business correspondent. Next we have the scope of activities include promoting, nurturing and monitoring of SHGs, GLGs or credit groups, etc. Post-sanction monitoring will also be a part of your BC model. What is post-sanctioning? As it was there in the business facilitator, here also, if supposingly a particular loan has been given to a farmer worth rupees 50,000. So although the small amount entails larger EMIs thanks to the lesser repayment period, but again you need to be very vigilant after you have disbursed the loan, because chances are really high that this loan might turn NPA. Why? Always remember to think from the scratch. Being a banker, you must acknowledge this fact that why somebody requires a very small amount of loan, that is 50,000, because they do not have enough funds to sustain their livelihood. That is the first reason. No matter what the government is providing subsidies, no matter what the government is providing various schemes, programs, so that they can resurrect their business activities, all the rural area people or the semi-urban area people also who are availing smaller loans, somewhere down the line they are unable to manage their household expenses prima facie. So post sanction monitoring is very important here. Follow up for recovery, disbursal of small value credit like this, recovery of principal, collection of interest, collection of small value deposits, sale of micro insurance or the mutual fund product, pension products. Mutual fund product only has to be sold if they have the awareness about that, but for the pension products you must create awareness and then try to sell them those products. Why? Because ultimately this is for their benefit only. Simply stated, this particular chapter will be talking about mostly the duties of a bank. What all duties a bank performs when we talk about the banker customer relationship. And the duties will be various. You can say they are varied, starting from the services which the banks provide. We have seen the services in the chapter of ancillary services. Next comes those kind of services which we say club together form the duties plus the responsibilities. These are some heavyweights as compared to the services. In services, you are just providing a particular, you can say, goods or services to a particular customer. But when it comes to the duties, responsibilities, certain laws are backing those particular things. Those scenarios need to be dealt with utmost care. So when I talk about one of the duty, starting off, it is the duty of secrecy and confidentiality. What do we mean by secrecy and confidentiality? It talks about primarily the data. Data of what? Data of the customers. A bank would be protected only if it discloses the affairs of the customers under certain legal permissible compulsions or circumstances as follows. First, where the disclosure is under the compulsion of law. There is certain statute or a particular legal aspect is backing a disclosure of a particular data pertaining to the customer. Then only the bank should disclose that particular data. Where there is duty to the public to disclose, if it is in the public interest, then you can disclose the data. Where the interest of bank is requires it to be disclosed. So interest of bank may be in the form of appreciation or for that matter not an appreciating effort. What I mean by not an appreciating effort, like the data published in the case of SARFAESI Act. In that, we see that the people or the business entities who are unable to repay their loan, their data is being published in the newspapers. That also is a part of interest of bank, because bank wants to recover that money. That is why it is very serious about publishing the data. Where the disclosure is made with the express or implied consent of the customer. So if the customer wants to retrieve certain data at an individual level, that also can be done by using the banking services. So duty of secrecy and confidentiality is a basic one. All these four clubbed together will be termed as a particular domain where the duty of secrecy and confidentiality lies. When I talk about the disclosure under compulsion of law, let's see them one by one. So compulsion of law, what kind of laws are there? First of all, it will be an act, that is BBE Act, Bankers Books Evidence Act 1891. Now, this particular act talks about a certain legal dispute. So, two sections, that is section 4 and 6 of the Bankers Books Evidence Act, in a legal dispute between bank and customer, fine, bank's customer and a third party, certified copies of entries in the bank's books may be called for. So, you are trying to back your customer here against a third party. For that, if the information is required, you are willingly providing it. Summons by civil or criminal courts if there are certain proceedings, legal proceedings are happening. So these courts have the power to issue summons to banks to produce documents or tender the evidence. If a particular case, let's suppose recovery case is there in a particular court, then the bank must oblige whatsoever information is being asked by these courts. Next, we talk about some other laws. Income Tax Act 1961. Here, the section 133 of the Income Tax Act may call for books of accounts or other documents from the banks. When we talk about the books of accounts or other documents, they are directly related to the customer's account. So just think in your mind and tell me whether such cases are pretty often in the banks that every customer the data will be asked or being retrieved by the income tax officials. Answer is no. Only those perpetrators who are having certain illegal activities going on in their accounts, they will be questioned by the income tax authorities, and indirectly income tax authority can provide a particular summon to the banks also that they need a specific information regarding a customer. Some other acts under the compulsion of law disclosure. The other relevant acts under the information can be called for from a banker are Companies Act, you have RBI Act 1934, and FEMA and Gifts Act. All these are the very, you can say, common acts under which information can be seeked by the respective authorities from banks. Now, once we talk about the duties of a particular bank, they are multifold, responsibilities are multifold, and all those laws which we have just seen, all those acts which we have seen, more or less, they are more than enough to cover entire gamut of services which the bank will provide by providing the information to those particular authorities. When it comes to providing services to a common man in India, we have a particular board that is known as Banking Codes and Standards Board of India. Short form, you must have heard it, BCSBI. That is how we know it normally, but the full form is Banking Codes and Standards Board of India. What was the reason why it was started, and right now when we talk about 2025, how relevant it is? All these things we'll be studying today. So in November 2003, RBI constituted the Committee on Procedures and Performance Audit of Public Services. So Committee on Procedures and Performance Audit of Public Services under the chairmanship of Shri S.S. Tarapore. So Tarapore Committee on, you can say, the Procedures and Performance Audit of Public Services was constituted by the RBI. Who was Sri Tarapore? He was the former deputy governor. And what was the aim of this particular committee? See, the name of committee is very important here. Committee on Procedures and Performance Audit of the Public Services. So the aim was to address the issues relating to availability of adequate banking services to common man. As I was telling you in the initial, you can say, part of this particular video, that one thing is services which the banks provide. But when we take these services very seriously and we want them to be implemented at grassroots level, more or less we talk about the responsibilities. Fine. They no longer remain a service, they become a responsibility. and BCSBI will ensure that these responsibilities are being taken care of very, very seriously. The committee recommended setting up Banking Codes and Standard Board of India (BCSBI) on the lines of Banking Codes and Standard Board functioning in UK. So you might have seen that in Indian economy and also other developing economies, we have taken certain, you can say, examples from the foreign or the developed nations and tried to implement them in our country because these models have worked in those countries and we want to aim for the efficient methods which are already going on in the developed countries. So if a question is being asked that BCSBI model has been uh, taken up by India from which of the following nations? So the correct answer will be UK, that is United Kingdom. What is the history of BCSBI? As you know that it is a registered entity. So the BCSBI was registered as a separate society under the Society Registration Act, the SRA 1860. You must remember the act under which the BCSBI has been registered. So Societies Registration Act 1860 and on which date? 18th Feb 2006. That is the date when it was registered. When we talk about the committee, it was set up in 2003. So it took roughly 2.5 years for the committee to, give the final verdict and the formation of BCSBI happened. What is the main objective? It is to plan, evolve, prepare, develop, promote, and publish comprehensive codes and standards for the banks for providing for fair treatment to their customers. So fair treatment, that is the sole aim which is being ensured via BCSBI. Fair treatment includes everything. It includes when the customer is stepping in the branch, how you greet the customer, how the customer feels in the physical environment of your branch, how efficiently you are doing your work. Is there any complaint of the customer? If there is a complaint, how you are handling that particular complaint? If you are not handling it properly, what all the customer can do? All these things clubbed together, they will be forming a part of fair treatment. To function as an independent and autonomous body to monitor and to ensure that the codes and standards adopted by the banks are adhered to in letter and spirit while delivering the services to the customers. Now, why specifically banks have to ensure these codes? Because ultimately they are providing the services and their respective boards have this particular liberty to engage in the BCSBI on their own terms. But the essence of BCSBI must remain there. When I talk about the collaboration, so BCSBI had in collaboration with IBA, that is Indian Banks Association, evolved and issued following two codes. Two codes have been issued when we talk about in collaboration with the IBA. So BCSBI plus IBA has taken the matters very, very seriously. And right now we have two codes in our country. Code of Banks Commitment to Customers issued in 2006 in the starting of BCSBI, which was revised in 2018. So the revision happened when? In 2018. To remember the timelines. Next is Code of Banks Commitment to MSE, that is Micro and Small Enterprises Code, released on 31st May 2008 and reviewed in 2022. Why it was reviewed in 2022? Because in 2020, the MSMED Act, under which the MSMEs perform in our country, it was amended. And the review is still due because in Feb 2025, again, the limits of MSME have been revised. So ultimately, in the upcoming months, you might find a committee or so which is being created again to revise the guidelines under the Code of Banks Commitment to micro and small enterprises. When I talk about the MSME, it is micro, small, and medium enterprise. But here we are only focusing on micro and small. What about the medium enterprise? One more M is there, no? That is medium. So always keep in mind that in India, the medium enterprises are very minimal. Micro and small enterprises clubbed together, they form more than 97% of the MSME industry or the MSME enterprises in the country. So that's why special focus is there always on the micro and small enterprises. Second reason is that rural and urban and semi-urban areas, these are being targeted under the micro and small enterprises. Urban areas, more or less, they do not have that much concentration of micro and small enterprises. And ultimately, when we talk about the last mile delivery or the financial inclusion, micro and small enterprises will be playing a huge role. So that's why a specific code is there, code of bank's commitment towards micro and small enterprises. What is the present status when we talk about today? So RBI has since set up Consumer Education and Protection Department, issued the Charter of Customer Rights, and considerably strengthened the Ombudsman mechanism to enhance the consumer protection. So, consumer protection is at the core. Always remember, whenever we are talking about BCSBI, it is not only about providing the right services, it is also having a bent of mind towards consumer protection. And this ombudsman mechanism, the ombudsman scheme of the RBI, being a banker, you must have faced some actions or, for that matter, some information of this particular scheme while working in the bank. This is practically happening and it is quite visible to the public also. So, a great step which has been taken by the RBI, a commendable one when it comes to protecting the customer rights. It was accordingly decided to dissolve the BCSBI, and BCSBI is no more functioning. The codes issued by BCSBI continue to be applicable to the banks. So when we talk about the core function of BCSBI, it was what? The consumer protection along with the customer rights must be intact. And that has been carried forward by the ombudsman mechanism. Because ultimately, when we talk about the regulator, that is the RBI, it will decide whether the banks are taking customer rights seriously or not. So, what are the key commitments under the codes? To act fairly and reasonably in all their dealings with the target customer. Act fairly. That is the sole. To help customers to understand how banks' financial products and services are working. So, providing the information awareness is also, you can say, one of the aspect here to help customers use their account and services, whatever you are providing them. So, not only delivering the services, but making continuous efforts to impart knowledge to them how you can use those services to deal quickly and sympathetically with things that go wrong. So when we talk about the issues being faced by the customers, those must be addressed. To treat all personal information of the customers as private and confidential. So respecting the privacy is also one of the idea under the codes. To publicize the code, make aware the customers, to adopt and practice a non-discrimination policy. You need not to discriminate any customer on any ground. That is also an important thing. If we talk about the grievance redressal, so every bank is required to give a particular window, a particular opportunity to the customers so that they can resolve their grievances. So every banker or the every member bank is required to have a help desk or the helpline at the branch itself. Helpline number must be there. Have a code compliance officer, that is CCO, at each controlling office above the level of branch. So the code compliance officer, this particular post must be there, and where it must be present in that office which is having the power over the branches. Display at each branch name and contact number of the code compliance officer. Now, just to give you a heads up, how many of you think that in your branches you have displayed the CCO number? Anybody who wants to share an experience that yes, it was not earlier there in the branch, but since you know that it must be there, so you were the one who initiated this process. Display name and the address of ombudsman must also be provided in the branch. Now let's talk about the obligations on the customers. The customers, when using these services, have certain duties. Again, the banks have certain responsibilities, some duties. Similarly, customers will also be having certain duties. So to provide the required documents whenever the banks ask, that is one of the major duty of the customers. To keep the passbook, checkbook, and debit card safely, whatever the services banks have provided you, respect that service and treat all those documents with equal importance. To keep confidential the user ID password for access to various channels, be it net banking or for that matter your mobile banking is there. To inform promptly the bank about an unauthorized transaction noticed in the account. So as soon as you know for sure that yes, you have not committed this particular mistake or you have not committed this particular transaction, then you must report the branch as soon as possible. Not to allow any third party to use own bank account for its transactions. So remember, whenever we are talking about a third party, it does not include you and whosoever you are trying to give your password, ID password. But third party specifically talks about any person who is there, who is using your account without your information. You are unaware of that fact that somebody else is using your account, be it the net banking or for that matter mobile banking. So you need not to allow such kind of activities. Not to provide any personal or account related information, including user ID, OTP to anyone purporting to call on behalf of the bank. Nobody, always remember, in the bank will call you and ask for your user ID, password, or for that matter OTP. So you must be very vigilant in all these things. Similarly, not to share any information with any person purporting to represent the bank visiting personally. Okay, so all these things, although they are very basic, but yes, these come under the duties of the customers. Plus, not to click on any link which you have received through emails for accessing the bank's website. Always go to the official domain of the bank's site and then log in the log in using the ID password. To sign all the checks or forms or letters as per the specimen signature, whatever SS you have provided to the bank, maintain that specimen signature. To use non-home branches only for permitted transaction and when it becomes essential, and do not just make an issue of that thing that okay, I am a customer, you should be delivering me all the services even if I am not your even if this is not my home branch. So always remember, in non-home branches, there are certain stipulation on the bankers also. They willingly, even if they are willing to provide you, they cannot provide you those services. To register one's own mobile and email ID with the bank to get instant alerts. Not to store important banking data in mobile, email, purse, or wallet. To use only verified, secure, and trusted websites. Again, the domain name must be there in your mind always. To use debit cards, credit cards only at authorized ATMs or merchant establishments. To change one's online banking password and PIN regularly. You must keep on changing it, not only when the bank's websites prompt you. To request to block one's ATM card, debit card, credit card, prepaid card if it is lost or stolen. First of all, what is the model policy on grievance redressal? See, it is based on various principles which we have studied in the previous chapters of, you can say, 16th, 17th, and 18th. But let's revisit them one by one. Customers will be treated fairly at all the times. That goes without saying. You cannot treat them unfairly. You must be very, very fair and considerate about the customer doubts or the resolution of those doubts. Complaints raised by the customers will be dealt with courtesy and in time. So the specific timelines are also important when it comes to customer doubts or the customer complaints. Customers will be informed of avenues to escalate their complaints, grievances within the organization and their rights to alternative remedy if not fully satisfied. See, the RBI scheme of ombudsman, it is based on this phenomena only, that if a customer is not satisfied with the resolution provided by the banks, then only they have this option of moving to the RBI. And when we talk about the efficiency, which has been increased thanks to this particular regulatory measure by the regulator, then yes, it has ultimately benefited the banking sector as whole. It has also given an avenue for the customers to instill the trust in the banking system. So bank will treat all the complaints efficiently and fairly. There should not be any kind of distraction while handling any kind of complaint. They must act impartially. Employees will work in good faith and without prejudice to the interests of the customer. What are the interests of the customer? See, the sole aim of customer complaint is to get their issues resolved. Fine. That is the only thing. Deep down inside a complaint, the resolution is what a customer wants, nothing else. If you are having some apprehensions that customer has given a complaint just to mock you, or for that matter just to give you an heads up that further action won't be taken, so this is a wrong practice. You must be very empathetic towards the customer. What all interests are there for the customers? When you talk about the internal machinery to handle the customer complaints or the grievances, see, the customer awareness and facilitation, that is the prime importance. Why I'm saying this? If the complaints are moving up in the order, the complaints are not resolved and they keep on piling in a particular branch, then it will not only be detrimental to the branch's reputation but to the bank's reputation as whole. And while we are trying to accommodate all the complaints, all the grievances of a customer, along with that, parallelly, we must start the customer awareness also, which acts as one of the important component in the internal machinery to handle these complaints. So how you can create awareness? You can tell the customer where to make a complaint, how a complaint should be made, that is, when to expect a reply. If they know that for sure within 10 days the customer's complaint will be resolved, then they can wait. Otherwise, if you do not come up with a solution for, let's say, 90 days, then there will be a detrimental effect on your branch. But if they already know that yes, 10 days is the maximum time, and they will be very empathetic towards the bank staff also, the customers, they do not want any kind of chaos. They just want to be heard and to get their complaints resolved. Whom to approach for redressal? You must have a particular person, or for that matter, a particular counter for that. And these information, whether related to a particular official or a particular counter which you have made in your branch, must be readily available with the customers. What to do if the customer is not happy about the outcome? Then also, rather than giving a resolution that you can go to the RBI's ombudsman scheme, you must have an alternate. You must advise the customer to wait for some more time because you and your team sincerely is looking into that matter. Along with that, you should have a complaints or the suggestion box for the customer's convenience, where they can suggest also. Sometimes what happens, what we have seen in the banks, that not only the complaints but certain suggestions are also unheard. Nobody wants to suggest anything. Why? Because of the culture. You should not promote this culture in your respective branches, and try to be very open towards suggestions also. Complaint book or register must be maintained in the branch, and complaint form should also be there. Although it is not advisable to have a complaint form, because once you are open to the suggestions, you are looking into the complaints with efficiency, then no matter what kind of complaint a customer comes with, you will be providing the resolution. Now, when we talk about the customer grievance redressal system, one of the most important or the earliest, I would say, system was ODR, that is online dispute resolution system. When we talk about the specifics of this particular system, the Payment System Vision 2021 of the RBI highlights the need for technology driven, rule based, customer friendly, and transparent dispute redressal systems. See, whenever there is a particular doubt in the mind of customer, it is there only because of non-transparency or the opaque policies of a bank. If you are open to the customer with all the policies, all the guidelines which your banks are making right now, then the customer will also feel at home. He or she will also feel that yes, you are addressing or trying to address all the doubts, plus trying to guide them as well. In August 2020, RBI advised authorized PSOs, that is payment system operators, banks and non-banks also, and their participants known as PSPs to put in a place system for online dispute resolution. A particular system where you will be resolving the doubts, the disputes, or the grievances of the customers via online mechanism, so that customers also feel the convenience while giving a particular input related to the disputes. If the grievance remains unsolved for up to 1 month, the customer may approach to RBI, that is Reserve Bank Integrated Ombudsman Scheme, RBI OS as we know it, 2021. Customers shall provide with one or more channel for lodging the disputes and grievances, be it the web-based or the paper-based complaint form. One complaint form must be there. Then you have the IVR, the telephonic registry directory must be maintained, and you must make the customers aware of this particular number. Mobile application, call center number must be there, SMS through branches also. You must provide a particular channel for lodging the complaints. Fine. Although we do not have that much resources right now in the public sector branches, but yes, that is how the system should work. For mobile phone based systems, third party app providers should also be encouraged so that you can have the resolution as soon as possible. The aspect of data confidentiality shall be taken care of because ultimately it lies in the duties of the banker. Confidentiality of the data must be maintained. Next, when we talk about the complaints of unauthorized electronic transactions, in the SMS and email alerts sent to the customers, facility to enable customers to instantly respond by reply should be provided for notifying any object. Any kind of object you are trying to notify must have the option of reply. And this will send a positive message to the customers that yes, the bank is there for us and they are also very serious to address our complaints. Complaints should be resolved and liability of the customer, if any, established within the timeline specified in the bank's board approved policy, but not exceeding 90 days from the date of receipt of the complaint. So various banks have different timelines for their you can say grievance redressal, but it should not exceed 90 days. No bank should take more than 90 days. Otherwise, RBI's ombudsman scheme will open the gateway for the resolution, or you can say dispute redressal for the customers. If the complaint is not resolved within 90 days, the customer should compensate it as per the RBI norms. So compensation will trigger once you complete these 90 days and no resolution has been provided by your bank. Credit facility related complaints, the maximum complaints when we talk about the data, the official data of RBI only from 2025, you will find the maximum complaints of customers pertain to the credit domain. Whether there was a service charge which was levied wrongly, the interest payment not calculated correctly, or for that matter, misinformation being spread by the respective banks. All these are the reasons why credit domain has the maximum complaints according to RBI's data. The board of directors should also lay down the appropriate internal redressal mechanisms to resolve the disputes related to loans. When we talk about board of directors, yes, they should also be encouraging the bank's branches to follow some guidelines which in effect will transform the entire banking system. Okay, so if you have any kind of doubt, guys, I would highly recommend you to ask me in the comment section, and do let me know if you have any kind of suggestion that would be highly beneficial for us. So when we talk about the next particular disclosures related to complaints, we have a particular CP-PAPs for this. So based on the recommendation of Committee on Procedures and Performance Audits on Public Services, which we know as CP-PAPs. Okay, always remember CP-PAPs is there. A particular committee was established so that we can have the procedures laid down for the public services along with the performance audit. RBI had advised that banks must place a statement of complaints before the board's customer service committees along with an analysis of the complaints received. So all these things should be encouraged on the, you can say, bank's board policy also, plus the various customer service committees which we have, be it at the nodal level or for that matter at the state level or the local banks level. All the levels, whatever the customer service committee is there, it must follow the recommendation of CP-PAPs. The full form of CP-PAPs is also important. IABF can ask you this. Next, when we talk about the intensive review of grievance redressal mechanism, so when we talk about RBI, it takes the complaints very seriously. RBI also undertake the annual assessment of customer service and grievance redresses in the banks based on the data and information available via CMS, which is what? Complaint Management System, and other sources and interactions. Then we have principal nodal officer who will be appointed by the banks under the ombudsman scheme. And what should be the rank of this particular individual? It should be not below the journal manager. Name and address of the principal nodal officer may be forwarded to the chief journal manager, customer education and protection department, RBI. So when we talk about the name, address of your principal nodal officer, it should be forwarded to the CGM. And for which department? The CGM should belong to which department? It is Customer Education and Protection Department, the CEPD, fine, of RBI. Okay. Contact details of the principal nodal officer needs to be prominently displayed in the portal of the bank also, so that the aggrieved customer can approach the bank with a sense of satisfaction that she's attended at a senior level. That is the rationale. Fine. RBI has given journal manager this power under the ombudsman scheme so that the customers also feel that yes, a person of the level of journal manager is handling my grievance. Then we have Chief Customer Service Officer at the select banks. So in May 2015, RBI advised few banks to appoint an internal ombudsman IO designated as the CCSO, that is Chief Customer Service Officer. Now, when we talk about the specifics of this CCSO, the person should not have worked in the bank in which he or she is appointed as CCSO to avoid what? Conflict of interest. Otherwise, they will be obliging the bank only. The bank's internal ombudsman is a forum available to bank customers for grievance redressal before they approach the ombudsman. In September 2018, RBI issued revised IO scheme, that is Internal Ombudsman Scheme 2018.
But before jumping to the 2019, I would like to highlight the older versions of Consumer Protection Act, which was 1986. When we talk about the Consumer Protection Act, why it was essential in the 80s, in the 90s era, why the countries, the various nations which are there, they were very specific about a particular law, a particular act which will provide some protection, some kind of protection to the customers or the consumers. Reason being this, the pre-globalization era. When we talk about the investments, once the investors come in your country, they will be focusing on the profit maximization. The consideration of the society or the social welfare is a limited one whenever we talk about a profitable business. So all those activities which are governed by business entities and they have consumers or for that matter customers as one of the stakeholders, a particular law was amended, a particular law was passed, and we know it as CPA 1986. Post-liberalization, the Indian market has grown with an unprecedented pace. We know the liberalization phase starting from 1991 till today also, we have n number of avenues for the business activities to flourish. But what about the consumers? This particular act, that is Consumer Protection Act, will look into that matter only. The earlier act was found inadequate to address appropriately to deal with the new issues. Hence, revised law has been enacted. Since this was a pre-globalization era act 1986, so after globalization, there were n number of concerns which were advanced by the customers also, and somewhere down the line, producers also felt that the demand is not rising, it is instead declining. What was the concern there? The major issue was the supply. The supply chain was not at all flourishing thanks to the limited production level. And for that, the producers also thought that we must protect the customers so that we can have some lucrative offers for them and they will be, using their products. So after the globalization era, we had discussion in the parliament also, and a particular law was enacted, bill was passed, and right now we see it as CPA 2019. So the 1986 Act was enacted with the objective for better protection of the interests of consumers or the customers. So one pertinent question which must be in your mind, whether this particular act applies to the customers of bank also, because you guys being banker must be curious about this thing. So let me clarify the most important aspects which are included in the CPA, that is Consumer Protection Act. They are directly or indirectly by various laws, be it the RBI Ombudsman scheme, be it the board's policy, have been implemented in the banks already. So the Consumer Protection Act 2019 retained the preamble of 1986 Act. What is this preamble? What is the basic crux of preamble? Be it the preamble of our constitution, preamble of a particular act, or whatever bill has been enacted. Preamble talks about the essence. What is the major objective? What is the crux of a particular act or a law? So it retained, the 2019 CPA retained the preamble of 1986 Act and had the same purposes as stated above, but it revisited the entire framework in the context of radically changed ecosystem and contained new provisions and also expanded the concept of consumer protection. You want to protect the rights of customers, then you must be very serious while enacting a particular law, that is CPA 2019. CPA 2019 extends the whole of India, including UT of J&K as well. So when we talk about the coverage, this law has been implemented in J&K as well. Like the earlier 1986 Act, it applies to all the goods and services. So from here also you can see that services are included, excluding some of the services or the goods like goods for resale. Nobody is answerable for reselling of a particular product. Goods for commercial purposes, then services rendered free of charge. If you are not paying any kind of money, any kind of amount for a particular service to avail that service, then nobody will be able to protect you, because under the law, under CPA 2019, a particular service must be rendered and that service should have been a chargeable one. Something must be charged from that. Services under a contract for personal service. So personal services again not covered under the CPA 2019. Here nothing is mentioned about the banking. More or less the goods for commercial purposes also are not under the ambit of CPA 2019. Now salient new aspects included in the CPA 2019. These are the new aspects. And when we talk about the examination, whether the examiner will be interested in asking you all these new aspects, answer is no. Examiner will focus on the essence. CPA 2019, how it implies in the banking services. So nonetheless, let's see what all has been added. So it defines specifically the consumer rights. The 1986 Act, although a comprehensive one, but this thing, the consumer rights, was excluded there. Then it adds the feature of unfair contract. The unfair means of a particular business or a particular contract has been added. Introduce the product liability action. What kind of action you can take whenever we talk about the product. Defines the design and includes related aspects. The design, the construction, the build of a particular product can also be contested in the CPA 2019. It includes e-commerce, which is a very important aspect when we talk about our foreign trade policy also. India wants to maximize its services in e-commerce activities, but thanks to various stipulation by World Trade Organization, still we are not able to implement this. But the CPA 2019, it includes the e-commerce as well as the electronic service providers. So all those services which are being provided electronically by various service providers, they are also included. Advertisement and endorsement. See, this advertising is a very important step which has been included in CPA 2019. The misleading advertisements, you can contest them also. Adds the express warranty parameter. Whatever there is, whatever product there is, whether it falls under the ambit of warranty or guarantee, it must be specifically mentioned. Distinguishes between the manufacturer, product seller and product service provider. So whatever goods you are using from any of the companies, just try to flip that product and you will see on the labeling at least the manufacturer, the product's manufacturer if it is different from the manufacturer, and the product seller. These three things will be specifically mentioned there. Why? Because CPA 2019 stipulates that. Plus, when we talk about the banking services, the CPA 2019 also covers the banking services. But when we talk about the extensive coverage of banking services, the consumers hold certain right under the RBI IOS, that is Integrated Ombudsman Scheme. When we talk about who is a consumer, see, in the customer banker relationship chapter, we have seen what is the definition of a customer or who can be a customer. But how a customer is different from the consumer? There must be certain consumables whenever we are talking about an entity, an individual who will be tagged as a customer or consumer. So it will thus be observed that the consumer is any person who, for a consideration paid or to be paid all these services, has bought any good or for other than resale or commercial purposes. So bought means they are buying something, they are investing in a particular product. So some money has been debited from a particular individual's account and credited to the person who is the owner or the seller of this goods. Hired or availed any service other than for commercial purposes, and that under a contract for personal services. Whenever we talk about the personal services, they are not included in CPA 2019. So always remember, excluding the personal services, all the remaining services will be included here. And the person or the individual or the business entity, whosoever is consuming or paying for that service, will be known as a consumer. Has used any goods other than for commercial purposes or benefited from any service other than from commercial purposes, and that under a contract for personal services. See, when we talk about the personal services, they are totally different from the commercial one. And this is a loophole, this one, commercial purposes. This is a loophole which is still prevalent in CPA 2019. If we talk about the CPA 2019, it will be applicable to all the goods and services except for certain exceptions which we have seen. When we talk about commercial purposes, a particular business entity can label the products they are delivering as non-commercial products or non-commercial goods or services, and it indirectly implies that CPA 2019 is not applicable to those products, to those goods or services. So let's see when the government comes up with amendment of CPA 2019. Till now, when we talk about 2025, so commercial purposes are excluded from the definition of consumer. Next, what about the consumer rights? Various rights are there, 5-6 rights which are important for the examination. Let's discuss them one by one. The right to be protected against the marketing of goods, products or services which are hazardous to life and property. So whenever you see an advertisement on television or for that matter any social media platform also, one warning is there. If the particular producer feels that yes, this particular product will be detrimental to the life or property of a particular person or the entity. The right to be informed about the quality, quantity, potency, purity, standard and price of the goods, products, services as the case may be, so as to protect the consumer against unfair trade practices. What are the unfair trade practices? All those activities where certain laws have been flouted by the producer, they are termed as unfair trade practices. For example, when we talk about the quality assurance of a particular product must be done. That is what the WTO mentions in its document of AOA. But if a particular firm is flouting that particular rule, they are doing what? They are doing the trade using unfair practices. That should be prohibited, and that is prohibited, and consumers' right hold in that scenario also. The right to be assured wherever possible access to variety of goods, products or services at competitive prices. So competitive prices means no injustice must be made towards the consumers whenever you are keeping a price or finalizing price for a particular product. And mostly in today's world it cannot be done also. Indirectly or directly you have to keep the prices in check. Whatever product you are delivering or services you are giving, you have to have a particular price in check. Reason being, there are n number of competitors in the market. The customer has those choices. But yes, it is also included in consumers' right. The right to be heard and to be assured that consumers' interests will receive due consideration at appropriate fora. What is this appropriate fora? That is also a point of discussion in this chapter only. But when you talk about this line, this particular statement, it states that the right to be heard. Whatever inhibitions a consumer has for a particular product, you must provide the appropriate information for the particular product. The right to seek redressal against unfair trade practices or restrictive trade practices or unscrupulous exploitation of consumers. So right to be heard, its extension is this one, right to seek redressal. Whatever grievance a consumer holds, it must be sorted out, it must be settled as soon as possible. The right to consumer awareness. So you must run some campaigns, some advertisements to raise the public awareness for various products, and it is a part of, or I would say integral part of, consumers' rights. Next, significant consumer complaints redressal for related terms. Various terms are there when we talk about the grievance redressal mechanism under the CPA 2019. First of all, let's see what is the term used for the administration. So first of all, we have district commission, which means district consumer disputes redressal commission established under the subsection 1 of section 28. So always remember, wherever this term is written with respect to the CPA 2019 or the consumer rights, It directly means District Consumer Dispute Redressal Commission. That is the full name. And which subsection is responsible for this particular definition, or it is wholly defined in which section? Section 28 of CPA 2019. State Commission, it will mean what? State Consumer Dispute Redressal Commission. And it has been established under which subsection? Section 42 of the CPA 2019, it mandates that this particular commission must be established in the state, and for the district as well we have section 28. For National Consumer Dispute Redressal Commission, section 53 stipulates such kind of establishment. Next, we have mediation. What do we mean by mediation? See, there are two things. One, a particular award has been given to the consumer by the redressal authority, by the appellate authority for that matter. Second is mediation. You want that the consumer and the producer should reach a common point so that we do not have any further argument. So mediation means the process by which a mediator mediates the consumer disputes. Mostly you will find the district commission having a particular official for mediation only, known as mediator. Mediator means, mediator referred to the person who will be mediating the entire process of dispute redressal, and it is stipulated under section 75. These sections are very important. Apart from these sections, nothing can be asked here, because apart from the sections, it is too direct. Next, we have member. It includes the president and the member of national commission or state commission or district commission, as the case may be. So when we talk about the president of a particular commission, or in general the members or the officials working under any kind of commission, be it district, state or national, they will be termed as member of that particular commission. Okay, for various foras we have four verticals, or you can say four components which are important for us. First of all, consumer protection councils must be there at all the level, center, state as well as district. Next, Central Consumer Protection Authority. What is the basic aim or objective of establishing this particular authority? Authority to regulate the matters relating to violation of rights of customers. Whenever we talk about a regulator, like in the banks we have RBI as our regulator, there also what is the role of RBI? To regulate the entire activities which are going on in the banking sector. Similarly, you have CCPA for the you can say consumers' rights, for protecting their rights. Consumer Disputes Redressal Commission, just now we have seen, again there are three types. First one being the central level, state and district level, and the individuals or the officials of these respective councils will be termed as members of the respective commissions. Then we have consumer mediation cells. So mediation, although it can be done at central level, but the district commission also has certain cells for the mediation process. So when you talk about the consumer mediation cells, these are attached to each redressal commissions and regional benches. These cells try to get the dispute settled through mediation, that no harm should be processed towards the producers, and the resolution must be done at the consumer's end. So the dent in the image of a producer should not be there. That is the essence of mediation. Otherwise, it is not a process which is regularly followed. Fine. So when we talk about this chapter for this particular session, this was it from my side, and the entire chapter of CPA 2019, starting from preamble till the various components, they are very important. Everything is important in this chapter. In module A, there are very limited chapters which hold the importance as such, whatever the topics are written, and unit number 20th, that is CPA 2019, is one of them. So if you are studying on your own, I hope that this particular discussion, whatever we have done, has given you the initial push so that you can complete the chapter on your own also by reading either the Macmillan publication book or whatever notes you have with you. Credit proposal. Supposingly a customer walks in the branch and he or she wants to avail a loan for a specific loan product. Then there are 2 or 3 things which you must ensure, starting off
with the loan documentation. Normally in the branches we see that the bankers, they have already printed a particular format where they have enlisted all those documents which are necessary for a respective loan product. But when I talk about the documentation, is it the only thing which you must focus upon? Answer is no. The reliability of the information which is being provided by the customer, although respected at the bank's level, but when we talk about the purpose of loan, that is also essential. The repayment schedule, what kind of repayment schedule should be there with respect to the individual who has asked for that particular loan. Whether the capacity to repay is right now there with the customer or not. He or she might possess a particular loan document, but whether that particular document should be the only proof or it should be the only ground upon which we should be disbursing the loan amount. All these things you should take care while appraising the loan, while evaluating the loan. Appraisal means what? Starting from the very basic till the actual objective of the task, you have to evaluate everything. Fine. So in effect, when you talk about the English meaning of this word appraisal, the word appraisal is synonymous with assessment, evaluation, judgment, review, as well as consideration. So if you are considering to provide a particular loan amount to the customer, it should have certain basis. Okay. Credit appraisal is the process by which the lender assesses the credit worthiness of the borrower. So borrower might be an individual, might be a business entity, might be partners. All these things have different loan products, and for every loan product we have different kind of appraisal going on. But what are the common grounds in the entire credit profile or the advances portfolio? This chapter will look into that. So when we talk about the simple definition of credit appraisal, its essence is it measures the risk inherent in the proposal, comes to a judgment to sanction or reject. This is the keyword which the bankers must have in their mind while accepting a particular loan proposal. One customer who has already walked in, as we are discussing the same example, the loan documents are there with him or her, and they are very keen to have a particular amount in their account by the end of the day. There can be two situations. One, that particular customer is insisting more. Reason number one, they actually require the money and they actually possess the documents whichever is being required by the bank. Second, although the funds requirement is there, but be very careful whether all the documents which has been produced by the customer are in original or not. Do not just rush into fulfilling the commitments which you have made to the head office in the name of targets. So whether you should accept or reject a particular loan proposal, it is an outcome of what kind of appraisal you have done based on the assessment of information, the applicant as well as the project. So normally when we talk about the applicant, it is the customer, and the project refers to a particular purpose for which the customer is in need of loan amount. Changes in two dimension. When we talk about the appraisal, there are two dimensions to it. Appraising the risk inherent in the proposal, and if the proposal will be acceptable given the risk appetite of the lender. So when we talk about certain banks, they do not offer a loan below a certain amount. Supposingly there are banks in the market, you will find the major commercial banks, scheduled commercial banks, they do not offer personal loan below 2 lakh or 2.5 lakh. That is the limit. What is the reason? Because A, it is not profitable at all. The rate of interest they will be earning on such a small amount will be less as compared to the expenses. And secondly, they doubt the credit worthiness of that customer. That if a particular customer is here in front of the bank, wants to have rupees 2 lakh, rupees 1 lakh in their accounts via loan, then how he or she will be paying it back. So repayment capacity is in doubt for such type of customers. Second, the appraisal or measurement of the quality of the credit. Quality of the credit, again based on the documentation, whether the particular banker is fully satisfied or not, the quality of those, you can say, assets which are at stake of the bank, whether it will be returning back to the bank or not. Next, when we talk about the techniques, there are various techniques via which you can accept or for that matter reject a proposal. Credit appraisal process involves the following steps: borrower identification as well as verification, normally done via KYC. So step 1, all of you who are in the banks holding the advances profile, working in the advances section of a particular branch, you must be knowing that whenever a customer walks in, you ask for KYC, find the Aadhaar card, PAN card from the customer, and then you tend to judge that particular customer's credit worthiness via entering the details in your CIC portal. So the CIC, be it the TransUnion, CIBIL or Equifax, whatever you are using at your branch, it will tell you that what exactly is the credit history of the customer. Assessing the business of the borrower. If the borrower is here for a business loan, then you will assess what kind of capacity that particular business holds, whether the stocks are fully operational, whether those stocks are lying there for time immemorial, let's say for 5 years the stocks are lying there, no demand is there in the market for that particular product, and the business activity is not going on very smoothly. All these things you must be assessing. Understanding the credit requirement. So especially the credit requirement is a task in front of a banker whenever we have business loans. For personal loans, you know the requirement. House loan, you know that yes, the particular customer is here to construct a home, to buy a house for you can say renovation also. But when it comes to the business loans, you are not very certain that what exactly the credit requirement should be for a particular individual who is running a business. So it will depend upon the working capital requirement. It will depend upon various, you can say, previous loans which it has already, the customer or the business entity has already taken. What about the repayment schedule of those loans? Whether the working capital is more than enough to cover up any losses, like that. All these things you should take care. Then we have one due diligence report, that if a particular customer is at risk of defaulting, how quickly he or she will default. A particular history, the credit history provided by the CIC, respective CIC, will tell you that. Selecting the appropriate exposure or the scheme. So when we talk about the customers, all they know, mostly the customers, they are aware about the loan amount. They want a particular amount to be reflected in their account, but they are not aware of the fact that which type of loan product will suit them best. And for that, the customer should be guided, the awareness must be created by the bank. And when you talk about the appropriate exposure or the scheme, it can be what? Term loan, or for that matter overdraft. In some cases, it can be CC limit also, which you must apprise while providing that limit. Not only for the loan amount also. When we talk about the KCC, we have what? It is also a CC limit, na? Kisan credit card. So that particular limit, or for that matter, the earlier loans which used to be for tractor, ATL loans, like finalizing the terms and conditions based on the documents which are required. And once the documents are being fulfilled at the customer's end, you check with your lawyer also, with the bank's empaneled advocate. The valuation report must be there if a particular type of loan like home loan is there, or for that matter, the Tehsil office should be contacted if we are talking about KCC. All these things must be there in your mind while appraising a loan. When I talk about the validation of proposal, so you have taken the documents, you have sufficed whatever is required at banks and to be done, and the customer is also willing to enter into the contract with the bank. Now what? You must validate the proposal. Information provided by the applicant is verified with the supporting documents. Another important modality is field verification, which normally involves what? Pre-sanction, fine, pre-sanction inspection. For personal loans, mostly the employer will be contacted, and when we talk about the business activities, for business loans, the word of mouth floating in the market will be treated as the initial piece of information for the banks. Important part of validation process is verifying all the required approvals, licenses both on record and on display at the premises. So if we talk about business loans, again, the GSTIN, whether it is there or not, what about the balance sheet, consolidated one, income tax return, whether it is there or not, all these modalities must be completed before entering into the contract with the customer. The banker must be sure that the person requesting credit has the authority to request a loan and the legal capacity to sign a loan agreement. Who can enter into a contract or the loan agreement? Who is a major, not minor, fine. So the type of customers, that also you should be understanding, and if you have not attempted any kind of mock tests pertaining to unit number 22, I would like to highlight that in the previous video we have completed unit number 22. So there you will find the types of borrowers as well. If you have not watched that particular video, highly recommended, just go through that video and try to solve the mock tests. Next, when you talk about the credit risk, how it is defined. Credit risk, basically for the bank, it is a type of risk which the bank is taking by providing the funds to the customers and not keeping it with itself. As soon as it is out in the market, whether the funds will be returned to the bank or not, that particular journey from the disbursal till the final you can say reversal of the entire loan amount along with the interest, that entire journey, that entire time entails to the risk which has been taken by the bank. The credit risk is defined as possibility of borrower or counterparty to default. If we talk about that the entire amount plus the rate of interest which has been levied by the banks, it is returned by the customer, then the credit risk is nil. Otherwise, even if for a particular small amount, the credit is at risk. A default event can be triggered by external, internal, or combination of both external as well as internal factors. External factor happened during COVID era. Nobody was able to run their businesses smoothly, so many loans got affected, be it the MSME loans or for that matter the big loans. Internal can be because of the lack of demand or the substandard products being offered by that particular business in the market, or a combination of both as well. Next, when we talk about the risk rating, although we will be having an elaborate discussion about the risk rating in our paid classes, but to summarize, to give you an overview, in this method the credit risk is assessed in the form of rating by assigning the marks to different parameters, evaluating on the basis of threshold, preset, standards, or marks. So asset quality, asset usage, and along with that the assets accessibility, these three clubbed together will give you a particular rating about the credit risk which has been undertaken by the bank. The credit risk rating model assigns grades or marks to the known risk components. Whatever risk is there, certain weightage will be assigned to that, and finally the risk ratings will be available at your disposal. What is the criteria for decision? How the credit rating of the applicant is helpful while deciding whether we should sanction a loan or not. So credit rating score of the applicant is a primary criteria for the decision making. The credit history of the applicant, check if the purpose of the loan fits with the credit policy of the bank and the proposed activity of the borrower is not banned or restricted list of the lending bank. So when we talk about the restriction, unlawful activities, obviously the banks cannot sanction loans for that. The activities defined by the RBI and which are being imposed on all the REs, that is the regulated entities under RBI, fine, such kind of things unacceptable. The lender will also need to check if the sanction of loan will breach any of the concentration limits or not. The salary of a person is 30,000 and he or she is already having loan of worth rupees 3 lakh and you are giving additional 9 lakh. How can it be possible? The basics. When you talk about the aspects of appraisal, first of all, creditworthiness of the borrower via CIBIL. CERSAI comes into play if there is a security interest plus land or immovable properties involved. Registrar will be there. The ROC, registrar of companies, will be one of the party in case of the business loans for companies. RBI defaulters list must be there in your evaluation criteria. CRISIL, not CRISIL, CRILC. Then we have income as well as net worth. So all those registries also in which you have to enter the defaulters list, that particular registry should also be checked by the bank. And when we talk about these registry and all, when you right now when you talk about 2025, the banking software is so advanced that once you enter the PAN and the Aadhaar, it will already being mapped by these registries. So you need not to separately check. Considering the purpose of the loan, working capital, for the purpose of working capital, they require a loan, term loan, or for that matter, P segment. Verifying the cash flows, source of repayment, income source, what about the income from the operations, the business operations per se. Assessing the security or the collateral security, what is the exit option in front of the particular bank. If they think that in long term, this account will be a bad asset and the customer will default, how they will be recovering the money, what about the exit option, all these things must be taken care while doing the appraisal. Okay, so methods of assessment and along with that the elaborate discussion for working capital, capital expenditure, loans for individual housing, vehicle, consumer durables, all these and much more.
The 247 today in the target series, we will be discussing the PPB subject. PPB, as you know, the most bulky one when it comes to JAIIB. And when I talk about the specific unit we will covering today, it will be unit number 25th pertaining to the collaterals. And if you are a banker, since we know that there are various verticals in bank, if you are from the deposits, this particular lecture will serve you good because you will be learning some basics in the loan category. And if you already are working in the advances section, this will add up to your knowledge. So it's a win-win situation for both the categories. So when we talk about the security, why we are talking about security, that must be a question in your mind. Directly, when I say that a loan appraisal process has been done, that is in the unit number 23, what we have read, as soon as a loan proposal arrives at your desk, you will be assessing, you will be evaluating the particular proposal via various documents. And one such important document, or you can say one important entity, will be the security. For the secured loans, you have to recover ultimately the credit which you have disbursed. So what do we mean by security? The bank finance, it is used by the borrowers for creation of some type of asset, either for the business or for the personal use. Whenever we are discussing loan amount, it might pertain to businesses or for that matter personal use of an individual. But what do we mean by security? It is just an asset. Fine. The asset created out of the bank finance as per the normal banking practice is invariably taken as the security. And the asset which is held by the customer, it will be termed as the security. You are creating an asset for a business. You might take a business loan. you are having a particular asset for your personal use, that will be a security for the bank. In case the loan which is being disbursed to you, it fails, you are unable to repay the loan, directly bank can avail the benefit of this security and sell it out and recover the amount. Simply stated, this is the meaning of security. Now, when we talk about the theory, besides often banks call for any other asset owned by the borrower or the third party as a collateral security as well. So, what do we mean by collateral? Basically, you might have heard about this term collateral damage, right? That a particular damage has been created, reason being that you are unable to fulfill the minutes of a contract, and because of that, what is happening, a particular security is at stake, and this security will act as a recovery for the bank. Okay, next, when I talk about the effectiveness of securities, there are various parameters via which we can judge how effective a security is, whatever collateral you have provided to the banks. So the borrower should have good title to the security, mainly when we talk about the land or building, or for that matter machinery as well, plant and machinery. In case of business loans, we talk about the title, that a particular patch of land must belong to the primary holder of the account, primary applicant of a particular loan account. It should be identifiable. You cannot just say that yes, a particular patch of land is there and I do not have the said documents with me, but it belongs to my name. This cannot be entertained by the bank. So document, you must have foolproof documents with you so that banks can also identify that particular security. Security should be easy and freely transferable. Now, when we talk about the major aim why banks want the security, they want the security just to recover their amount. Fine. If they are unable to transfer the property in their name after the recovery process has been initiated, how do you think banks will be recovering this amount? So it must be transferable. It should not have any encumbrance or liability attached. Example, partly paid. Talk about a patch of land. Let's just stick to that example only. You can have the example of shares also, but since we are talking about land only, so let's stick to that. When I talk about a particular patch of land, if already a loan has been disbursed via this land has already been used as a collateral security for XYZ loan, it cannot be attached to another loan in most of the cases. The ownership of the asset should be absolute. It must be established via certain authority also. The particular tehsil office must acknowledge that yes, this patch of land belongs to this XYZ person. The security should be easily marketable. You should be able to sell it. It must make sense when we talk about the selling. Fine, whenever we are trying to sell that particular land, it must make sense, the deal must make sense, and it must be a profitable business for the bank also. Assets without wide price fluctuations are preferable. The constant price is preferred here, no speculation. That is, banks do not entertain any kind of risk. Why do you think so? This is a mechanism added because see, whenever you are disbursing credit, being a credit officer, you have disbursed XYZ loan. Fine. This credit already bears the risk whether this amount, whatever you have disbursed via credit, it will come back to the banking system or not. Additionally, if you are taking a security, a collateral, which is more riskier, then you are just adding the risk involved in that particular loan. The market value should be easily ascertainable. So you should be able to evaluate that what is the actual value of that land. So the valuation report in case of housing loan, it will act as one of the benchmark for the bankers. Plus you can consult some alternate architect also who will prepare the valuation report for you, and you should be certain that yes, this particular patch of land has a marketable value like this. It should be possible to store the security in secured manner in case of pledge particularly. So when we talk about the storage of security, whenever the documents are at stake, it must be in a storable form. Fine. Storage must be there with the bank also, and the form be in a manner of, you can say, paper only. Fine. Paper only, no photocopy, nothing. The original will be considered. Many a times you might have seen that the title deed of a particular land or patch of land is not entertained by the banks, laminated. Fine, because it is hard to evaluate, hard to know what type of paper it is, whether it is the original one or just a photocopy. The security should be durable for a reasonable period of time. So when we talk about the expiry of certain pledges, or for that matter certain documents, that should be ascertained and must be in line with the tenure of the loan. So I hope that the effectiveness of securities, you are able to know that what all points are there and how as a banker you will be evaluating the same. Now, when I talk about the types of securities, these are four. First of all, immovable assets, all those assets which you cannot move. Then we have movable assets, actionable claim, or the financial assets, the specifically shares, fine, the shares which you are keeping as a security. Lastly, we have intangible assets, those assets which we cannot directly touch or feel. These are just the basic English meaning. Let's see one by one what exactly it pertains to. So in case of land and building, when we talk about the most common security which we normally take in the branches as collateral, this type of security is not of self-liquidating nature. That is, since it is held for long term in the same form, it does not get converted into cash during the economic cycle. So when we talk about land and building, how you will be defining it? Obviously, it is an immovable asset, but the conversion to cash, whether it is possible or not in a shorter duration, answer is no, because they are held for a long term. There are various techniques of evaluating whether a particular security is beneficial for the bank or not. And for short-term loan, long-term loan, when we talk about liquidation, all these things evaluated. And specifically in land and building, it is taken care that the particular patch of land is having all these effectiveness into consideration. In the event of bank decides to sell the property for recovering its advance, it needs to do so through the legal process. Fine. Do remember that bank is not the owner of that particular land. So the bankers have to go through the legal route only. And that is the only mechanism available to the bank. What are the advantages of keeping land and building as the security? So the advantage is that its value generally increases with time. Generally, that's a keyword I would say, because sometimes we have seen that some patch of land, their value has decreased over a period of time. But yes, why it is preferred over other form of securities? Because of its value. The you can say future value of a particular land is expected to increase with time. What are the disadvantages? See, disadvantages are huge, and that is the reason why whenever a loan is having patch of land as its collateral, we try to evaluate each and every aspect, be it the value of the land, be it the owner details, be it the details mentioned in the tehsil office or the revenue authority as we know it, or for that matter the disputes involved or not. These are the ground realities which I am telling you. But when we talk about the bookish language, the disadvantage is valuation is at times difficult. Fine, it is difficult to ascertain the exact value. Ascertaining the title of the owner, again, the patch of land actually belongs to him or her or not. Encumbrance attached, whether a particular loan has already been taken from that particular patch of land or not, then in those cases we have the encumbrance certificates as mandatory. It is difficult to realize the security that whether this particular patch of land will be able to cover up for the risk involved in the loan. Creating a charge is costly. It involves two or three parties. First party will be the advocate, then we have the valuation report, so valuer is also involved, plus the revenue authorities as well. Difficulty on account of rent control act. So when we talk about a particular owner whose property we are taking as a collateral, they have this law backing them, which is known as the rent control act, and the rent should be a particular, you can say, benchmark for the value of a particular patch of land. And this again is not a value of the uh, rent which is offered against the land. So disadvantages are huge as compared to advantages, but again, it is the most common one which is used by the bankers. Now, when we talk about the documents which are required to be called for from the mortgager, who is the mortgager? From the particular contract, that is the loan, if you are providing a mortgage, fine, so you will be the bank or the creditor, and the debtor will be the person or the business entity who is having the facility of loan thanks to the credit provided by you. So documents of title, the first document, all the material documents of title like the sale deed, gift deed, will, partition deed, conveying the title to the borrower that yes, this borrower is the actual owner of the land. Parent documents, there might be certain documents, or you can say previous documents related to this title. These are taken for the prescribed period to ascertain the flow of title. Usually banks call for parent documents for 30 years. Fine. So revenue authorities, mostly they have the record, the land record with them. And when we talk about the time duration, it will be 30 years here. Next is encumbrance certificate. As we were looking here, the encumbrance certificate for the encumbrance attachment. This is taken normally for 13 years to see if any encumbrance subsists on the property or not. So 13 years is the time limit. See, IIBF will ask you questions based on the tenure. Like for the parent documents, the banks will call the parent documents for 30 years. When you talk about the encumbrance certificate, it is for the 13 years. Then we have property tax receipts. The tax receipts for property are usually an evidence that the possession of the property is of the proposed mortgager only. Fine. Who is mortgaging his or her land? Okay. So again, it is the debtor. Next, the court permission. If the property offered is standing in the name of a minor, permission of the competent court to encumber the property must be taken. Whenever minor is involved, banks hesitate to provide loan against such collateral, but yes, special permissions must be taken if such type of land is considered for collateral. Search report, if immovable property belongs to a company registered under Companies Act. Always remember, if there is a company registered under the Companies Act 2013, a certificate of registration of charge, which is issued by ROC, that is registrar of company, is required in order to ascertain any charge substituting on the subsisting on the property. So again, search report ensures that there are no additional charges on that particular property which you are giving, which you are having as the collateral by the mortgager. Then we have the lawyer's report, obviously the TIR, as we normally call it, the title investigation report. Normally, the banks take an opinion from their paneled advocate regarding the clear, good, and marketable title of the proposed mortgager over the property. So TIR also has some cost. The advocate will levy certain cost here, and that is the reason why we say that creating a charge is a costly phenomena. Now, when I talk about the valuation of property, how it is done by utilizing the services of recognized valuers who would be either engineers or mostly they are the architects only. Making inquiries with local real estate agents, that is also one of the method via which you can estimate the property's value. But nowadays this inquiry does not have that particular say as compared to the valuation report, because we need concrete evidence that yes, valuation of the property is true, or you can say it is the actual or exact value, and based on this value only you will be providing the loan, so you cannot take risk here. By using the valuation published by the local authorities, this is the most authentic one. Fine, this is the most authentic one when we talk about all the services. Using latest sale transaction of the neighboring properties in order to yourself with an estimate. It will be helpful to have an estimate if you know what was the price of the neighboring properties. Calculations based on the annual rental value. But again, in this annual rental value, your Rent Control Act will be one of the controlling, you can say, enactment, and you won't be able to, gauge the actual number, actual amount of the property's value. Fine. Now, next we talk about the nature of ownership. You must ascertain that whether the property is freehold or leasehold. Freehold means you own the property, the land it's on, as well as the space above the property. It is not that just the land belongs to you, above that the building is somebody's else. And when we talk about the revenue authorities, they do not know about it, nothing like that. Freehold means land, the construction above it, and the space, everything belongs to you. Leasehold, you own the property, but not the land or the building. One thing or the other, somewhere you will be missing the ownership. So freehold land owner is the absolute title holder of the land and is able to deal with it as he likes, whatever he likes, because this freehold land gives him or her the free will. Okay, free will to do whatever he or she wants to do. Leasehold is the one which is taken on the lease for a specific time period. You do not own the land per se, but the building is on lease. Like that, you can remember. So freehold tenure is forever. Leasehold, the tenure is 99 years normally. What are the other aspects which are involved when we talk about the immovable properties? If any advance is granted against the primary security of immovable property, the purpose for which such advances is sanctioned is to be made very, very clear. So the purpose is very important. You should not this particular aspect for granted, because if you do not know exactly what is the purpose, then there is again an inherent risk involved in lending. The mortgage deed must be drafted carefully considering all the legal stipulations. So legal stipulations pertains to what? Your start title, and you must know whether there are any dispute involved or not for this particular property. It must be witnessed by at least two persons. So two persons must be the witness. Simple mortgage attracts ad valorem stamp duty, whatever is applicable. Fine. This is just another form of saying that the applicable stamp duty, which is finalized by the district authorities. To avoid loss of security by fire or natural calamity, it is prudent to insure the buildings, if any, in the property for its full value at the borrower's expense. So insurance for the buildings will be done by the borrower, not you. Okay, that is why you might have seen that in home loan, or for that matter plant and machinery loans, in the branches, once the audit arrives, we tend to deduct these charges, because insurance will be provided, it must be provided in some cases, and the expenses will be borne out by the customer. I hope that most of you must be knowing, being a banker, that documentation starts from
the scratch. Okay, you cannot just say that once the loan has been disbursed, now let's procure the documents, or for that matter, once the account has been opened, now let's see your Aadhaar card. No, that's not how the things will work in a bank. And whatever documents are there, especially for the credit facilities which are being offered by the banks, we will be studying them in the unit number 27. But before that, there are certain enactments, certain regulations which a particular banker must know while processing the documentation for the bank loan, or for that matter other activities. So when I talk about the Indian Contract Act, then we have the Partnership Act, Companies Act, the Indian Registration Act, Limitation Act, and the Indian Stamps Act. They directly affect the documentation process. How? Let's say, for example, in a particular partnership firm, you have procured a document of partnership deed. Okay. Only partnership deed is there with you, nothing else. Now, what is the prescribed format of this partnership deed, which is mentioned in the Partnership Act? If the partnership deed which you have procured is not in the prescribed format, it is of no use for the bank. Okay. And the format will be given where? In the Partnership Act, in the annexures of these Act. Similarly, for a company governed by Companies Act 2013, if the memorandum of association does not have some stipulations as prescribed by the Companies Act, and this MOA has been admitted by a banker, then again it will be of no use. So I hope that you are understanding why these enactments you must study as a banker if you manage such type of activities pertaining to loans, credit facilities, fund and non-fund based facilities, whatever you are being assigned by the bank. What is the need for the documents? Question might arise that we need not to have the entire documents, whatever has been mentioned in the document list by the bank's board policy. But when we study deeply, when we come to know that there are various documents pertaining to a particular type of loan, we would realize the fact and we would appreciate that these documents not only serve as the legitimate, as a legit documents as we know them for the customer, but also they will save us, save our reputation as a banker if in case the entire loan turns into bad asset. So we can directly jump onto the recovery process if documentation is in the proper format. Okay, so first of all, it is to identify the borrower, definitely for the KYC, know your customer obligation. Then identify the security, whatever security is being involved. Supposingly a particular KCC limit has been sanctioned from your bank, but the security or the hypothecation is not properly done. Hypothecation of crops, fine, in case of KCC, is not properly done. And just in case this account becomes NPA, fine. If it becomes NPA, what about recovery process if the hypothecation of the crops is not in the prescribed format, or for that matter it has not been fully realized by the bank? Okay, so there lies the importance of the security. You need to pinpoint, identify the security in and out, not only the land, the address of the land, no, but the value of the land, but also the ownership of that particular land. All those khasra numbers must be there for the KCC loan account. I'm telling you, the khasra numbers must be there, khatoni number must be there, because earlier when we talk about the farm land, it is not as formal. The dimensions of a farmland is not as formal as it is in the urban area. So all those stipulations which are being mentioned by the Tehsil office and acknowledged by the Patwari must be there in the KCC. Fine. So you must identify the security in and out. Then to have a written evidence of the transactions of lending made by the bank, whatever lendings you have made, You must have it documented. To ensure due repayment of the loan by the borrower or the guarantor. So the repayment schedule must be in line with the requirement of the desired loan. To entitle the bank to take legal steps for recovery of the loan in the event of non-payment by the borrower or the guarantor. Fine. Recovery again, being a person from advances section, most of you would appreciate this fact that without proper loan documents, recovery process cannot be fulfilled or completed at all. Then to create a valid and effective security in favor of the bank and to create charge on this security. So how the charge is created, what do we mean by this SI charge? We will be discussing in the documentation chapter only. And if you are new to our channel, you can subscribe to it. That is JAIIB CAIIB English medium, and for bilingual medium, you can subscribe the channel. That is Officers Adda 247. Fine. This is the channel's name. So when we talk about the types of documents, mostly you have the promissory notes, a kind of negotiable instrument, fine, that you promise. A journal agreement is being signed between the creditor as well as the debtor. Next can be bill of exchange in the process of documentation. And where have we read this bill of exchange? Quickly tell me in the comment section whether we have read in PPB or not. In PPB, which module, if you remember? What are the types of bills? How they are being exchanged? Fine. Next, we have the agreements. Now, this does not only mean the loan agreement or the letter of arrangement. No, not only that, but various agreements which has been accomplished by the borrower. Right? The borrower might be having some kind of agreements with other third parties as well. So that must also be disclosed in front of the present creditor. Then we have the forms. What kind of forms? These are prescribed by the banks. Fine. These forms are not being procured by the customer or for the matter the debtor, but whatever is being prescribed by the bank, it will be included in the bank branch only. So from the bank, you can procure this particular form, XYZ form for a particular loan, and then you can approach that particular branch with all the necessary documents. Mostly these forms are for your annual income declaration, right? Annual income declaration. Fine. So now let's see what is the DPN, that is demand promissory note. See, whenever we talk about the P notes or the promissory notes, one thing is common, that a journal agreement is to be accomplished. Fine. A journal agreement is to be accomplished using the promissory notes. So where a fixed period for the repayment of loan is not specified, the bankers take a demand promissory note. Just a journal agreement, nothing specific is there. In DPN, the borrower makes a promise to the banker to repay the loan amount on demand with agreed rate of interest. Okay. And being a banker, what do you think whether this type of loan document should be procured by you or not, or some other alternate measure must be taken? The form of DPN should be in conformity with Section 4 of the NI Act, Negotiable Instrument Act 1881. Right? So the particular forms, whatever the forms are there, supposedly for DPN, they must be in line with whatever has been mentioned in Section 4 of NI Act 1881. Now, direct question can be asked from here, right? Not on the NI Act, but the specific section. So for the DPN, always remember Section 4 of NI Act prescribes a particular format. DPN attracts a stamp duty as per the Indian Stamps Act. Rate of stamp is uniform throughout India. Fine. So while arranging the stamp,
the stamp duty which will be levied is universal across our country. It must be ensured that DPN is duly filled in and stamped before the borrower signs it. So you must fill it in full. Being a banker, you must know what to fill and where. Next, we talk about the agreements which form under the Indian Contract Act. So the form of an agreement should be in conformity with the Indian Contract Act, like for DPN it was Negotiable Instrument Act. The amount of loan, rate of interest, penal interest rate, then percentage of margin, period of repayment, right of the bankers in case of default of loan, details of the securities charged, they are included in the agreement. Always remember, the agreement has all these things. Even if the penal interest rate is not being finalized for a particular product, in your bank's board policy, you will find a reference that yes, for that time period till the penal interest is not formalized for a particular digital product, or for that matter a particular product or service which are being provided at the bank's end, you will have a tentative schedule. Fine. So that tentative penal schedule should be levied once the agreement is signed. The agreements attract a stamp duty as per the Indian Stamp Act also. So Indian Stamp Act, again, it is here also. So stamp is a very important aspect of documentation. And if you want to cover the entire unit, that is unit number 27 with us, and talk about the in and out of your documentation chapter, I would highly recommend you to subscribe our channel. Fine, subscribe our channel. That is, take the paid classes, because there we are covering these topics in detail. Right now on YouTube, you will find the introduction of various chapters. But when I talk about paid classes, you will find the online live lectures in real time. You can ask your doubts as well. Plus, along with that, the coverage of the entire syllabus is exhaustive. So if you are interested to cover the entire unit, do join our paid classes. The rate of stamp duty on the agreements, it varies from state to state. So for the stamp duty on agreements, there is a variation across state. But when I talk about the DPN, the rate of stamp duty on promissory note, it is uniform throughout India. So this is a point of difference which you must keep in your mind. The bankers use different form of agreement depending on the nature of credit facility or the lending arrangement. So you will find good number of agreements for various products. Then we have forms. They are not in the nature of promise or agreement. These are obtained to specify clearly the intention of the borrower. Fine. What is your intention? You must know the intention of your customer. You must ask them directly via these forms. Example, when a payment is to be made out of the loan proceeds to a supplier of goods, a letter from the borrower authorizing the bank to pay the proceeds by means of draft or banker check is taken by means of a form. So for the payments, whatever the proceeds are being provided to the third party by this customer, reason must be specified, and this reason will be specified under the forms. Fine. So forms, they form a very integral part of the entire loan arrangement, and in the documentation also they play an immense role. Next, what is the documentation procedure? So when I talk about the procedure, you will be having a particular list first of all. So selection of correct set of documents, that is the first thing. The list which most of the bankers have for the advances section, as well as for the account opening application as well. Then stamping of the documents acknowledging the authenticity of the documents. Then amount of the stamp duties, then filling of all these forms, whatever the documents are there, executing the documents, fine, providing the actual information, whatever is written in the form. Then we have some legal procedures. Legal procedures are also involved. Keeping documents valid, fine. The documents are valid, that is, they are non-expired, fine. The expiry date is not there. They are still valid. They are not void. Okay. Whosoever is the owner of, let's suppose, XYZ land, that particular owner is the present owner, not the past, not the future, but in actual real time, that is the owner. Safekeeping and preservation of the documents, a particular process which banks find difficult at times thanks to the limited resources. But yes, the most important point. This is the most important point, because even if you tick all the boxes starting from executing the documents till the legal procedures which are involved for a particular document, if you cannot preserve or keep them in a safe, it is of no use, fine. If there is a loss of document, liability lies on the bank. Now let's see the selection of correct set of documents. It should be ensured that correct set of documents is there. When we talk about a particular facility, supposedly term loan is there, then the documents which are required for a term loan must be procured. For a working capital, the list of inventory must be there. Whatever the material is in process, or for that matter, the raw material, the finished goods, everything must be written for a working capital loan. For demand loan, various DL documents must be attached. Okay, so for a particular facility, the specific documents must be carried out. The mode of charge, you must be having hypothecation or the mortgage deed. When I talk about hypothecation, so it is like a collateral over collateral, fine, like the primary collateral. So you are trying to manage the loan using a collateral over the primary security. That is the hypothecation. Mortgage deed, that yes, this particular type of land belongs to XYZ person, and the chain of record will tell us the ownership status, that first the owner was this, then so on. Next, we have the type of borrowers who are using or who are under this set of, you can say, loan. So it can be individual or company. Okay. Next, we have the stamping of documents. Now, this stamping is very important. When I talk about the stamping, it not only means that yes, you are providing a stamp, but an acknowledgement. Let's see. With the examples, you will come to know in a better way. A document shall be stamped in accordance with the Indian Stamp Act amended by the concerned state governments. Fine. So always remember, the Indian Stamp Act will be amended by various states according to their rules. Indian Stamp Act 1888 contains provisions regarding instruments chargeable with duty, mode of using the stamps, time of stamping instruments for instruments executed in India and out of India as well. Now, as per the section 17 of the Act, all the instruments chargeable with duty and executed by any person in India shall be stamped before or at the time of execution, not after. Always remember, stamping of the documents cannot happen afterwards. Although sometimes during audit, you might find these practices that yes, stamping is done at a later stage, but that too for a limited set of, you can say, loans, not for all. For those loans where the property is involved, it cannot be done. As per section 18 of the Act, every instrument other than the bill of exchange and promissory note, which are chargeable with duty and executed out of India, may be stamped within 3 months after it has been first received in India. So for that particular case, except for your bill of exchange and promissory note from foreign, if you have procured it, then 3 months. 3 months is the maximum timeline. As per the section 19 of the Act, the first holder in India of any bill of exchange payable otherwise than on demand or promissory note drawn or made out of India shall affix thereto the proper stamp and cancel the same before he presents the same for acceptance or payment, or endorses or transfers or otherwise negotiates the same in India. So whatever the promissory note or demand loan is there, or for that matter, bill of exchange, all these, if they are being presented by a first holder in our country itself, then the transfer of those, or for that matter, acceptance of those, will be in India only. Section 35 of this act will provide that any person shall not admit an instrument not duly stamped in evidence for any kind of purpose. Fine.
Opening, holding and maintaining foreign currency accounts by a person resident in India is regulated under FAMA. So do remember, FAMA stands for Foreign Exchange Regulation Act, and this was introduced in the year 1999, but it became applicable, okay, or we can say it came into force in the year 2000 year. In the year 2000, it became what? It became effective, but it was introduced in the year 1999. Clear? Now let's move forward and talk about the remaining, that the person resident in India, they can hold foreign currency account abroad for meeting the bona fide business or personal needs. Okay, for meeting bona fide purpose and their personal needs, they can have what? They can have a foreign currency account. Okay, so foreign currency account, person resident in India, they can hold this abroad for meeting their requirements. Okay, so this is how having an account in the foreign currency and maintaining an account in India also allowed to the resident in India, and as well the person who is going abroad, they can also have this account. Now, when we talk about the types of account, what they can have, the first type of account that is permitted to be had, that is first exchange earners foreign currency account, that is EEFC account. This is the first account which is allowed to be have in India in foreign currency. Second, we have RFC account. RFC account stands for resident foreign currency account, RFC account. Third, we have RFCD account, that says for resident foreign currency domestic account. Then we have a diamond dollar account, that is diamond dollar scheme, DD account. Then next we have here these important accounts that we have to cover. Okay, so first account we are going to talk about is EEFC account. EEFC stands for exchange earners foreign currency account. This exchange earner foreign currency account is allowed to be opened by the person in India, the resident, individual resident or corporates which are working in India, they are allowed to have this account. So do remember, exchange earner foreign currency accounts are allowed to be had by the Indian resident, and we can say Indian corporations or Indian corporate. They can have their accounts in India, or we can say any corporate or any person who is resident in India, they can have this account. So I will be writing here individual or corporates resident in India, they can have this account, that is the EEFC account. This account will be opened in form of foreign currency, this account will be in foreign currency account. So I will write FC account, that means foreign currency account. Also, this is the current account type of account, because there will be no interest will be paid in the EEFC account. So this account will be maintained by the persons in a form of current account, so no interest will be paid. Now, EEFC account will be allowed to be opened by only those who earns foreign exchange. If the earning is in foreign currency, then only the person can have the EEFC account. It's not like you are having a EEFC account because you wanted to exchange the currency, you wanted to convert your rupee into dollar or some other currency. No, this account will be maintained by Indian resident, or we can say individuals or corporate resident in India, but if they are earning foreign currency, only those people who are earning foreign currency, they can have this account. Okay, so let's start. So these accounts can be opened by a person resident in India, essentially from foreign exchange earnings. Okay, it will be opened by whom? Those companies who are in India, those individuals who are in India and they are earning foreign currency, they can have this account. Okay, next we have withdrawal in rupees is permitted, but the amount cannot be recredited. You can withdraw the money from this account and you cannot deposit it, like amount in this account will be only deposited from the earning in form of foreign currency. Like if I have withdrawn some amount from this account, and converted it into rupee, I cannot convert that rupee again to the foreign currency and deposit in this account. Because if we allow such kind of transaction, more and more people will be focusing on conversion of currency. They will make their business like that, है ना? Like whenever the foreign exchange is good for India, they will be purchasing the foreign currency, and when they are getting better return, they will sell the foreign currency. So these kind of commercial transaction people will start working. So that's why it have been said that withdrawal in the rupee from the WFC account is allowed, but you cannot recredit by converting the rupee into foreign currency in this account. The amount will be credited in this account only by earning foreign currency. Okay, and this account will be a non-interest bearing account because the current account pattern will be there, type of current account it is. The claim settled in rupees by ECGC. ECGC stand for Export Credit Guarantee Corporation or insurance company. That also cannot be credited here because it is in the rupee. In this account only that payment will be allowed to be deposited, will be allowed to be credited that have been earned in foreign currency, not converted in foreign currency. Okay. Then fund-based, non-fund-based credit facility should not be granted against these balances. So what we are saying here, the fund-based credit facility or non-fund-based credit facility will not be granted against these balances. Fund-based credit facility means the actual loan, when the bank actually gives money to the public, that's a fund-based credit facility. Non-fund-based credit facility simply means the bank guarantee letter of credit where the bank lends their name and do not actually gives money as a loan. That's a non-fund based credit facility. Okay. Apart from that, we can see can be used to repay the packing credit advances in any currency up to actual export made. Next, we are saying it can be, the balance in this account can be used to repay the packing credit advances. Packing credit advances is what? When you are doing export, before exporting, you have to do the packaging and all of the product. And for that, the exporters also take loan. So the packing credit advances in any currency up to actual export made will be also allowed to use from this particular account, or like you can make the payment of that in from this particular account. Okay, so this is the EEFC account. Do remember this account will be in current account form. It will be allowed to open only to the people who are resident in India and earning a foreign currency. Also, apart from that, one more thing is there. You can withdraw money in form of rupee from this account, but you cannot deposit money by converting rupee into any foreign currency in this account. In this account, the deposit of foreign currency will be made when the person actually earns the foreign currency. Only that amount of foreign currency will be allowed to be deposited in this account. Okay, so that's the EEFC account, exchange earner foreign currency account. Now, next type of account, we have a resident foreign currency account, that is RFC account. So you can see a person resident in India is permitted to open a RFC account with an authorized dealer, okay, bank in India, out of foreign exchange received or acquired by him. Okay, so what we are saying, the person resident in India is allowed to open a RFC account with whom? With an authorized dealer bank. Authorized dealer banks are those banks to whom RBI have allowed to perform the foreign exchange transaction. And in India, out of foreign exchange received or acquired by him. So that person can manage the RFC account in India. Also, the other point is that it can have resident relative as a joint holder on a forward or survivor basis, as well as who cannot operate the account during the lifetime of the account holder. So former or survivor basis means what? It means the person who have opened this particular account will be the actual person who will make the transactions or who will operate the account. But if the death of a person happens, then whoever the survivor is, that person will be allowed to manage the account, to operate the account. Okay, so that's a former or survivor condition. Now, the balances in NRE, FCNRB account can be credited to RFC account when the residential status of NRI or PIO changes to resident. So if non-resident Indian or person of Indian origin, they came back to India and they again become the resident of our country, then their NRE account balance, their FCNR account balance will be allowed to be transferred or will be allowed to be credited in the RFCD account. Okay, so these are the points that have been given to the RFCD account. Next type of account we have that was the RFC account. Next type of account we have a RFCD account. RFCD account stands for resident foreign currency domestic account. So a resident individual can open this account, है ना, to retain in a bank account in India the foreign exchange acquired by them. So whatever foreign exchange they are acquiring, they can maintain that particular foreign exchange in India in form of foreign currency. That's a resident individual is allowed to have. Okay. Also, balances in the account can be used for permitted current or capital account transaction. What we are saying, the balances in the account can be what? It can be used for the permitted current or the capital account transaction. The current and capital account transaction or balance of payment we are talking about. So balance of payment is simply is what? It's the systematic record of all the economic transactions between India and rest of the world in one financial year. That transactions will be maintained in two types of account, that is current and capital account. One more account is there, that is a financial account, but that's not in our syllabus. So we have to cover the current and capital account. So whatever the balances in the account can be used for the permitted of current account transaction and capital account transaction. For these purposes, we can use the balance of RFCD account. Okay. And also the account can be opened from foreign exchange acquired in the form of currency, notes, bank notes, and traveler check from overseas sources. Okay, so what we are saying here, we are simply saying that the account will be opened from the foreign exchange acquired in form of foreign notes. If you have acquired the foreign exchange in form of foreign currency note, in form of bank notes, in form of traveler check from the overseas source, then you are allowed to have this particular account. Okay, then you are allowed to have what? Then you are allowed to have this particular account. Okay, so this is the RFCD account we are talking about. Clear? Done. Next. So this is the RFCD account, that is called as a resident foreign currency domestic account. Clear? Now let's move forward. The next type of account we have is a diamond dollar account. Diamond dollar account is also called as a DDA account. That's a diamond dollar account. So first of all, the firms and companies which compile with the eligibility criteria that is stipulated in the foreign trade policy of the government of India, they may open the DDA account. Okay, so what we are saying, DDA is what? Your diamond dollar account. Okay, it stands for your diamond dollar account. So diamond dollar account is simply firms and companies that will be compiling with the eligibility criteria which is stipulated in the foreign trade policy of the government of India, and it may open the DDA account. And DDA account have been asked so many times in the paper. See, whatever types of account we are covering today, they all are very important. Apart from these, we have a NRE account, NRE, NRO, FCNR. These are also important. So all the type of account, EEFC account, your RFC account, your RFCD account, your FCNR account, your NRE account, your NRO account, then your diamond dollar account, these all 6 to 7 types of accounts are very important, and it have been seen every time one or two of these accounts have been asked in the paper. So do remember that. So DDA stand for diamond dollar account. It will be in the form of US dollar currency only. So you can see here, realization of exports, proceeds and local sales in US dollar of rough cut polished diamonds and pre and post shipment finance availed in US dollar can be credited here. Okay, it will be what? It will be credited here. Next we have, so first of all we are saying all the realization of the exports proceed and the local sales that have been done in US dollar currency, whether it is done from the rough cut polished diamonds and post and pre-shipment finance, they all, that is availed in the US dollar currency can be credited in this account. Second is there, payment for purchase of rough cut polished diamond can be made. Okay, if you are purchasing them, then you can make the payment from this account and the funds can be transferred to the rupee account also from the DDA account. Then we have the account should be a non-interest bearing current account. It's also a type of a current account So no interest will be paid in the DD account also. And it will be in US dollar currency only. Do remember that. Okay. As the name suggests, na, diamond dollar account. So it is for the purpose of what? Simply as the name says, it's for the purpose of realization of exports proceed, pre and post shipment finance that have been availed. Second, apart from this, we have a payment for the purchase of rough cut and polished diamonds. And apart from that, no interest earning will be there in this account. So this is a DD account, or we can call it a diamond dollar account. Okay. Now, one more act is there that is very important, Foreign Contribution Regulation Act 2010. So acceptance of contribution from foreign sources and foreign hospitality by certain types of organization like non-governmental organization, political organization, media houses are regulated under this law. So we are talking about what? We are saying the foreign contribution regulation is happening, Act 2010. So the acceptance of contribution from the foreign source and the foreign hospitality by what? By the certain type of organization. It can be a non-governmental organization, political organization, media houses. They are regulated under this act. So it was done to find out that yes, definitely no such kind of corruption is happening. So that's why every transaction which is happening or any kind of contribution that we get from the foreign sources or foreign hospitality will be given to any public servant of anything. So they all comes under the Foreign Contribution Regulation Act. So you can see on the 1st May 2011, the Foreign Contribution Regulation Act 2010 replaced the then existing the Foreign Contribution Act 1976. Okay, that have been replaced. Apart from that, you can see various provisions related to acceptance of the foreign contribution and foreign hospitality are governed by the provision of FCRA and the Foreign Contribution Regulation Rules 2011. So definitely to find out no corruption is there, no such kind of illegal activities there. All the public servants who are going abroad, being there in the foreign country, and any kind of contribution, any kind of donation, if we are getting from the foreign sources, they all will be regulated. To find out that there is no corruption, to find out there is no involvement of terrorist organization. That's why this law will be followed on each and every transaction, each and every remittances. Okay, now next. So this is the foreign currency account we have discussed. Now let's start some practice of this particular topic so that we will know that whatever we have studied is correct. So first of all, residents can hold how many in types of accounts in foreign currency in India? 2, 3, 4 or 5. So how many types of account resident can hold in India? In foreign currency, account will be held in a foreign currency. Do remember that. 2, 3, 4 or 5. So we have just discussed 4 type of accounts can be opened. EEFC, RFC, RFCD and diamond dollar account. Okay, so right answer will be C option. Next question. Foreign currency denominated account maintained in India cannot be in the form of savings account, fixed account, current account or recurring account. In which type of account we cannot have a foreign currency denominated account in India? So you can see in NRE, NRO, that's a Indian currency account, but FCNR is there. FCNR is allowed to have a FD in foreign currency. So definitely FD cannot be true. It is allowed. Now, apart from that, the savings is allowed. EEFC account is a type of current account. So current is allowed, but not the recurring deposit. So foreign currency denominated account maintained in India, it cannot be in the form of RD. It cannot be in the form of recurring deposit. Okay, that have been said. Now, foreign currency denominated account cannot be maintained in India by ship managing agencies in India, Indian company receiving FDI, exporters exporting against the advance payment, or composite insurance broker who cannot maintain the foreign currency denominated account in India. A, B, C or D. So definitely ship managing agencies in India can manage. Indian company who are receiving FDI, they can manage. Composite insurance broker can have, but the exporter who is exporting and he have taken the advance payment, they cannot maintain the foreign currency denominated account. So right answer will be C option. Okay, they cannot have a foreign currency denominated account in India. That's why the right answer is C. Next question is saying which statement is or are incorrect in terms of diamond dollar account, DD account. So first is saying realization of export proceeds and local sales in US dollar of rough cut polished diamond and pre and post shipment. One second. Pre and post shipment finance. Clear? Then he's saying payment for purchase of rough cut polished diamond can be made and funds can be transferred to rupee account. Third is saying the account should be a non-interest bearing account, and they all are correct. Right answer is D option because they all are correct. So the realization of export proceed can be maintained. Your pre and post shipment finance can be credited. Your payment for the purchase of rough cut polished diamonds is allowed, and the payment will be transferred in the rupee account, and also it's a type of current account, so no interest will be paid. Next, which of the following person can open a foreign currency account with the bank outside India for normal business transaction? So which one is correct? First is saying that an authorized dealer in India with its branches, head office, correspondent outside India, a branch outside India of a bank incorporated in India, an Indian shipping or airline company, insurance, reinsurance companies registered with IRDA for insurance, reinsurance business, an Indian firm, company, body, corporate for its foreign office, branch or its representative, an exporter exporting services and engineering goods on deferred payment terms on a turnkey project or a construction contract abroad. So which one is correct here? A, B, C or D. So question is asking which of the following person can open a foreign currency account with a bank outside India for a normal business transaction? And the right answer will be an authorized dealer in India with its branch, head office or correspondent office outside. That's correct. A branch outside India of a bank incorporated in India. Indian shipping or airline company can have. Insurance, reinsurance companies registered with IRDA, they are also allowed. An Indian firm, company, body, corporate for its foreign office or branch is allowed, and as well as the exporter who are exporting services, engineering goods on a deferred payment. Deferred payment means installment payment we are talking about. So they all are allowed to open a foreign currency account, okay, with a bank outside India for the normal business transaction. So right answer will be your D option. All 1 to 6 is correct. Okay. Now, foreign currency denominated account can be maintained by, so this we have done, that is RD. Now, diamond dollar account is scheme DD account. The account should be in non-interest bearing what type of account? So as the name, as the question is suggesting, non-interest bearing account it is. FD got interest, RD got interest, savings account get the interest, but not the current account. So right answer will be C. So first of all, we are going to talk about module A. Module A talks about general banking operation, and today's session is responsibility of a collecting bank. So let's start. Statutory protection to collecting bank. If we talk about, so section 131. Okay, section 131 grants the protection to a collecting banker here, and that's a statutory protection to the collecting banker will be provided, and this is applicable to both the checks as well as the drafts. Okay, this is applicable to both checks and draft, that section 131 grants the protection to the collecting banker against the check as well as the draft, but only when the payment have been done in a due course. Okay, this protection will be there when the payment have been done in a due course. So condition for protection. First, the protection under section 131 is subject to satisfying the following conditions. So first condition is the collecting banker acts in a good faith. Okay, the collecting banker have to act in a good faith while they are making the payment of a check. Second, it acts without negligence. There should be no negligence from the side of a collecting banker while they are processing the check or the demand draft. Okay. Next, third condition, it receives payments for a customer. Okay. The third condition is that the bank should receive payment for a customer. Fourth condition is that the check is crossed generally or especially to the collecting banker. Okay, the fourth condition we have is what? That the check is crossed generally or especially. Cross check means that the drawer of a check have made two parallel lines on the top left of the check. If it's a general crossing, it definitely means the payment will be done in the account, not in a cash. You cannot give a payment of a cross check from the counter. It will be always paid in an account. Okay. Also, if it is especially cross-checked, if it is especially cross-check, or we can say especially crossed check, in that case, a certain bank's name will be written here. It means the payment of that check will only be done in a particular bank. If it is written SBI, then the payment of a check will be done in a SBI bank account only. Okay, so cross check is simply when there are two parallel lines. In the cross check, you cannot endorse the check. You cannot make the payment of a check from the counter. The payment will only be done in the account of a customer. If customer do not have account, so he can endorse. Sorry, in the cross check, he can endorse the check. So I will write here, in cross check, payment will be done in account only. Okay, payment will be done in account only. You cannot give cash from the counter in the cross check. Okay, so if the customer do not have their own account, they can endorse the check to the someone else's name and they can take cash from that person. But in cross check, you cannot provide payment in payment in cash from the counter. You are not allowed, to make the payment to in any situation, in any case, from the counter. The payment will always be made in the account of a customer. And if the customer do not have an account, the customer have an option. He can endorse the check to someone else's account, their friends, their family member, or anyone, and then they can take a cash from them. But cash payment is not allowed. Now, the special check. In a special check or a special crossing, you will find that account pay, SBI or any other bank's name is written. Account pay in the parallel lines, it will be written in a bank name and a account pay. So, if account pay SBI is written, it means the payment will be made only in account. The payment will be made only in SBI bank account. And the payee have to have a self account in SBI. Then only he is able to take the payment of the check. You cannot provide the payment of a check in form of cash from the counter. That's the condition. In any kind of crossing, the payment on a counter is not allowed in form of cash. Okay. But yes, in the special check, payment will be done in the payee's account only in a specified bank account. Second, the payee cannot endorse the check here. Okay, endorsement is not allowed. So self account is mandatory in the same bank which is mentioned in the check. Okay, next. It verifies the prima facie genuineness of the check for collecting payment under its CTS clearance. Okay, so it is very important that the genuineness have been check of the check, have been cross-check of the check for collecting the payment under the CTS clearing. Also, it looks for any fraud, forgery, tampering, that can be verified with a due diligence or ordinary care, and it is apparent on the face of the check to be truncated. So what we are saying, it looks for what? It looks for any kind of fraud or forgery or tampering if happening with a check. It have to be verified. And due diligence. Proper verification, proper due diligence have to be done with the ordinary care, and it is apparent on the face of the check to be truncated. Clear? So simply proper due diligence is required to make the payment of such kind of check. And this is the condition that have been defined under section 31. If the protection under section 31 the customer wants to take, then they have to see, if the collecting banker wants to take, then they have to check the conditions. Okay, now duties of the collecting bank. Now what is the duty of a collecting bank? First, no specific provision has been laid down for the nature of duties for a collecting banker. But definitely section 131 provide protection to the collecting bank, also states certain conditions that include the bank should not have been negligent. So specific provisions are not there. But under section 131, when you are providing the protection to the collecting bank against a check or draft, then a certain conditions have been defined that bank should not negligence it. Okay, if the negligence is from the bank side, definitely no protection will be given to bank. So what is this? First is saying to show that the bank has not been negligent. The bank, it has to prove that it has taken all precautions and care required of a prudent banker in collecting a check. Okay. Next, now what is the duty? Let's say first is duty to open the account with references and sufficient documentary proof. And the first duty is you are allowed to open the account but with the references and sufficient documentary proof. Then only you can open the account, otherwise no. Second, duty to confirm the reference where the referee is not known or has given reference in absentia. The second duty is what? That you have to confirm the reference where the referee is not known to the bank or has been referenced in absentia. In that case, you have a duty to confirm the reference. Next, duty to follow the KYC norms. Under what? Under the Prevention of Money Laundering Act 2002 rules and KYC direction of RBI. So definitely KYC norms have to be checked under PMLA Act and rules and KYC directions given by RBI that have to be checked. Now there is a duty to ensure the crossing and special crossing. Like if check is cross check or if check is a special check, then you have to make sure the condition of cross check and a special check you are following. Okay, that's also important. Next, duty to verify the instrument for any apparent defect in the instrument. Okay, next duty is what? Duty to verify the instrument for any apparent defect in the instrument have to be checked. So these are the duties that have been defined to get the protection by the collecting bank under section 131 of check or draft. Okay, so if any bank, any collecting bank want to take a protection, they have to make sure that they are fulfilling these duties. And if they does, definitely they will get the protection. Okay, now let's start with the certain questions. So unit number 13 and 14, the responsibility of a collecting banker and a paying banker. These are very small units. Okay, so let's start. When a banker receives information that a check for collection is lost, the banker should first inform the drawer, inform the drawee, inform the RBI, exercise due caution while collecting the check. So when a banker receives the information that a check for collection is lost, the banker have to do which of the following thing? What is the responsibility of a banker at that time? A, B, C or D? Okay. So right answer is definitely the banker should exercise the due caution while collecting the check. So right answer is your D option. Okay, right answer is D. Like bank should be properly cautious about it when they're collecting the check. Now, next. Duty to follow the KYC norms under Prevention of Money Laundering Act rules and KYC direction of RBI. Okay. So, under the KYC norm, the identity of the customer is required to be verified by obtaining an official valid document. Where required, the address can be evidenced by obtaining a latest copy of electricity or telephone bill. Then both A and B, and fourth, none of the above. So there is a duty of a bank that they have to follow the KYC norms under Prevention of Money Laundering Act rules and KYC direction of RBI. What does this statement actually means? It means that the identity of the customer is required to be verified by obtaining the official valid document. So there are total 6 official valid documents. And how many official valid documents are there? 6 is there. First, passport is there. Okay. Second, driving license is there. Third, Aadhaar is there. Proof of Aadhaar actually. The proof of Aadhaar is required. Then apart from that, we can say that the letter of National Population Registry. Okay, that is required. Fifth, apart from that, we can say identity, voter identity by Election Commission of India. Okay, and then job card by Narega. Job card by Narega. that is National Rural Employment Guarantee Act. So these are the 6 documents which are counted under the official valid document. So this is very true. Like you can confirm the KYC, you can confirm the customer identification with an official valid document. Second is also true if the address is changed and you have to update the address. You can give any utility bill, in which you actually have the new address. That's also correct. So right answer is C option. Both A and B is correct to fulfill the objective or to fulfill the duty of the KYC norms. Okay, so right answer is C. Next, in the absence of proper KYC document, the collecting banker can be held liable for collection of a fraudulent check on the grounds of negligence, convenience, crime, or arrogance. So, the collecting banker will be liable here, and because they have been negligent in this situation. The KYC documents were not the proper, but still they have the collection of fraudulent check. So that is the negligence from the side of a bank, and in that case bank won't get the protection. Okay, bank won't get the protection. Protection will be given if the due course conditions have been fulfilled. If the payment in the due course have been done, that it will be continuous. Next question. Section 131A of Negotiable Instrument Act extend the protection granted to a banker while receiving payment of a draft, making payment of a check, endorsing payment of a check, or all of the above. So Section 131A of the Negotiable Instrument Act 1881 extends the protection granted to a banker while what? Receiving the payment of a draft. So if the payment of a draft is received by the bank, still he will get the protection. The bank will get the protection. So right answer is A. Now, the condition for collecting bank to claim protection has been laid down under the dash. Indian Contract Act, Banking Regulation Act, Negotiable Instrument Act, Banking Companies Rule. So this is very simple. I guess everybody can answer this. The condition for collecting bank to claim the protection has been laid down under the dash. Definitely Negotiable Instrument Act 1881, Section 131. So right answer is C. Okay. Next, which of the following is not the duty of a collecting banker? Not a duty of a collecting banker. First is saying duty to confirm the reference where the referee is not known or has given reference in absentia. Second, duty to follow the KYC under the Prevention of Money Laundering Act rules and KYC direction of RBI. Duty to ensure crossing and a special crossing. Duty to take action against the forged signature. So which of the following is not a duty of a bank, collecting banker? So this is a duty, this is also a duty, this is also a duty, but not the duty to take action against the forged signature. This D is not correct. So right answer will be D. It's not the duty of a collecting banker. Now, Section 131A of Negotiable Instrument Act extend the protection granted to a banker while that we have done, receiving a payment of a draft that we have done. So this question is repeated. Next, the condition to be satisfied for claiming protection under Sections 131 are: first, the banker should act in good faith and without negligence in receiving the payment. Second, the banker should receive payment for a customer, act as mere agent for collection. Third, the person for whom the banker acts must be his customer. Then all A to D or all A to C actually. So what do you think, which one is correct? So condition to be satisfied for claiming the protection under Section 131. Definitely should be in good faith without the negligence. Receive payment for a customer, and the whom banker acts must be his customer. Definitely. So right answer is D. All A to C are correct. They all are the duties or the conditions. Okay. Next. The protection under Section 131 is subject to satisfying the following conditions. First is saying the collecting banker acts in good faith, it acts negligence, it receives payment for a customer, the check is crossed generally or especially to the collecting bank. Only 1 and 3, only 1, 3 and 4, and 1 to 4. Which one is correct? So collecting banker acts in a good faith. This is one of the conditions. That's true. The collecting banker have to act in a good faith. So this is true. It acts in negligence. No, it should act without negligence. This is wrong. It received payment for a customer. The check is crossed generally for special or especially for to the collecting banker. So right answer is 1, 2, 3 and 4 is correct, but not the second. Hana, second one is wrong. So right answer is C. Next. Consider the following statement in relation to the condition to be satisfied for claiming protection under section 131. Which of the following statement are incorrect? The banker should act in good faith without negligence in receiving payment. The banker should receive payment for a customer, act as mere agent collection. The person for whom the banker acts must be his customer. And the check must be the bearer check. So, only 1, only 2, 2 and 3 and 4th. Which of the following statement is incorrect? So, first is correct. Act in good faith without negligence. Second is correct. Third is correct. But the bearer check is not. So, right answer is only 4. Only 4 is the incorrect one. Okay, because we have just seen the condition. You can see these are the conditions. Should act in a good faith without negligence. Hana. Should receive payment for a customer. Person for whom the banker acts as must be his customer, and the check should be one crossed or specially to the bank. Very first understanding of module A. So these are the total chapters of your module A, 21 chapters, and we are at a 17th unit, that's a customer service guidelines. Okay, till 16th unit we have covered all the chapters. If you haven't seen the recording of that or the session of that, the recording is available on JAIIB CAIIB English Medium channel. You can go and watch that. So let's start. First of all, when we talk about the customer service guidelines, what is it? So, customer service is an act of taking care of the needs of a person by providing and delivering these services in a professional manner. So, because we know banking sector is a service sector which provides services to its customer. So, definitely when you are talking about a service, Hana, when we are talking about this customer service, it actually means taking care of the needs of your customer. Okay, it's a customer-centric business. Banking sector is a customer-centric business. We have to make the customer satisfaction our priority. Then only we can earn the trust of our customers. And banking sector is actually working on a trust. Right. So this is what we are saying, that providing and delivering the services to the customer in a professional manner. So it is expected to be delivered promptly and politely and relates to the service provided before, during and after the relationship is established. So it's not like before the customer, before a person becomes your customer, you are treating him very politely and you are keep asking him or her what they want, what are their needs in the product, what are their needs in the financial system, and you are providing guidance to them, you are helping them out to do the research and everything. But once they have enrolled in your product, once they have opened the account in your bank, after that, you still have to be polite with them. You still have to help them. Okay, so it's a after sale services. It should also be as good as before selling the product. Okay, so that's what we are saying. So, good customer service is best brand ambassador for any bank, because good customer service provides you or helps you to earn the trust of a person. When a person trusts on your bank, they will be doing a good mouth publicity. Okay, that will be doing a good mouth publicity. So, definitely this is your what? Best brand ambassador. So, the banking system in the country has perhaps the largest outreach for delivering of financial services. Clear? Next. The Reserve Bank of India, that's the central bank of our country, it created a 6-member committee which is headed by the Deputy Governor Mr. BP Kanungo at that time to review the customer service standards in entities regulated by RBI in May 2022. Okay, so in May 2022, RBI created a 6-member committee whose chairman was RBI's Deputy Governor, former Deputy Governor Mr. BP Kanungo. Clear? And the committee will evaluate the efficiency, adequacy, quality of customer service in the regulated entity. Regulated entities means the banks, the financial institution to whom RBI is regulating. Okay. So existing RBI guidelines on customer service, identifying the gaps, if any, there is a gap, and suggest the measures to improve the customer services. So this is what the committee will do. It will check that what kind of services a customer is getting. Then it will also check if there is any gap between what you are providing to the customer and what RBI is saying to provide to the customer. If there is any gap, then it is the responsibility of the committee to give the suggestions also, like what should be done next. Now, the committee will also review the evolving needs of the customer service landscape, especially in the context of digital, electronic financial products, as well as distribution landscape, and suggest the suitable regulatory measures also. So, committee will review, analyze, and also suggest some measures that to be adopted to make the customer services best in a bank, so that the customer will be satisfactory and we will be getting a trust. Now we have a customer service organizational framework. So RBI actually emphasized that matters relating to the customer service should be deliberated by the board, the bank board. Every bank have their board, so it should be deliberated by the boards. So boards need to review the customer service aspects in the bank. Okay, all the customer service aspects in a bank have to be reviewed by the bank. Next, so a detailed memorandum should be submitted to Board of Directors once every 6 months. Prescribed institutional setup for the banks will include the Customer Service Committee of the board, the Standing Committee on Customer Service, the Branch Level Customer Service Committee, the Nodal Department Officials for Customer Service. So these are the prescribed institutional setup for the banks that have to be there in every bank. Okay, and the bank board have to be involved in the customer service activities. Okay, bank board have to be involved. Now, so board approved policy on customer services are these. So bank should have under mentioned policies duly approved by their board. Okay, and that are essentially pertaining to customer service, hence should be made known to the customer through the various modes. The customer should be aware about this policy, and the bank should have these policy in every bank that will be made by their board of directors. So what are these policy? The comprehensive deposit policy, the check collection policy, the customer compensation policy, and customer grievance redressal policy. These are the 4 policies which have been authorized to be made by the bank boards. Every bank board have to create these policies and they have to make the awareness about it to their customers as well. Okay, so that the customer don't have to face any kind of problem and they should be aware about their rights. Now, next comes to the ATM operation. So a lot of ATM operations, or we can say customer services, are updated and have been introduced with the penalties also to make sure that the customers are getting right services. So you can see customer services related aspect of ATM operations have gained significant given their spread. So you can see here free transactions at ATM are there. So customers are what? They are eligible to get the 5 free transaction, including financial and non-financial transaction. Financial means you are withdrawing money, you are depositing money. Non-financial means you are checking your balance. You are taking a statement of last 10 transaction. You are changing your PIN. That's a non-financial transaction. So financial, non-financial, both 5 free transactions are there every month from their own bank ATM. Okay, that is called as a on-us transaction. On-us transaction means when you are using your bank's ATM card in the bank's ATM machine only. That's an on-us. Off-us means you are using your bank's ATM card in some other bank's ATM machine. That's an off-us transaction. Okay, now they are also eligible for free transaction inclusive of financial and non-financial from other bank ATMs. That is 3. So in off-us transaction it is 3, but on-us transaction it is 5. And it also changed from the metro and non-metro cities. So 5 transactions are in non-metro, but in metro there are 3 transactions. So do remember, I will explain this again. Same bank ATM if you are using, then 5 transaction in a month, whether it's a metro city or a non-metro city. These 5 free transactions include financial, non-financial, both transaction. Done. Second, if this is a transaction from some other bank's ATM, then 2 conditions come. In metro cities, it is 3 transactions. In non-metro cities, it is 5 transactions. So the first one was on-us transaction, second one was a off-us transaction. Now transaction at ATM, PIN validation for every successive transaction is required. So security concern arise in case of certain types of card readers which facilitate multiple transaction without what? Without the need for the PIN validation for each transaction. So the possibility of fraud or misuse of the card of public is very high. So to eliminate such kind of risk, the process should require PIN validation for every transaction. Okay, like OTP. One-time password should be required, including balance inquiry through ATM. Also, the timeout session should be enabled for all screen and stages. So, if you are using your internet banking, and you left your page of laptop, of computer, of your phone unused, you have not moved your cursor, you have not selected any service in the internet banking or whatever, then after a certain period of time, if you again click on any service, they will show the session is timed out. This is for the security purposes. Let's say, for example, I went to the cyber cafe and I was using my internet banking and I got a call and suddenly I went outside the cafe and start talking because of the network issue, and might be possible someone else who was checking my screen and who knows that I am using my bank account in my in a cyber cafe, they might do some transaction or something there. So that's why it's important that for every kind of transaction OTP will come. For a certain period of time, the session should be timed out. Okay, so these are the security concerns. These are the security measures. Next, lodging of ATM related complaints. So to facilitate lodging complaints related to ATM at all ATM kiosk banks must display the telephone numbers of help desk, contact person of the ATM owing bank to the lodge complaint and seek assistance. Second, the uniform template prescribed by RBI for lodging of complaint related to the ATM transaction. So in every ATM machine, in every ATM center, you will find they have given the toll-free number. So if you actually facing some issue, like if I have done the transaction by myself, after doing everything, the balance is deducted from my account, but I didn't get the cash out from the ATM. Then also I can go and contact. This is 24/7 available, the number which is available on the ATM. Okay, next. Measures to enhance efficiency in ATM operations. So following is steps for efficient ATM operations have been given, like message of non-availability of cash to be displayed before transaction initiation on a screen or any other manner. So it's important, like let's say if I have filled every information of my card, I have a process, hold the transaction process. But when I click PIN and enter the button, it shows that the ATM is cash out. Definitely my time have been wasted there. So if the ATM is cash out, the screen should be representing that message before starting the transaction. To display ATM ID in the ATM premises, definitely. Complaint form with the name and phone number of the official to be available at the ATMs. Then sufficient toll-free number for lodging the complaints and reporting and blocking lost cards should be there. Mobile number, email ID of the customer to be registered to send the alerts. Also to inform the customer the failed transaction complaints must be lodged with the card issuing bank for all the failed transaction. Failed transaction means the amount is deducted from your account but you didn't get the cash. Okay. Now, a scheme of penalty for non-replenishment of ATM. This is introduced newly. So banks or white label ATMs, they should have a robo system for availability of cash in ATM with a timely replenishment. Replenishment means if the ATM is cash out, you should immediately fill the cash in that. So cash out at any ATM of more than 10 hours in a month attract a flat penalty of 10,000 per ATM. In case of white label ATMs, the penalty is charged to the bank meeting the cash requirement and of that white label ATM. So bank may recover the penalty from the white label ATM. So what is white label ATM operators? What is white label ATM? The ATM provided by non-banking entities. Okay, the ATM provided by non-banking entities are called as a white label ATM. Like a IndiCash ATM. It's the first white label ATM of our country provided by Tata. okay, like Hitachi ATM. So they are the non-bank entities who are providing us the ATM. So they are getting a cash management from the bank, particular bank they have tie up with. So the penalty will be sent to the bank and bank have to pay the penalty to RBI. But bank will recover the penalty from the white label ATM operator, like from the Tata, in case of IndiCash. Now, dispute regarding ATM failed transaction. These shall be settled by issuing bank and acquiring bank through the ATM system provider only. So, no bilateral settlement arrangement outside the dispute resolution mechanism of the system provider is permissible here. And this is meant to avoid the dispute between the issuing and acquiring bank in payment of the compensation. Okay. So, these are the certain ATM operation related transaction we're talking about. So, reconciliation of transaction and ATM failure time limit. So, RBI has advised that banks to resolve the customer complaint regarding wrongful debit on the account of ATM transaction within how many days? T plus 5 working day. T means the transaction day plus 5 day. And these 5 days should be working day. In between, let's say 15 August came. So, that's not a working day. So, that won't be counted. Okay. So, receipts of customer complaint, in case of the delay, the card issuing bank must compensate the customer 100 rupees per day of delay. If it is 10 days delay, then they have to pay the 1000 rupee. So, this amount shall be credited to the customer's account automatically without any claim form from the customer. Okay. So, these are the ATM operation transactions that we have discussed related to customer service activities will be performed in that case. Okay, so what kind of customer service activities will be performed in these cases that have been informed here. Clear? Let me know if you have any doubt. Okay, next. So let's practice some questions. First question is talking about business hour of bank branches. How many hours are there? Are fixed by RBI at the time of granting permission for the branch. Are as fixed by the concerned bank without any restriction. Are as fixed by the district consultative committee. Must be minimum 4 hours on all weekdays and working Saturdays. So, how many days is it? It should be minimum 4 hours all weekdays and the working Saturday. So, right answer will be D option. Okay, the right answer we have is a D option. Minimum 4 hours should be there in all weekdays and on all Saturdays. Sorry, on working Saturday because second and fourth Saturday is off of a bank. Okay, next. Customer compensation policy provides for payment of compensation to the customer for delay in what? Delay in opening of a savings account, delay in issuing a duplicate draft, delay in issuing a checkbook, delay in filing up the passbook. Sorry. So, in which case customer compensation policy of a board, will be providing compensation to the customer. Definitely issuing a duplicate draft. So, right answer will be your B option, issuing a duplicate draft. If the bank does a delay in that, definitely bank have to pay the compensation. Banks are required to have a customer service committee at every what? Branch, regional office, your department at its head office or none of the above. So, it's a customer service committee. As the name suggests, where are the customer? In a bank, where are the customers? Customers are at the branch level. So, definitely at branch level, the committee should be there. For resolution of disputes related to ATM transaction, first, banks can have bilateral settlement arrangement. Second, issuing bank will be solely liable for any loss to the customer. Third, acquiring bank will be solely liable for any loss to the customer. Settlement will be through the ATM service provider only. So, what do you think? Which one is correct here? What do you think? Which one is correct here? For resolution dispute related to ATM. A, B, C or D? Okay, so definitely resolution dispute related to bank's ATM transaction will be, settlement will be through the ATM service provider only. Hana, so right answer will be your D option. For online card not present transaction, the authentication process is same as that for card transaction done on POS or ATM. Requires digital signature of the card holder, requires an additional factor of authentication based on information not available on the card, requires a second level password also. So which one is correct here? A, B, C or D? Which one is correct here? Okay. So definitely when we are talking about online card not present transaction, the authentication process is what? An additional factor of authentication based on the information not available on the card. That is actually the OTP. Hana, like the information which is not available on the card, that authentication have to be taken. So right answer is C. If we talk about the introduction of this act, you can see that the Right to Information Act in 2005 that came was enacted with the intent to provide for setting out the practical regime for citizens to get information under the control of public authorities in order to promote transparency and accountability in the working of every public authority. So to bring the accountancy, or we can say transparency in the public authority working, we have brought the RTI. Okay, that is Right to Information Act. Because this Right to Information Act gives us the right that we can ask questions to the government, to the public authority about any query or any doubt we have. And the public authority have to provide that information to us under a certain rules and regulations, certain conditions. It's not like every information we are asking we will get. If that information is related to nation security or something kind of serious issues, then the public authority have a right to deny to provide the information about it. But the rest will be provided to the customer. Okay, so we have a right to ask question to our public authorities under the Right to Information Act 2005. Okay. So when you know you are accountable to someone, like when you know that someone can come one day and ask you a question that creates your accountability to answer the question, then somehow the working will be better. Okay, so that's what we are applying in the public authority also. So the act aims at containing corruption and holding the governments and their instrumentalists accountable to the governed by providing access to the information. So act contains what? The act aims at containing the corruption and holding the governments as well as their instrumentalists accountable for what? For any kind of miswork. Okay. So it will be governed by providing access to the information to the customer when they are asking for it. So they will become accountable to provide the right information and to make sure that no misuse of public authority will be done. Now, the act also creates machinery for ensuring effective implementation of the act. Okay, it's not like this only available in the papers that this is the act. They also make sure that implementation of this act is also going on. Like if anybody is asking for any information, that is provided to them. So the act has application to those banks and financial institutions that will come under the purview of public authority as defined in the act. Okay, so under this act, the application of this act will be on the banks and financial institutions also. What type of banks and financial institution? The one which comes under the purview of public authority. Okay, now on coming into force of this act, the Freedom of Information Act 2002 has been repealed. Okay, so when we are saying that this act came into force in 2005, so the Freedom of Information Act 2002 has been repealed. Okay, now next comes to applicability, where this act is applicable. So first of all, this act extends to the whole of India. Okay, and next is all public sector banks and other institutions owned and controlled by the government are the public authorities and are required to comply with the provisions of RTI Act 2005. So simply, act is applicable to whole of India and all public sector banks and other institutions which are owned and controlled by the government. They are public authorities and they are required to comply with the provisions of the act. Okay, so do remember, the public sector banks, they comes under the public authorities. Now RTI provides for exemption from the disclosure of certain information, as I have told you earlier, that include commercial confidence trade secret that would harm the competitive position of a third party, unless the competent authority is satisfied that the larger public interest warrants the disclosure of such information. Like it's like similar condition. When we talk about banks, banks have a duty of maintaining secrecy and confidentiality about their customer information. But in some cases, in some exceptional cases, banks are allowed to share the information of their customer with the public. Okay, whether it have been asked by a government officer or any authority, public authority, or if the court have given the order to give the information, or if that information is in the context or in the interest of the public, then bank disclose the information of their customer after having a duty of maintaining secrecy and confidentiality. Still the bank does the same. So same applicable on the act also. If it is harmful in any manner to the country or the parties involved in the contract, then those information won't be disclosed, otherwise it will be disclosed. Okay, so since the third party includes a public authority, the exemption is available to the banks if the disclosure of information is likely to harm the competitive position of the bank itself. Okay, so banks are also got the exception ki if providing this information actually harms you being a competitor, being in a competitive position, then you don't have to share the information. Okay, now the act exempts disclosure of personal information which has no relation to the any public activity or interest, or which would cause unwarranted invasion of the privacy of the individual. Okay, so simply we have said that the act does what? It exempts the disclosure of personal information, okay, which has no relation to any kind of public activity or the interest. So these are the conditions or disclosure situation or applicability situation have been added in the RTI Act. Now you can see right to information, section 3 says that subject to the provision of this act, all citizens shall have the right to information. So thus the right to information is conferred upon the citizen of India. Okay, so section 3 of RTI Act 2005 says, it says that subject to the provision of this act, all the citizens shall have the right to information. Okay, all the citizens should have what? The right to information. Now, so we keep talking about public authority. Now, what is public authority? So you can see any authority or body or institution of self-government established, that is a public authority. Public authority means any kind of body, any kind of institution, any kind of authority which have been introduced or established or built by the government itself. That's a public authority. Like in the public sector bank, we talks about SBI and nationalized bank differently. So SBI is the kind of bank which is the self-government established, and nationalized banks are those banks which have been converted into a public sector banks by purchasing the private bank, right? So public authority simply means which have been a self-government established. So you can see how by or under the constitution, okay, that established under any constitution, then by or any other law made by the parliament, okay, that institution or that body have been established by any other law that have been made by parliament, then by any other law made by the state legislature, then by notification issued or order made by the appropriate government, and includes any of these that have body owned, controlled or substantially financed on government organizations, substantially financed directly or indirectly by funds provided by the appropriate authority or the government. So any kind of body, any kind of institution which have been established by the government in these conditions, they call as a public authority. Okay, and that's not it. Next we have here records. Hana, their record should include any document, manuscript and file, any microfilm and facsimile copy of the document, any reproduction of image or image embodied in such microfilm, whether enlarged or not, any other material produced by the computer or any other device, that records have to be included, Hana, of being the established. Now, right to information, the right to information accessible under this act, which is held by or under the control of any public authority, and it includes the right first to inspection of work, document or record. Okay, it gives the authority that the inspection of the work, inspection of the documents, inspection of the record can be done. Then it also gives the right to take notes, extract or certified copies of documents or records. It also gives right to taking the certified samples of material. It also gives right to obtaining the information in the form of discs, floppies, tapes, video cassettes, or in any other electronic mode, or through the printouts where such information is stored in computer or in other device. Okay, so these rights are there with the public to the public. Okay, so that these will be allowed in case of request of the customer. Now, the third party we're talking about, a person other than the citizen making a request, right, for information and includes a public authority. Third party means what party? That means a person who is other than the citizen and making a request for the information, and it includes a public authority. That's the third party. Okay, under the transaction. So this is how the Right to Information Act gives the right of asking questions about any decision or action of the government or the public authority in written form. Okay, and the government will provide that information. There is a time period, like in with how many duration they have to provide the information. And if they have not provided the information to the customer within a specified time period, they have to pay the penalty as well to the public, right? And they definitely, if you're filing RTI for any information, you have to give the fee as well. It's very nominal. And if under the RTI such information is not allowed to be disclosed, then they will simply say no to your application, no to your request. Okay, so these are the things which are allowed and will be performed under this act. Okay, next. First, public authority means what? First is saying an authority established by the government, an authority established by law, a non-government organization, any authority or body or institution of self-government established or constituted by or under the constitution by any other law made by parliament, by any other law made by state legislature, by notification issued or order made by the appropriate government. So what do you think? Who will be called as a public authority? A, B, C or D? And the right answer will be definitely the D. Okay, right answer will be D. Like, who is public authority? The option number D gives the right definition of public authority. Next we have right to information means the right to what? Right to inspection of work, document and records, taking notes, extract or certified copies of documents or records, taking certified samples of materials, all of the above, and obtaining information in the form of diskettes, floppies, etc. of information is stored in a computer or any other device. So what will be the right answer? Definitely all of the above and the remaining. So again the right answer will be your D option. Introduction is saying that one of the prime function of a banker is lending money. Okay, one of the prime function of a banker is what? Providing loan or lending money. So the banker while lending should follow sound principles of lending and should assess the permissible limits of finance on the basis of accepted norms. So definitely when a bank is providing loan to its customer, it's the responsibility of the bank to cross-check the principles of lending. Are you following the rules, regulation, norms related to lending or not? That have to be confirmed. And next is, in its business of lending money, a banker shall acquaint himself with various laws governing the different types of borrowers. Okay, so when the banker is providing loan to a customer, they have to make sure that they are following the loan to the related customer. Because the borrowers, the types of borrower, unlimited types of borrowers we have. So while providing the loan, we have to check that we are providing the loan on the basis of the type of borrower laws. You can see the advanced portfolio of bank indicates its dynamic personality, definitely. Okay. Now next we have cardinal principles of lending. These are very important. Okay, whenever a banker is providing loan to the customer, they have to go through these cardinal principles of lending. So first of all, the business of lending is not without certain inherent risk. Every type of loan that bank provides to the customer, it includes risk. Whether a bank is providing loan to me or whether a bank is providing loan to Mr. Ambani, in both the cases, a normal risk of default will be there. Doesn't matter to whom bank is providing loan. In every case of loan, there is an inherent risk or a minimum or a normal risk of default is there. Okay, so especially when the lending banks depend largely on the borrowed funds, the cardinal principles of lending are first, safety, second, liquidity, third, profitability, fourth, purpose, fifth, diversification of risk, and the sixth is security. Okay, so safety, liquidity, profitability, purpose, diversification of risk and security. These are the cardinal principle of a bank that a bank cardinal principle of lending that a bank have to follow while providing the loan to their customer. Okay, they have to take care of the safety of their funds. They have to maintain the liquidity so that asset liability mismatch would not appear in a bank. Profitability, they have to check that how much they will be earning out of this. The purpose of loan, the diversification of risk, as well as the security. These all are the cardinal principles of lending that have to be followed by a bank while they are providing loan to a customer. Okay. Now, apart from that, we also have a 7 C's of credit. So it is another conceptual framework used by the financial institution and the non-bank lenders to evaluate the credit worthiness of a borrower. Okay, so 7 C's of credit is simply help out the bank and financial institution to find out the credit worthiness of a borrower, as well as they also find out the strength of an overall borrowing request. Okay, so what are these 7 C's? These are the 7 C's. The character, capacity, capital, collateral, conditions, cash flow, and credit worthiness. These are the 7 C's of credit which help the bank or financial institution to find out that to whatever customer we are providing loan, is that customer have a good credit worthiness or a good credit history, or that customer whatever borrowing request he or she has given us, are they capable of making the payment in the future, like they have such kind of a strength that they will be able to repay our money. So that will be checked from the 7 C's of credit by knowing the character, capacity, capital, collateral, condition, cash flow, and the credit worthiness of a borrower. Okay, so these are the 7 C's of credit. That is very important. This have been asked in the paper earlier as well. Now the types of borrower, multiple types of borrowers are there, and in every case of type of borrower, the different kind of laws will be applicable. Different rules, regulation, norms or documentation have to be taken while providing the loan. So you can see various borrowers can be classified as an individual. Individual includes the minor, individual also includes the joint account, the savings account, they will be covered in here. Now proprietorship form, then we have partnership form, then we have Hindu undivided family, we have companies, we have a statutory corporation, we have trust and cooperative society, and we have limited liability partnership. So the types of borrowers have been classified in 8 categories. On the basis of their categories, on the basis of their types, they will be defined in the types of borrower category. Okay, and every case will have a different rules, regulation, and the documentation or security required will depend on the type of borrower as well. Clear? So we have seen what is the cardinal principle of lending, we have seen the 7 C's of credit, and we have seen the types of borrowers. Okay, the types of borrower we have to cover in detail as well. Okay, but I'm not going to be detail. I'm not going in a detail in this session. We will be discussing the basic idea of the whole chapter. Okay. Now we have a type of credit facility. So definitely bank provide credit to the customer, and there are some type of credits which actually let the bank give the money to the people. Like this is a one type of credit facility in which bank actually give the loan to the customer. And there is another type of credit facility in which bank do not have to provide a credit to the customer. They simply lend their name to the customer to take a funding. Okay. So first of all, types of credit facility includes 2 types, that is fund-based credit facility and non-fund-based credit facility. I guess this is very basic and everybody is aware about this. The fund-based credit facility simply means such kind of credit facility in which bank actually giving money to the customer in form of loan. Right, and the non-fund based credit facility simply means the type of credit facility in which bank is not providing the hard cash as a loan. Bank is saying the fund based credit facility, these involves what? These involves the outflow of funds. So thereby the money of the banker is lent to the customer. Okay, so they can be generally of following types, like you can see the cash credit and overdraft, the term loan and demand loans, the bill finance. They all are the types of fund-based credit facility in which actually the money will be given to the customer by the bank. That's a fund-based credit facility. That's simple. Okay, that's what? That's a fund-based credit facility that will be provided to a customer. Now, next we have a non-fund-based credit facility. So, non-fund-based credit facility, in this the bank's funds are not directly lent to the customer. Okay, bank is not giving money, bank is not giving capital, but bank guarantee, letter of credit, acceptance facility, these are the non-fund based credit facility. So in the bank guarantee, in the letter of credit, bank is actually providing what? The bank is actually providing their name to the customer so that they will be able to raise money from the market. So they are lending their name only here, not the funds. Okay, so the most common method adopted by the banks is to saturate the loan portfolio based on the customer segment into the retail loans or the commercial loans. Okay, so simply most common method have been adopted by banks that they saturate. Saturate means they divide the loan portfolio based on the customer. Like what segment of customer is taking loan from the bank, accordingly they will divide the category of a loan that you can see retail loan and commercial loan. So retail loan, simply individuals are taking loan, that's a part of retail loan. Commercial, when the business entities, partnership firms, limited liability firms are taking loan, that's a commercial loan. Okay, next, concept of working capital. Next we have what? Next we have a concept of working capital. So the term working capital, I guess everybody is aware about the working capital. Every business requires a working capital, money by a manufacturing enterprise for financing of its day-to-day requirements. Okay, every business have their day-to-day requirement, and to use the capital in that requirement will be called as a working capital. So you can see, to purchase the raw material, stores or spares, payment of the wages to the employee, then payment of other expenses towards energy, fuel, water consumption, statutory dues, rates, taxes, carriage expenses, etc. Then other expenses required to be incurred in connection with the production, selling and administration, etc. So all of these are what? They are the day-to-day payment requirement of a manufacturing firm. Like on a daily basis, they have to pay a certain amount of money to purchase the raw material. They have to pay wages to their customer. Okay, apart from that, we can say that they have to pay taxes, duties, water consumption, fuel, energy expenses on a daily basis. And when the company goes to the bank and asking for a loan for day-to-day requirement purposes, that will be called as a working capital loan. Okay, so operating cycle of every business refers to the time it takes a company to buy goods, sell them and receive cash from the sale of said goods. Or we can say from purchasing the raw material, okay, till selling goods and services, whatever, and getting payment. So this process, whatever goes through in between this process, is called as an operating cycle. Okay, so simply, in other words, it denotes the time taken for a company to turn its inventories into cash. Inventories means their products they have converted into cash by getting a payment. So this whole process is called as an operating cycle. Okay, it might be of 6 months, 1 year, 2 years, 3 years, depends how much time it takes to convert the raw material into finished goods and then sell to the customer. Okay, so starting from the purchase of raw material till getting money from the customer after selling the finished goods, this whole duration is called as the operating cycle. Okay, this whole duration will be called as what? The operating cycle. Next we also have one type of lending, that is bill finance. So you can see here, that's a part of your credit facility, right? So bill finance is also one of the important facets of lending by banks for working capital purpose, and this facility finances directly the receivables of the borrower on individual sale transaction basis. I guess in PPB you have heard about factoring, forfeiting, right? They are the ways by which the borrower actually, or we can say the person who have sold the goods actually goes to the bank by taking their trade receivables, shows those trade receivables to the bank and asks them to give them the immediate cash. So on those trade receivables, bank provide the immediate cash to the seller, right? Similarly, bill finance is there. It's also the same kind of way. The bank actually finances the receivables of the borrower, of whatever individual sale transaction happened between the two, that will be financed by the bank. Next, generally the bill finance is conducted through discounting of bills of exchange drawn by the borrower or third person on the customer of borrower. So the loan extended to the borrower is liquidated when the buyer of the borrower pays the discounted bill. Okay, what we are saying here, generally the bill finance is what? It is conducted through discounting of bills of exchange which is drawn by the borrower, and it can be drawn by the third party or third person of the customer borrower. So simply the loan extended to the borrower is liquidated when the buyer borrows pays the discounted bill. So simply it is a self-liquidating type of facility that bank provide to the customer, and where the bill finance facility is granted to a borrower, the amount of cash credit facility is lower because the letter in that case is only in respect of the stocks. So simply when the bank finances the bill of a customer, that's called as a bill finance. Okay, so methods of bill finance depending upon the payment obligation, they are this type. The first, bill discounting. You can call it bill discounting, you can call it bill purchase, you can call it advance against bills for collection, you can call it a drawee bill acceptance, or you can call it a bills co-acceptance. They all are the ways of bill finance, and I guess every one of you is very much aware about this bill discounting. Very common term used in a banking sector, in a banking business. Okay, so whenever a bank finances the bill of a customer and the customer gets immediate cash on that, that's a bill finance, or you can call it a bill discounting, or any of them. Okay, so these are the type of credit facility. Now you can see credit facilities are mainly classified into fund-based and non-fund based, that we have seen that fund-based covers cash credit, overdraft, bill finance, term loan. Okay, and the non-fund based facility, among other things, they include bank guarantee, letter of credit will be covered. There are several aspects which are related to the management of lending, business of loans. So definitely when bank is providing loan to the public, there are a lot of aspects which are related to the management of those loans, or management of those lending businesses. So simply these range from interest rate to be charged on a various types of loan. Deciding what rate of interest should be charged on a particular type of loan is also one of the biggest task in the banking sector, because to decide interest rate we have to go through the costing of the loan, then processing of loan application, then recovery of loan extended, then monitoring of advances and loan portfolio. We have to go through all of these decisions while providing loan to the public. Okay, next, these aspects are connected with the day-to-day activity of assets related functions in bank. Okay, so definitely how much interest rate will be charged, what will be the processing of loan application, when the recovery of loan will be given, extension will be given, and how to monitor the advances, it all are related to the day-to-day working of a bank or the day-to-day activity of a bank. So it is important to understand various issues which are connected with these aspects for proper management of the lending operations. Okay, that's what we are going to talk in today's session. Chalo, let's continue. Now, interest rates on loan. Next, we have what? Interest rates on loan. So first of all, when a bank provide loan to the public, the first rate of interest they started charging from public was prime lending rate. In prime lending rate, we have seen a lot of partiality was there. So that's why prime lending rate was replaced by benchmark prime lending rate. And then this benchmark prime lending rate was replaced by the base rate. Then this base rate replaced by marginal cost of fund based lending rate, that is called as MCLR. Then this MCLR replaced by external benchmark lending rate, and then we got repo linked lending rate. So this is how the lending rate that is charged, or the interest rate that is charged by banks from the public, have been changed, right? So you can see prime lending rate, benchmark prime lending rate, base rate, MCLR, EBLR, and now we have a repo linked lending rate. So this is how the interest rate on loans have been changed, which is charged by the commercial bank from the public. So after interest rate to be charged by banks on advances were deregulated, normative regulations were issued by RBI, which contain the basic principles for the framework to determine the interest rate for various loan products. Okay, now these regulations have over the period undergone several changes. Now all these regulations have what? They have gone through the several changes. Now the first we are talking about here, the initial approach was based on the prime lending rate as an internal benchmark. I told you, the first interest rate that have been charged was the prime lending rate. Then came the base rate. Before base rate, we also came up with the benchmark prime lending rate. So prime lending rate, benchmark prime lending rate, and then came the base rate. Now, this was further modified to adopt the marginal cost of fund based lending rate. Okay, after that we got MCLR, that's the internal benchmark for the banking sector to be charged. Then this was further modified to encourage switching over to external benchmark. So it became EBLR, external benchmark lending rate. Okay, and then it have been introduced, that is repo linked lending rate. So do remember this: prime lending rate, benchmark prime lending rate, base rate, then MCLR, then EBLR, then RLLR. Okay, do remember all of these. Now the base rate system. First of all, the Reserve Bank Working Group on Benchmark Prime Lending Rate, that chairman was Mr. Deepak Mohanty. They reviewed the benchmark prime lending rate system and suggested the changes to make credit pricing more transparent. Because in prime lending rate, in benchmark prime lending rate, there was no transparency or a very little bit transparency, and there used to be a lot of what we can say, there used to be the partiality at the time of providing loan to the public. So that's why they have made the committee and have discussed that how to change these issues or how to convert them. Okay, next. So moreover, the calculation of benchmark prime lending rate were mostly not transparent, and banks were frequently lending below the benchmark prime lending rate to the prime borrowers. Right, so benchmark prime lending rate have been given, the calculation have been given, but still banks were focusing on what? On paying a little less interest rate or charging a little less interest rate from the prime borrowers, and also under pressure due to various reasons. Okay, so this used to happen. So the base rate system was introduced. So based on the committee's recommendation, the base rate system replaced the BPLR system with effect from 1st July 2010. Do remember this: benchmark prime lending rate have been replaced and base rate system was introduced from 1st July 2010. So base rate included those elements of lending rates that were common across all categories of borrowers. So it will be same for all the borrowers. Doesn't matter who is the prime borrower, who is not. Okay. Then after base rate, we have introduced the MCLR. It stands for marginal cost of fund based lending rate. So in December 2015, RBI reviewed the norms for determination of base rate and introduced marginal cost of fund based lending rate. That is MCLR. So MCLR would serves as the internal benchmark for pricing all rupee loan and limit. Okay, so whatever loan the banks are providing to the customer, they will be charged on the basis of internal benchmark rate, that will be MCLR, in which a proper formula, a proper costing capitals have been given to the banks. Every bank will calculate that formula and then will tell that what interest rate they have to charge from the public. So in March 2016, Master Direction of RBI in 2016 was issued. Okay, in 2016, RBI have given the Master Direction, and by this direction, the provision of this direction apply to whom? To scheduled commercial bank, excluding RRB, a small finance bank and local area bank. So it have been said that all the scheduled commercial bank, all small finance bank, all the local area bank, they will follow the MCLR now, excluding RRBs. RRBs have been not added in 2016 for the MCLR, but rest other banks have been added. Why there is no name of payment bank if there is a small finance bank? Because payment banks are not allowed to give loan to the public, right? That's why. So in 2016, it was applicable to all banks except RRB. These directions are not applicable to operations of foreign branches of Indian Bank, right? So it is not allowed to the foreign branches of Indian Bank. It means the Indian banks who are working overseas, they won't follow this regulation of MCLR. Now, the credit management process have been introduced. So the credit management is simply what? It's a process of managing, or we can say It's a process of appraising and sanctioning the loans and monitoring the account for recovery with the view to increase revenue of banks and financial institutions. Okay, so what we are saying, the credit management is what? It's simply a process of appraising and sanctioning the loan. Okay, and also at the same time monitoring the account of a customer for the recovery purpose with a view to increase the revenue of a bank and financial institution. So that's a credit management. Like whatever loan they are providing to the customer, the management of that will be done in the credit management. So the expression credit, it refers to the short-term loan and advances as well as to medium-term loan, long-term loan, off-balance sheet transaction. So credit means simply providing loan, right? So management includes within its preview pre-sanction appraisal, sanction documentations, disbursement, post-lending supervision and control. All of these activity will be covered in the credit management. So in credit management, first we will preview the application, then pre-sanction appraisal will be given, then the amount will be sanctioned, documentation, disbursement, post-lending supervision on the customer, and the control will be continued in the management. Okay, so before and after providing the loan, the supervision will continue. Now, in the highly competitive and deregulated environment, banks and financial institutions have to evolve better system and procedure to manage the credit needs of their highly demanding customer, particularly those which are corporate and retail sector. Okay, so we are saying now the market is very competitive. Everybody is ready to give the loan. Everybody is there who are ready to give the loan with the minimum rules, regulation and rate of interest and the conditions. So it's very important for the banks and financial institution to have evolve a better system and the procedure to manage the needs of their customer related to credit. Okay, so next, the developments of the past decade have totally changed the credit management perspective in banks. Okay, so whatever development happened in a certain years, it actually changed the perspective. Now, the term credit management encompasses the following activities. First, capital adequacy norms. In the credit management, you have to check the capital adequacy norms have been followed or not. You have to make sure that risk management, including asset liability management, is very particular in a bank. Then, exposure norms of a bank. Then, risk pricing policy and credit risk rating of a bank. Then, assets classification, income recognition and provisioning norms. Then appraisal, credit decision making and loan review mechanism, they all have to be followed. So these are the activities or these are the things which have to be taken care while doing the credit management in a bank or a financial institution. Okay. Now the credit exposure, simply how much credit can be provided. So credit exposure simply says include credit exposure, funded and non-funded credit limits, and investment exposure as well. So including the underwriting and similar commitments will be given. Now the sanction limits or outstandings, whichever are higher, shall be reckoned for arriving at the exposure limit. Clear? Next we have, however, in the case of fully drawn term loans where there is no scope for the re-withdrawal of any portion of the sanction limit, banks may reckon the outstandings as the exposure. So what does it mean? So simply the sanction limits or the outstanding which we are giving to the customer, out of which whichever is higher, it shall be arriving at the exposure limit of a bank. Like this is the amount of money that bank can provide to the customer. So in case the fully drawn term loans are there, in that case there is no scope for the redrawal. Okay, because of any portion, because that is fully drawn term loan have been given to the customer. So credit exposure tells us about how much money can be given to a particular customer or by a bank to the public. Next we have credit monitoring. Credit monitoring can be defined as a continuous supervision, continuous control, continuously looking after, we can say, the process which enable the bank to ensure the quality of loan assets. So this underline 4 points. First is, it means supervision of loan account. Keep looking at the loan account, keep checking the loan account that are the installments coming regularly or not. Second, supervision is to be continuous and not one-time exercise. Definitely until and unless the loan is recovered, we have to keep looking at the account. Okay, supervision. Its objective is to ensure quality of assets and adherence to regulatory IRAC guidelines. Hana, why we keep checking the loan account? So that we will know that actually the customer is paying loan or not, so that we will be able to make sure NPA won't be converted. And the fourth one is it helps in verifying that the borrower is conforming to the terms of sanction. So this is why the credit monitoring will be done. Okay. So credit monitoring is what? It keeping the track of the borrowing company's performance throughout the period of loan. If I have taken a loan from a bank for the period of 10 years, so bank keep checking my account to see that if I am paying the installment or not. And it will be continued till the 10 years period, till the time I return the whole amount of money to the bank. Okay. So that's what the monitoring is. Now, what are the monitoring goals? Simply, the main objective of credit monitoring is to minimize or eliminate the NPA. When you keep supervising the loan account, you will find that the customer has missed 1 or 2 installment or 3 installment, and before, like I guess everybody have heard about a special mention account. A special mention account 0, special mention account 1, and a special mention account 2. These are the 3 type of special mention account we have, and all these 3 special mention accounts actually help us to early identify the bad debts. Okay, it actually helps us in what? Early identifying the bad debts. So that's how we are eliminating NPA. That's how we are making sure we minimize the NPA. Okay, so credit monitoring is helping in that. It helps the banker to ensure the end use of funds, evaluate the borrower unit's performance, projection, ensure the quality of asset, and as well adherence of the regulatory guidelines. Clear? So to this end, the bank has to keep a close watch over the conduct of the credit account through keeping track of, first, transaction in the account. Second, a study of a stock statement submitted periodically by the customer. Third, periodic statements on performance parameter like the sales of a company, the level of debtors company have, the creditors company have, the operating profit company have. All of these have to be keep checking about the customer who have taken loan from us, because these things actually affect the customer's repaying capacity. Okay, done. Next. So delay or negligence in detecting or reporting early warning signals may later catapult into major trouble, pushing the account to a core NPA, compiling the bank to make the more provisions which affects the bottom line. That is, prevention is better than the cure. So that's why the credit management, the credit monitoring, and the credit control is done by the banks, and this is why they are very important, because it's always better to prevent something to happen, or in comparison to what? Solving the issue which have been already created. So simply, that's what the banks are doing by with the help of credit monitoring, credit management, and all that, that we should stop making our loans to go to the NPA. Okay. So this is basically your understanding of this chapter concepts. Now let's practice some questions. Like the first question is saying, what is involved in the processing of loan application? Deciding the interest rate based on geography, reviewing the financial stability of applicant, monitoring of advances and loan portfolio, managing the bank's customer service team. So at the time of processing of loan application, definitely you won't decide the interest rate based on the geography. That how is credit monitoring defined? A one-time check on loan account, a continuous supervision process enable the bank to ensure the quality of a loan assets, a method to increase loan limit, a process to reduce the interest rate on loan. So right answer will be what? A continuous supervision process which enable the bank to ensure the quality of loan assets. That's what the credit monitoring actually means. So right answer will be your B option. Okay. Next, what is the role of continuous supervision in credit monitoring? So first is saying to check loan repayment once a year, to ensure that the loan account are regularly reviewed and managed, to determine the interest rate for borrowers, and to approve new loans for the borrower. So which one is correct? Definitely, why we are doing continuous supervision? Because you want to ensure that the loan account are regularly reviewed and managed. So right answer will be B again. Okay. Next question. Who determines the MCLR? Ministry of Finance, RBI, banks themselves, or NABARD? So marginal cost of fund-based lending rate have a proper formula defined and costing defined. Every bank have to calculate the values of the formula on the basis of their bank's position, and then they calculate the MCLR. So right answer will be your banks themselves. So right answer is C. Lending is what? It's a very risky business of a bank. So, and the credit risk forms a major risk for the banks. Credit risk is also called as a default risk. It's a type of risk in which customer have not returned the money of a bank which they have taken as a loan. That is called as a credit risk, or we can call it a default risk. When the customer defaults and do not provide the loan of a bank to the bank return. Okay, so repayment is not done by the customer. That's a default risk, or that's a credit risk we can call. So there are several factors that could lead to the default by the borrower. In order to mitigate such kind of default risk or credit risk, one of the measures adopted is obtaining from the borrower the certain assets charged to the bank as security for the repayment of the credit facility extended. So we know that this is a kind of risk that can happen with any bank, with any particular bank or financial institution who are providing credit facility to the customer. They might face this default risk or this credit risk that the customer are not repaying the loan. Might be after 1 year or 2 year or 3 year from the starting of the installment, the customer is not paying the loan. So that creates a credit risk for the bank, default risk for a bank, that might convert itself in a liquidity risk or a financial risk for a bank. So that's why banks want to be secure while they are providing the loan to the customer. And that's when the concept of security or collateral came in the credit facility extended by the bank. Okay. Now next we are talking about here that in order to safeguard the advances or the loans that banks provide to their customer, in order to safeguard the advances, bankers normally take securities on which they fall back when any borrower commits default. If any borrower defaults and do not repay the loan of a bank, then the bank actually use that security or collateral to recover their funds. Okay, so typically bank finance is used by the borrowers for the certain for the creation of some types of assets, either for their business purposes or the personal use. And for multiple reasons, the customers take loan from a bank, definitely. Now we have that the assets created out of bank we are talking about here, that the assets created out of the bank finance as per normal banking practices invariably taken as security. And besides, often banks call for any other assets that owned by the borrower or the third party as a collateral security. Clear? So simply we can say that banks secure their loan by taking the collateral, by taking the security from the customer or owned by a customer. And also there are some cases or there are occasions when bank extend credit facility without any tangible security being available. So that results in a clean or unsecured loan. The clean loan or unsecured loan we can simply define as that type of loan which do not have any collateral or security provided to the bank at the time of providing loan. So banks provide loan to the customer in by taking security, by taking collateral. Apart from that, bank also provide loan to their customer without taking any security. And without taking any security, when a bank provide loan to the customer, it comes under the unsecured loan. Okay, that's a part of unsecured loan. Now, next we have here effectiveness of security. Next we have what? Effectiveness of security. So definitely the effectiveness of security would largely depends on the nature of the security, like what nature of securities we are actually using to cover our loan, that will define. Like if we talk about mortgage, that's a immovable property. Mortgage is what? It's an immovable property, and definitely the immovable property will be differently acting on the recovery of loan, and every type of security covers the different kind of security for a bank. Like in case of pledge, hypothecation, lien, assignment, they all give a different percentage of return of money. It's not a guarantee that if you have a security you will recover the whole amount of loan, no, but definitely the type of security have a different type of effect on the recovery of loan. So the major requisites of a good and acceptable securities are defined here, that first, the borrower should have good title to the security. If any goods the borrower is giving as a security, definitely the borrower should have the title of that security. It have to be there. Now, next, the asset should be easily identifiable. The asset should be easily identifiable to the bank, and it should be easily used. So the security should be easily and freely transferable. The bank should not take such kind of security or such kind of collateral which are not easy to transfer, which are not easy to convert into cash. Okay, so because the main objective of taking the security, like if the customer defaults, the bank still have something to recover their loan or to recover their amount. That's why the security should be easily and freely transferable. Next, we have here that it should not have any encumbrances or liability attached, like example, partially paid shares. That also covered here. Like no such kind of encumbrances or liability should be attached, whether it's partially paid shares. Okay. Apart from that, the next points that have been defined to us is that the ownership of the asset should be absolute. Okay. The ownership of the asset that the customer is giving as a security to the bank, it should be absolute. Also, the security should be easily marketable, like you can easily sell that security, easily anybody can purchase that security. Assets without wide price fluctuations are preferable. Like if you say that I am going to take a loan from a bank, but I am ready to give the shares of a certain company as a security, the shares are very fluctuation, the shares price are very fluctuative. Every day we are seeing that the share prices are changing, and that might affect the chances of the amount that bank can get out of that security in the future when the customer don't pay the loan. So definitely such kind of security should be there whose prices are not that much fluctuative. Okay. Now the market value should be easily ascertainable. Like if you are taking any kind of assets or security as a collateral, then you should be capable of identifying the value of that product easily. And it should be easily available. It should be possible to store the security in secure manner in case of pledge particularly. Pledge actually covers those kinds of security whose possession will be given to the bank. Okay, in that case, definitely it's important that the proper storage of that security will be done. Like for example, in pledge we have a gold, and the gold definitely requires a storage facility that the bank have to maintain. If the bank do not have to secure those golds which they are taking as a security, definitely they are not allowed to take the security of gold. So the security should be durable for a reasonable period of time. So these are the certain features we are talking about which should be there in the acceptable securities. Okay, next. Now types of security. In practice, the securities offered by the borrower are of various types. So they can be immovable asset, it can be movable, it can be actionable claim financial assets, it can be intangible assets. So these are the types of securities that we are using as a collateral. Immovable property, we always know it will be counted in a mortgage. Movable, it can be pledge, it can be hypothecation, it can be lien. Actionable claims and financial assets are simply your assignment. Intangible assets can be your assignment. So these are the type of securities we use generally in the banking system. So whatever may be the nature of a security, movable, immovable, whatever, the banker while accepting it have to ensure the certain factors. Like the first factor is it is saleable. The banker have to make sure that whatever property they are taking from a customer, that property is saleable. Like if the customer do not repay the money in the future, we should sell that property and recover our money. So that have to be assured by the bank. Like before taking that security, bank have to assure that. Then whenever required to do so for recovery in case of default by the borrower. Now the value of the securities is ascertainable at any time from reliable sources to enable determining the drawing limit and assessing the saleable value of the asset. That have to be taken care of. Now its value is reasonably stable and not subject to wide fluctuations, and depending on the volatility, banks fix the percentage of margin also. So next we are saying that the value should be reasonably stable. Like there should be no that much fluctuation in the prices of the value or the value of a product. Okay, not subject to wide fluctuation. We don't want a wide fluctuation. We don't want the price changes regularly. We want a kind of reasonably stable property or the asset to be as a security. And next we are talking about it is easily transferable without, as far as possible, going through a legal formalities. Like should not involve a lot of legal formalities to transfer the property at the time of recovery. So that's what we are talking about here. Okay. So classified as primary and secondary also. Securities are classified as a primary security and secondary, or we can call it a collateral security. So primary security is the assets against which advances is made. Okay, so any kind of assets against which advances are given to the customers, that is called as a primary security. For example, it can be stock of goods, so the sales receivable, the machinery, and it also those assets on which margin of security will be applied. So that's a primary security. Then we have a collateral security. It is a security of any other assets of the borrower or of a third party. So the securities are also divided on the basis of the primary and collateral security. Okay. Now the types of collateral and their characteristics. So there are lot of types of collaterals are there that the bank take from the customer to provide the loan, and they have a multiple classification that we will be covering in this chapter in detail. Like the first one is land and building. So you can see when we talk about the land and building here, type of security we have land and building. Definitely it's an immovable property, so it will covered under the mortgage. So the type of charge will be created here will be equitable mortgage or the registered mortgage. Now the types of valuation, the bank's approved valuer will define the value of a land and building. Then registration of charge will be there, possible only when the property is freehold and non-encumbrances. It means it should not be provided to someone else before it provided to bank. Like it should be a property which have not been already given as a security to someone. Okay, so it should have a freehold, it should be having a non-encumbrance certificate, search report, and prior sale deeds should be gone through properly. In case of companies, the charge should be got registered with the registrar of the company. Okay, so these are the registration of charge we are talking about. Then possession of security, simply the title deeds remains with the bank who is providing the loan. That's what the land and building we are doing. Okay. Now next we have plant and machinery. The other type of collateral we can give, it comes under the hypothecation because that's movable. So the types of valuation, whatever the original invoices are saying and whatever the depreciation value of that plant and machinery happened will be calculated as a valuation of a property. Now registration of charge in case of companies, definitely the same should be got registered with the registrar of companies. And possession of the security, the physical possession remains with the borrower, with the borrower's bank and the constructive possession. And banks have what? Banks have a constructive possession here. Now stocks are also counted in the hypothecation and pledge. Both are movable. Hypothecation and pledge both are movable. The only difference is the possession in hypothecation remains with the borrower, and in pledge it remains with the lender. That's the only difference. So market reports, newspaper invoices, they all will be covered here. And by way of obtaining inventories and stock reports at regular intervals, it will do as a registration of charge. Next, physical possession remains with the borrower and the bank has an equitable charge. And in case of pledge, physical possession remains with the bank in an independently accessible store. So as I have told you, pledge and hypothecation both are movable, but in hypothecation, possession remains with the borrower. But in pledge, the possession remains with the lender. Okay. Next type of collateral we have is railway or lorry receipts or airway bill, and we can say bill of lading. So these are the pledge of receipts or bills in full set of issue. That's also a pledge. So valuation will be the invoice of there. Okay. And by way of delivery and a valid endorsement through not legally required, but railway or transport authority should be notified for the registration of the charge. And the possession, documentation of title remain with the bank who is providing the loan. In case of we are providing LIC policy, that comes under the assignment because LIC policy is a kind of actionable claim. It counted under a actionable claim type of security. So definitely it's assignment. And the surrender value certificate issued by a company will be the actually type of valuation. Now, if we talk about registration of charge, by a way of assignment in favor of the bank will be created and the original policy remain with the bank here. Okay. Now, National Savings Certificate, Indira Vikas Patra and other government securities are there. They are also pledge of security. The face value plus the interest rate will be given in these security will be counted as a types of valuation. and the bank endorsement of transfer assignment in favor of bank will be taken as a valuation of charge. Original securities remains with the bank here. Okay, so this is the type of securities we have. Apart from these, we also have bank's own term policy, like FD. So pledge, it is also face value of the fixed deposit plus the interest will be counted. By way of assignment, it will be taken, and original document receipt remains with the bank. That's a term deposit. Term deposit simply means that FD or RD policies. Now the gold ornament, definitely pledge because the possession remains with bank. Like newspaper weight certificate approved by the jeweler will be calculating the valuation of the property, of the gold. Then registration of charge, delivery of possession will be counted here, and the jeweler is kept in the jewelry is kept in the safe custody with the bank. So as we discussed that bank should have a proper storage value, like bank should be having a proper store where the bank defined these all gold ornaments or any other pledge securities will be stored. Then UTI, share of approved companies we have, that's also pledge. UTI is Unit Trust of India, that's a mutual fund. So the valuation will be on the basis of newspaper and SEBI approved agents and brokers will be counted. Letter of pledge, blank transfer deeds and dematerialization will be taken for the registration of charge, and the certificate remains with the bank here. Okay. Now these are the certain types of security that we have. The major difference, confusion is between the hypothecation and pledge. Like if we talk about the legal provision, section 2N of securities, or we can say Sarfasi Act, actually talks about the hypothecation, and section 172 of Contract Act 1870, Indian Contract Act 1872 talks about pledge. Definition, we know a charge is or in or upon any movable property existing or future created by the borrower in favor of a secured creditor without the delivery of possession, because in hypothecation possession remains with the borrower. Okay, so property to such creditor as a security for financial assistance include floating charge into fixed charge or immovable property. Clear? So hypothecation, the possession remains with the borrower. And in case of pledge, it stands for the bailment of goods as security for payment of a goods, of a debt or a performance of a promise. So the customer have promised that we will return your loan after 5 years. So if the customer have not returned the loan of a bank after 5 years, definitely the bailment will be taken by the bank. Okay. Apart from that, you can see parties involved. The borrower will be called as a hypothecator and bank will be called as a hypothecatee. When it comes to the pledge, borrower is a pledger or pawner and bank is a pledgee and pawnee. Okay. Name of securities, that hypothecation is movable, pledge is also movable. Then nature of charge, we have hypothecation, equitable and floating will be counted. They are equitable and as well as floating. When it comes to pledge, it's legal and fixed also. Now rights of ownership will be in the hypothecation remains with the borrower, in pledge also remains with the borrower, because we are talking about ownership. We are not talking about possession. In case of possession, in hypothecation it remains with borrower, and in pledge it remains with the lender. But ownership always will be the customer. Okay, ownership will always remain with the customer. Now right of sale, through the court of law, and private sale after giving reasonable notice. So this is how the hypothecation and pledge will be defined, and the differences is defined between the two. Because see, when we talk about mortgage, mortgage is very simple. It's an immovable property. So we don't have that much confusion about the mortgage. When we talk about actionable claim, definitely assignments are there. The major confusion is between pledge and hypothecation, because both are movable and both includes like a stock of goods and all, but still they both have a difference. Okay. So I hope this difference is clear to all of you. When we talk about the delivery of goods in a hypothecation, the actual, it can be symbolic, it can be constructive. But in pledge, it's not there. Then limitation period for hypothecation, it will be 3 years, but in pledge, no such kind of limitation period is there. In general lien, you can find that it is, in case of hypothecation, it's not available to perform the general lien, but in case of pledge, it is available. Okay, and degree of care have been given, like the borrower to take care of the hypothecated goods, because they have the possession, so they have to take care of the goods till the end of the loan recovery, till the loan account close. But in case of pledge, the bank is bound to take care of the goods because bank have taken a possession in case of pledge, and the possession have been taken care by the bank, and definitely the bank have to take care of everything. That bank tend to safeguard their advances by taking different kinds of security. So we know the business of banking covers 4 functions. Accepting deposit from public, that should be used for the purpose of loan and advances, or we can say investment and lending. That should be repayable on demand and otherwise withdrawable by check, draft, etc. Right? These are the certain 4 functions of business of banking. So when a bank providing loan, the bank have to secure themselves. And to secure themselves, bank take the security, the collateral from the customer. Okay, and that's the type of securities we are going to talk today. So the main purpose of taking a security is to fall back on it in case the loan is defaulted. If the customer defaults and do not provide the loan back to the bank, definitely bank have to face the credit risk, which is also called as a default risk. And if a lot of such kind of loans have not been repaid, or the customer actually defaults, then the bank have to face the liquidity risk, or that might convert into the financial risk, and because of which bank have to face the solvency. So that's what you're talking about here, that it's very important that before the customer defaults, bank should have such kind of securities or collateral that can be utilized at the time of defaults. Okay, so banks take movable property, immovable property, or a debt as a security for a loan, right? And the method of creating charge over a property depends upon the nature of property and the nature of charge they are creating. So simply, when the bank is taking securities, it can be movable, it can be immovable, it can be as a debt. Now, for example, when a bank gives a loan against the security of gold ornament, it takes a possession of the ornament. That's a pledge. Okay. When it advances against the security of vehicle or a house property, the bank does not take the physical possession. At the time, the possession remains with the borrower because that's a hypothecation. In pledge, the possession will given to the bank, and in hypothecation, possession remains with the customer. Okay, so this is the example of type of security we are taking here. Now, meaning and essentials of a contract. So first of all, the term contract is defined under section 2H of your Indian Contract Act 1872. And it says that a contract is an agreement enforceable by law. Like it's what? It's an agreement between the two parties, and it is enforceable by the law. Now, the law of contract constitutes the most important branch of commercial law, definitely, and it affects the entire trade, commerce and industry in the country. Obviously, the law of contract, which covers all the conditions and everything, so it is going to affect the entire trade, commerce and industry. So, the banking services law of contract is relevant for various activities, especially the lending process of a bank. Okay, now various agreements between a bank and a borrower are governed by the law of contract because they have been enforceable by the law, right? Because agreement is not an obligation, but contracts becomes the obligation because we enter the law in it. Now, the meaning and essence of a contract essentials. So similarly, guarantees or bank guarantees or letter of credit issued by a bank, they are also governed by the law of contract. So you can see, in India, the law relating to contract is governed by the Indian Contract Act 1872. And the act is broadly divided into 2 parts. Part 1 describes the general, okay, the part 1 describes the general principles of contract which are applicable to all the types of contract, like the general principles they are talking about. But when it comes to the part 2, it deals with special types of contract, namely indemnities or guarantees, etc. Okay, so that's a part 2. So the act is divided into 2 parts. Do remember part 1 and part 2. Part 1 is general principles of contract, and part 2 is special types of contract like indemnities, guarantees will be covered. Now, so the contract means an agreement enforceable by law. It has 2 major constituents. First, an agreement between 2 persons or more. And the second, the agreement must be enforceable by law. It means the rights and obligation arising out of the law have to be there. It means that first it is made by free consent of all the parties, like they by their own wish entered the contract. Second, it is made for a lawful consideration, like while we are talking about the terms and condition and for what purpose we are having a contract, that is having a lawful consideration. It is made with a lawful object as well, like the some lawful objects will be there. And the fourth, it is not declared as a void expressly in the Indian Contract Act. So these are the four things that we're talking about which have been enforceable by law, which makes the contract differ from the agreement. Okay, these are the things. So that's the meaning of contract. Now all the agreements are contract if they are made by the free consent of the parties, competent to contract for a lawful consideration and within a lawful object. So we can say what? All the agreement are contracts, but all the contracts cannot be the agreement, because contracts are always lawful, and agreement, not every agreement is lawfully added. So the contract equals to agreement per se plus the enforceability. So definitely all agreements are contract, but not all contracts are agreement, because until and unless enforceability of law is there, it can't become the contract. Also, all contracts are agreement, but all agreements are not necessarily the contracts. Very basic concept of agreement and contract, or this is the difference between contract and agreement which we saw. Now, the types of charges: the bank charge over properties confine itself to one or more of the following 7 types of charges. Now, what are these? Every one of you is very much aware about these terms. The first one is assignment, that covers the actionable claim. Second, we have lien, any movable property. Then set off, right of set off we talk about. Then we have hypothecation, pledge, and we have mortgage. So these are what? These are the simply the type of charges we are creating, and the last one was right of appropriation. Okay, so assignment, lien, set off, hypothecation, pledge, mortgage, and appropriation, they will be covered in the types of charges. Now, next we have for banking services, law of contract is relevant for various activities, like that especially lending, and the various agreement between bank and borrower, they all are governed by the law of contract, obviously, right? And they all come under the Indian Contract Act. So an agent is a person employed to do any act from another person or to represent another person in dealing with some third person also. So when the bank collect the various financial instruments for their customer, this law comes into force, definitely. And a bailment is what? It is the delivery of goods by one person to the another for some purpose. That's what the bailment of goods we talk about. And one party is delivering the goods to another for certain purposes. Next, we know banks charge over the properties. They confines itself to one or more of the any 7 types of charges that we have seen. It can be assignment, lien, set off, hypothecation, etc. So a banker's lien is what? It's an implied pledge. Like in lien, it is implied that until and unless customer returns the loan of a bank, the property possession remains with the bank. Okay, when the customer repay the loan of a bank, then that property will be returned, that possession will be returned. Until that, it will remain with the lender. That's why it's called as an implied pledge. Now, a set off is simply the right of a debtor to take into account a debt owing to him by a creditor when claiming a debt due from him to the creditor. So the bank have a right to set off from one debit account to the credit account. Okay, then apart from that, hypothecation, we know it's a movable property. In hypothecation, the possession and ownership both remains with the borrower. Okay, it both remains with the borrower, and if borrower fails to make the payment of a loan, then the bank will take the property. Now, pledge is simply in which the ownership remains with the borrower, but the possession goes to the lender. Example like car loan is a hypothecation, gold loan is a pledge. Okay, accordingly possession you can understand. Now for immovable property, that's a mortgage. Actually, the provision of Transfer of Property Act 1882 applies, and the Transfer of Property Act contemplates 6 types of mortgages. We have simple mortgage, mortgage by conditional sale, and unfiscary mortgage, English mortgage, mortgage by deposit of title deeds, anonymous mortgage. They all are the types of mortgage will be covered. Mortgage is when the bank take or the customer provide immovable property to the bank for a security purposes. Okay, and the Companies Act 2013 provides that for the purpose of registration under said act, it includes the specified charges. Like under the provision of SARFAESI Act 2002, particulars of any charge creating security of interest of bank or financial institution over the property, they can be filed with the registry. That is so. So definitely if any kind of security will be covered or will be made, they will be regulated by certain law, certain act. And that's what the immovable property comes under, the Sarfasi, or we can say the Sarsai Act. Okay, Sarsai is actually what? It's a authority, or it's a nodal agency for the property dealing, we can say. Like before bank accept any mortgage from a customer, they have to confirm it, or they have to cross check with the Sarsai that that property is already not given as a lease or as a security to someone else. So when it comes to the assets of a bank, the assets of bank covers loans, or you can call it advances. Loans and advances are the assets of a bank. And now these assets are divided into two categories or two parts. The first one we have is a standard asset. The first one we have is standard asset. This standard asset is divided into two categories further. The first one is regular asset, and the second one is stressed asset. Second one is stressed asset. So now standard asset is not a part of NPA. Okay, in accounting it have been defined that a standard asset is not a part of NPA. So one type of asset we have a standard asset, and the second type we have is a non-performing asset, that is called as an NPA. Okay, so standard asset further divided into regular and stressed asset. Regular assets means those assets which are keep generating income for the bank. Okay, those assets which are generating income for the bank, that is called as a your regular asset. Like regularly customer is paying installment of a loan, and regularly the bank is earning a certain amount of money in form of interest on a loan, that is called as a regular asset of a bank. Now stressed asset is actually called as a special mention account. The stressed asset covers the special mention account, and the special mention accounts are actually kind of early identification of bad debts. Okay, stressed assets are what? They are the early identification of bad debts. Now what does this mean? It means special mention accounts give the warning or have a kind of early identification pattern that what type of a loan account can go to the NPA. So that's why the stressed assets account covers the special mention account. So I will write here. The first we have SMA 0, special mention account 0. Then we have SMA 1, that is a special mention account 1. Then we have SMA 2, special mention account 2. And their duration is 1 to 30 days. Then 31 to 60 days. And then 61 to 90 days. So if in this duration the customer have not paid the installment of a loan, then it will be defined as a special mention account 0, special mention account 1, and a special mention account 2. And after 90 days, okay, after 90 days, it converts into NPA. Okay, if any customer is not repaying or any customer is not paying the installment of a bank loan for more than 90 days, it will be defined as an NPA. Okay. So this is how the assets of a bank is defined, and now the NPA is defined into the three type of assets, that is substandard asset. NPA have substandard asset. Then we have doubtful asset. The doubtful asset on the basis of the duration, it is divided into three categories: doubtful 1, doubtful 2, and doubtful 3. And then we have loss asset. So these are the three types of assets under NPA: substandard, doubtful, and loss asset. And other standard asset covers these regular and stressed assets. So now we can say special mention accounts are like the early identification of bad debts, right? So how we get the early identification? Because it gives the notification, it gives the idea that how many accounts are there who have not paid the first installment, who have not paid the second installment, or who have not paid the third installment. So on the basis of this duration 1 to 30, 31 to 60, 61 to 90, we got to know which accounts might go to NPA after a certain period of time. Okay, and that will be 90 days. So now once the loan become NPA, we have to recover that. Okay, and for the recovery of this NPA, we have introduced the laws related to recovery of dues. Okay, and that's what the unit is, laws relating to the recovery of dues. Okay, so what are these laws are? Let's see. So recovery of money lent is not always smooth, and banks are required to occasionally use legal avenues like courts for recovering dues from the defaulting borrowers. Definitely, every type of loan which bank is providing to the customer, it covers a normal risk of default. Whether you are giving loan to me, you are giving loan to other 24/7, you are giving loan to Mr. Ambani, you are giving loan to Mr. Bill Gates, in every case, a normal risk of default will be there. Okay, a normal risk of default will be there. So recovery of money is lent, not always smooth, and banks have to find out certain other ways to recover their dues. So simply, the Indian Contract Act and the Civil Procedure Code were used for this purpose. They had their own constraints. Considering significance of recovery by banks, a few laws have been enacted providing specific remedies to banks and financial institutions. So earlier, these kind of cases used to go to the court, but we know what is the situation of Indian courts. A lot of cases are pending, and it keeps going on. Like they keep giving dates and they never find the result or solution, the final decision. So that's why the Certain Recovery of Dues Act have been created, which only focuses on the NPA recovery, and that provide a kind of early resolution as well. Okay, so Recovery of Debts and Bankruptcy Act 1993, 6 Sarfasi Act, that is Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act, then IBC, Insolvency and Bankruptcy Code, Legal Service Authorities Act 1989, and the Law of Limitation. These are the laws that we have to cover in this particular unit. Okay, and when we talk about recovery of dues, we have a DRT, DRAT, NCLT, NCALT, we have Sarfasi, we have asset reconstruction companies, we have IBC. All of these have to be studied when we are talking about recovery of dues. Okay, we are talking about the recovery of dues. We have to cover all these ways by which recovery will be done. So let's start first with the introduction to the Recovery of Debts and Bankruptcy Act, that was 1993, that is called as a DRB. So recovery through courts were a major bottleneck. Bottleneck means hurdle. It was very tough due to huge backlog of cases with the various courts. As I have told you, when we used to take the courts, Indian courts, for the recovery of loan, and when we go to the court for the solution, it takes a lot of time, right? So even in recovery of decreed debts, considerable difficulties were faced. It was observed huge assets were blocked as unproductive assets, and the process of recovery required considerable manpower of the banks and financial institutions, thus drain on their productivity. So what we are saying simply that it have been seen huge assets were blocked at the unproductive assets. Why unproductive? Because whenever bank provide loan to earn income on it, to generate income on it, but such certain NPAs or non-performing asset, they stop generating income on the loan, and at that time they become unproductive assets for us, and a huge amount of such kind of unproductive assets were there. Okay, and the process of recovery, it required the considerable manpower of the banks and of the financial institution. And I guess you all have heard about the name Bad Bank National Asset Reconstruction Company Limited. So Bad Banks was introduced to make sure that banks do not focus only on the recovery of NPA. Like banks' primary focus became the recovery of NPA for a certain period of time in financial years. So at that time, the business development and finding the way by how to raise the capital, these kind of things banks were not capable of focusing on. There was no innovation in the banking sector. So that's why the Bad Bank was created. So that the bad bank will take over the NPA of a bank and the bank balance sheet will be clean, so that the bank will focus on the other things like the business development and how to raise the capital from the market. That's why the NPA, NARCL, or we can say Bad Bank, was introduced. So now when we talk about this, this is seeing the same thing. A lot of manpower of the bank and financial institution was required. It was very hard to do that. So hence Recovery of Debt due to Banks and Financial Institution Act 1993, that is DRT Act, was enacted, and debt recovery tribunals were constituted for the speedy recovery. So DRTs are what? They are the special type of courts created by the central government for the recovery of NPAs. Okay, what is DRTs? DRTs are simply special type of courts established by the central government for the purpose of recovery of loan only. So the act was amended in 2019, including its title as Recovery of Debts and Bankruptcy Act. Now next, the extent of this act is, the act is applicable to the whole of India except the state of Jammu and Kashmir. That act is made applicable from 24th of June 1993 through the DRTs established progressively across the country. So now qualifying amount, we have the cases or the amount of debt due to any bank or financial institution or their consortium is 20 lakh or more are covered under the DRT. If the NPA or the loan amount is 20 lakh or more than that, then we can go to the DRT. Okay. Now, what is presiding officer? So, presiding officer means the presiding officer of the debt recovery tribunal appointed under section 4(1). Okay, when we talk about presiding officer, that means it's a presiding officer of debt recovery tribunal. It will be appointed, the person will be appointed in the section 4(1). So now the tribunal is made up of only one person called the presiding officer, and the qualification for the officer is a person is qualified for appointment as a presiding officer of DRT if he is or has been or is qualified to be appointed as a district judge. If a person is qualified to become a district judge, he can be appointed as a presiding officer. So term of office is what? The presiding officer holds office for a term of 5 years from the date on which he assumes his office or until he attains the age of 65 years, whichever is earlier. Accordingly, the term of office will be decided. Now, apart from that, recovery officers are also there. They are appointed by the central government for each tribunal under section 7(1) for implementing the recovery orders passed by the tribunals. So whatever recovery orders the DRT will give, the recovery officer will go and recover such kind of assets. Okay. Now, then we have appellate tribunal, DRAT, debt recovery appellate tribunal. That's a higher authority after the DRT. If any bank is not satisfied with the DRT, they can go to the DRAT for the solution. Right. So the central government has power to establish one or more appellate tribunals known as debt recovery appellate tribunal. The central government specifies the area within which the appellate tribunal may exercise jurisdiction for entertaining the deciding the application filed before it. Okay. So central government is what? It specifies the area within which the appellate tribunal may exercise the jurisdiction. So chairperson will be a DRTA consists of only one person called as a chairperson. Okay. And qualification will be the person, he is or has been qualified to be a judge of High Court, has been a member of Indian Legal Service and held a post in grade 1 of that service for at least 3 years period, has held office as a presiding officer of a tribunal for at least 3 years. So if a person fulfills this criteria, that person will be appointed as a presiding officer, or we can say chairperson of a DRAT, that is debt recovery appellate tribunal. Okay. The person should be qualified to become a judge of High Court. The person should be has been a member of Indian Legal Service in the post grade 1, and after that it should be working there for 3 years, and the person should be working as a presiding officer for the DRT for at least 3 years period. Then the person will be qualifying to become the chairperson of a DRAT. So the term of office is chairperson holds office for a term of 5 years from the date on which he assumes his office or until he attains the age of 70 years, whichever is earlier. Okay. So that will be followed. Now, introduction to SARFAESI Act. Next, we have a SARFAESI Act. So I guess every one of you is aware about the SARFAESI Act, right? SARFAESI Act is actually helping us out to recover the loan or NPA, that covers the amount more than 1 lakh or 20% of the contract, or of the loan amount. So you can see the lender's rights over the securities, both movable and immovable, for realization of the amount advanced were of limited value and less effective since enforcement of security was required to be done through the legal proceedings. And then the legal process took unduly long time to complete the prior to the passing of the Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act 2002. Okay, so the legal process that took unduly long time to complete the prior to passing the SARFAESI Act. So SARFAESI Act introduced major changes in the legal framework for recovery of dues of banks and financial institutions through the enforcement of the securities. So in this, we have seen it streamlined the functions of asset reconstruction company for dealing with the financial assets of a bank and financial institution. For this purpose, the procedure as well as the regulatory control measures were required. So when we know the SARFAESI Act actually have made changes in the recovery of dues, and we can say recovery of dues of banks and financial institution by doing what? By enforcement of the securities. So it performed the securitization process. It performed the reconstruction process of the assets that have to be recovered by the SARFAESI. So qualifying amount is the act is applicable to the cases where the securities interest for securing repayment of any financial asset is more than 1 lakh and the amount is due 20% or more of the principal amount and interest thereon. So if let's say a person have taken a loan of 1 lakh rupees and more than the recovery of dues will be done under the SARFAESI. Let's say a person have taken a loan of 10 lakh rupees and he returned, for example, 8 lakh rupees. Okay, then it will not be applied because the only 20% is remaining. Then it will apply the SARFAESI Act. But if the person has repaid the 9 lakh rupees, only 1 lakh rupees is remaining, then it won't be applied. The two conditions are there. The amount should be more than 1 lakh. Only 1 lakh is remaining, then the SARFAESI won't be applicable. If more than 1 lakh is there, SARFAESI will be applicable. Second condition, the principal plus interest together covers the 100% amount of a loan. Out of that, if 20% or more than 20% is remaining of that particular amount, then the SARFAESI will be applicable, otherwise no. Okay. Apart from that, it also has been said that the SARFAESI won't be applicable on the agricultural land. So you can see the act is not applicable to any security interest created on agricultural land and certain properties are not liable to attachment under the some specified acts. Now agricultural land is not included in the SARFAESI Act because it has been said that agricultural land, selling of agricultural land is only authority given to the farmer. So the SARFAESI Act cannot perform the auction of a agricultural land of a farmer. Okay, so agricultural land, if the mortgage is agricultural land, then SARFAESI won't applicable. If the loan amount is less than 1 lakh remaining, then also the SARFAESI Act won't be applicable. If the recovery balance is less than 20% of the total amount, then also the SARFAESI Act won't be applicable. So these are the three conditions given under the SARFAESI Act. Okay. Now we have asset reconstruction company. These are those companies which take NPA of a bank from the bank and then reconstruct that asset, rebuild that asset and sell that asset in the market and recover their money. That's what the ARC does. So they have to be registration with RBI and ARC has to compile the following two conditions. First, it have to obtain a certificate of registration from RBI. Second, the net owned fund should not less than 100 crore on an ongoing basis. Okay. So certificate of registration have to be taken from RBI and the net owned fund should be 100 crore or more than that. Also, asset reconstruction companies can raise money for their acquisition activities by issue of SRS under the schemes formulated by them. So depending on the nature of securities asset, RBI has power to specify the different amounts of own fund for the different class or classes of ARC. Like in the NBFC it happened. NBFC also non-banking financial companies are there. They also have to take the certificate of registration from RBI. But they have been said that net owned fund should be 2 crore and more than that, not less than that. But in case of type of NBFC, the net owned fund amount can be differ. That will be defined by the RBI. Now the conditions for registration as IRC are: first, not incurred loss in any of the 3 preceding financial year. If any company want to be registered as an ARC, they should not have faced any kind of loss in the last 3 years. Then made adequate arrangement for realization of the financial assets acquired and shall be able to pay periodical returns on and redeem on respective due dates the investment made by the qualified buyers or other persons. Also, we are saying that it should make the adequate arrangement for the realization of the financial assets acquired. Okay, so they should have a proper arrangements where to raise the capital, where to sell the capital, like the proper management of financial assets they should be decided. The arrangement should be there. And they have to be capable of making the periodical returns on and redeem on respective due dates of the investment. That have been made by the qualified buyer, because the asset reconstruction companies will buy NPA from a bank and then sell in the market and recover the money. So they have to have capability of making the periodical returns. Then director have experience in finance, securitization and reconstruction. The ARC can make the director a person who have experience in finance, securitization and reconstruction. then none of its directors have been convicted of any offense involving moral turpitude. Okay, then its sponsor is a fit and proper person in accordance with the criteria also. Also, it has compiled with or is in a position to compile with prudential norms by RBI as well. So these are the conditions which have been registered that have to be followed on by the ARC while they are going to register as an asset reconstruction company. Okay, so these all conditions have to be followed by the ARC. So asset reconstruction companies are simply those companies which actually take the NPA of a bank and sell those NPA's assets to the market and recover their fund from there. This is how the asset reconstruction companies actually works. Okay, now we have a national asset reconstruction company. The national asset reconstruction company is doing the same thing. The national asset reconstruction company is doing the same thing. They take over the NPA of a bank and then recover the money from the market by using those assets. That's what the ARC does. So deferred payment guarantee in international trade finance, if we talk about, it actually what? The deferred payment guarantees serve as crucial financial instrument in international trade, particularly for capital goods transaction, where substantial payments are spread over extended periods. So what is deferred payment guarantee? They actually serve as the crucial financial instrument. They are very important financial instrument in the international trade, and particularly for what? For the capital goods transaction, where your payments are spread over extended periods. Okay, so the presentation explores how deferred payment guarantee functions, then their purposes, their significances in facilitating the global commerce while mitigating financial risk for both the importers as well as the exporters. Okay, so you can see here the definition of deferred payment guarantee is, it's a bank's assurance to an exporter guaranteeing the timely payment of installment of goods purchased on credit by the importer, typically involving capital equipment with payment spread over multiple years. Okay, so what is this deferred payment guarantee? It's a bank's assurance. Bank is giving assurance to an exporter that whatever goods you have sold to the importer, the payment of that goods will be given to you in a timely manner in form of payment of installments. Okay, it will involve the capital equipment with the payments that you have traded with the customer, with the importer for a multiple years. So let's say importer have purchased some goods from the exporter, but importer is not capable of making the immediate payment. So he will opt the deferred payment guarantee, in which bank is giving assurance to the exporter that we are guaranteeing you that you will get a timely payment of installments against the goods you have sold to the importer over a multiple years. So one equal monthly installment will be created for a certain period of years, and that's what the bank guaranteeing to the exporter under the deferred payment guarantee. Now, what is the purpose? Purpose is to protect the exporter from default risk, or you can call it a credit risk. Okay, so might be possible that if importer have taken goods today and saying that I will make the payment in the future after 1 month, 6 months, or 1 year or 2 years, but we don't have guarantee that after 6 years or after 6 months the importer will be capable of making the payment. What if importer become insolvent after 6 months? Then exporter have to face the risk. So we don't want that to happen. So the purpose of having a deferred payment guarantee is what? Protecting the exporter from the default risk or a credit risk in the future, while allowing the importer to purchase the high value goods without immediate full payment, addressing cash flow and foreign exchange challenges. So it is beneficial for exporter as well as for importer. It's good for the importer because importer will be capable of purchasing the goods now and paying for it later. And it is good for the exporter because exporter have done the trade and the exporter have a guarantee that exporter don't have to face any kind of credit risk or a default risk. Right? Now, example scenario we have given: an American manufacturer imports, let's say for example, $5 lakh of industrial equipment from Germany with payment spread over 5 years. So the German exporter receives a deferred payment guarantee from American importers bank, ensuring the payment securities regardless of importer's future financial condition. Right? So it is good for both the importer as well as for the exporter. It will good for the economy as well, because the money will keep following. The currency will keep circulating in the economy. Now, deferred payment guarantee represents an alternative financing method for the fixed assets, particularly valuable when substantial foreign exchange is required for capital goods imports. Okay, so that's what we can say, that this is how the deferred payment guarantee becomes very useful. So why use the deferred payment guarantee? So benefits for importers we have here, that enables acquisition of expensive capital goods without immediate full payment. Right? You don't have to make the immediate payment to the customer, to the exporter, but still you can purchase those goods and services. This is one of the benefit for whom? For the importer. Like that, they do not have to make payment right away. They have purchased the goods, they can make the payment after a certain period of time. And second thing we are saying, they are capable of purchasing the goods at the same time. That's beneficial for them. Okay, now next. Reduces the foreign exchange burden by spreading the payments. Because payment have been spread for over 5 years or 3 years or 4 years. So the foreign exchange burden will be also reduced. Improves the cash flow management and capital allocation. So importer will be capable of maintaining the cash flow, because he or she will be making the payment of the goods purchased in the next 5 years. So they will manage the cash. Then allows business expansion with manageable inflation impact. Financial impact. So it does what? It allows the business expansion with manageable financial impacts. Okay, now we have a benefits for exporters. So what are the benefit? Eliminates credit risk with bank backed payment guarantee. Okay, it does what? It eliminates the credit risk with the bank backed payment guarantee. That's simple. Like if exporter is doing shipment of goods today, but in future he has to get the payment, he will be stress free that definitely he will get the payment of the goods sold. Then it creates sales opportunity for high value goods. Like if you are capable of providing goods on credit, you will have more options for trade. You will have more orders. Because definitely every importer, every purchaser don't have that bulk amount of money available with them before purchasing the goods. So if you are offering them, right, if you are offering them that you can purchase now and you can pay later, in that case, you will get more and more orders as well. It provides certainty of future cash flows also. Like you will be confirmed that after 3 years or in the next 3 years, I will be getting every month the payment of $1 lakh or $1,000. That's the conformity you have. Then potential to discount the guaranteed future payments as well. So these are the benefits of the deferred payment guarantee for the importer and exporter. That's good for them, right? Now the structure of deferred payment arrangements. First, initial payment, like the advance payment of 10 to 15% of the contract value by the importer to demonstrate commitment and reduce the exporter's risk exposure. Like you have to pay at the same time a certain 10 to 15% amount to the exporter in advance. Then documentary payment, additional 10 to 15% payment upon receipt of shipping document through a letter credit confirming the goods have been shipped. Definitely, like if the exporter gives the bill of lading. What is bill of lading? Bill of lading is a kind of bill issued by the captain of a ship, which represents that the goods have been loaded on the ship with the right condition. Okay. Then deferred payment. Now the remaining 70 or 80% amount of money will be paid in installment in the next 1 to 7 years. That will be secured by the bank's deferred payment guarantee. typically include both principal and interest payment. So this is how the structure of deferred payment arrangements will work. So this structure balances the risk between the parties while facilitating transaction that might otherwise be impossible due to capital constraint or the foreign exchange limitations. So this is what the structure of deferred payment arrangements actually is. Okay, now the key elements of a valid deferred payment guarantee. What are the key elements? First is underlying transactions must relate to an actual supply of goods where the supplier has agreed to postpone payment collection. This forms the consideration for the guarantee. Okay, when it comes to key element of a valid deferred payment guarantee, what is it? We are underlining the transactions. Okay, and it should relate to what? Actual supply of goods that the seller has agreed to postpone payment collection. Okay, according to that, the actual supply of goods have to be done. So underlying transactions have to be completed and the payment schedule should be done. Clearly defined schedule detailing both the installment amount and interest payment with specific due dates incorporated into guarantee. So apart from underlining the transactions, you have to give the payment schedule also. Like this amount of money will be paid on this particular date. And in the next these 3 months or 5 months or 6 months, this date will be the amount. On this date, this amount will be paid. So you have to give actual schedule of payment. It's not like you are saying, I will make payment in the next 3 months. Now in next 3 months, might be possible the person is thinking about I will make the payment one day prior to the 3 months completes. But no, such kind of transaction won't be done. You have to give the exact payment schedule. Now unconditional assurance. Bank's irrevocable commitment to make payment upon demand without protest or additional condition if the importer fails to pay. Okay, so what we are saying, unconditional assurance. So bank does what? Bank's irrevocable commitment to do what? To make the payment upon the demand without protest or additional condition if importer fails to pay. So definitely every bank guarantee becomes active when the buyer defaults, when the importer defaults. So bank have to give the unconditional assurance. So banks typically include verbatim reproduction of the payment schedule for the main contract, from the main contract within the guarantee document to ensure the clarity as well as to prevent the disputes. Okay. Now legal principles which actually govern the deferred payment guarantee. First, primary and independent liability. So bank's obligation is independent of underlying commercial contract between the buyers and seller. So the principle of autonomy applies fully to deferred payment guarantee as with other bank guarantee. Okay, so definitely the bank's obligation is independent. Doesn't matter what's happening in a commercial contract between buyer and seller. Okay, now unconditional payment obligation. So bank must pay without the demur or protest. So when a guarantee is properly invoked, regardless of the dispute in underlying transaction, then limited defenses should be there. So bank cannot refuse payment based on defective goods or other contractual disputes between the importer and exporter. Bank have to make the payment. Okay, so bank guarantee operates as an independent financial obligation separate from the underlying contract. That's how the bank guarantee works. Now the advance uses bills of exchange with deferred payment guarantee is, so we have an enhanced flexibility for the exporter. Like in every sophisticated DPG or deferred payment guarantee arrangement, the exporters may draw the usance bill. Usance bill means uses bill on the importer for each deferred installment with payment guaranteed by issuing bank. Okay, every installment will be guaranteed by the issuing bank there. So this approach creates negotiable instrument that can be first discounted with the exporter's bank for immediate liquidity. Like if immediate liquidity is required to the exporter, what exporter can do? Exporter can go to its bank and take that money. Exporter can go to its bank and take that money. Immediate cash can be taken. Second, held until maturity for the full payment, or if exporter do not require money immediately, they can wait for the maturity to get the full payment, or they can sold to the third parties in secondary market. That's the also option. And fourth, we have used as a collateral for other financing. Like you can use those deferred payment guarantee as a collateral for taking loan to or by performing any other financing. So these are the uses we have for the deferred payment guarantee. So this mechanism effectively transforms future guaranteed payment into present value financial instrument, which enhance the exporter's working capital position. Okay. So these are the advantages that will be seen to the deferred payment guarantee. Now, key takeaways of this is that capital financing solution we have. If you are having a deferred payment guarantee, we found the solution of capital financing. So it facilitates trade of high value capital goods by spreading the payment burden over time while maintaining the security for sellers as well. So like the requirement of capital for the purpose of doing business will be resolved here for the both, for buyers and sellers as well. Risk mitigation is there. So transfer the payment risk from exporter to the banking institution. It enables international transaction that might otherwise be too risky. So if you are doing an international transaction, it have a more risk in comparison to national, because you don't know that person. You have never met that person with whom you are performing any kind of export or import transaction. So it minimizes the risk. Documentation requires clear payment schedule, precise the terms, careful structuring to ensure enforceability and full regulatory requirements. So documentation is also very important part of this. Then bank's role, the bank undertake unconditional obligation to make the payment according to the schedule, independent of dispute in the underlying commercial transaction. So if we have given a payment schedule of every month, 20th of every month, the amount of $100 have to be paid to the exporter. The bank have that obligation, unconditional obligation to make that payment. Okay. Now, deferred payment guarantee represent a sophisticated financing mechanism that bridges the gap between exporter need for payment securities and importer need for flexible financing of capital investment. Okay, so this is the key takeaway of the deferred payment guarantee. So as you can see, as per section 126, okay, we are talking about section 126 of Indian Contract Act 1872. A guarantee is a contract to perform the promise or discharge the liability of a third person in case of letters default. What we are saying here, simply in the section 126 of Indian Contract Act 1872, it has been said that guarantee is what? Guarantee is simply a contract which actually talks about to perform the promise or discharge the liability of a third person in case of letters default. Okay, so the bank guarantee actually promises in a contract to perform the payment or discharge the liability of a third person in case the letter actually defaults. So bank guarantee actually becomes active once the buyer defaults. When the letters default, then in that case the bank guarantee actually became active. Okay, if let's say there is no default from the side of the buyer, then the bank guarantee won't be required to be performed. But after the default, the bank guarantee have to be performed. So a guarantee may be either oral or written. Okay, and the question whether a particular contract is a contract of indemnity or guarantee has to be decided by examining the language of the document entered into between the parties and the nature of transaction. So are we talking about the contract of indemnity or a bank guarantee contract? That will be understood and that will be identified on the basis of the language written on the contract. On that basis, we decide that this is a bank guarantee or a contract of indemnity. Okay, I guess contract of indemnity you all have heard somehow when you study the insurance, or when you actually provide insurance policy to the customer, you let them understand this contract of indemnity. So contract of indemnity simply says that the one party is promising to make the financial good financial loss good for you in case of default. Or we can say whenever we take the insurance from any company or any party, that insurance gives us kind of surety that in case of any financial loss, you will be getting your claim back. So indemnity actually means making good the loss. That's the indemnity. And that's how the contract of indemnity we talk about. So in commercial transaction, banks, customers are sometimes required to give a bank guarantee. And this is generally an alternative to keeping cash as a security deposit. Okay, so whenever there is a commercial transactions going on, trading transaction or business transactions are going on, banks, customer, they use the bank guarantee there. The bank guarantee actually make their credit worthiness better. Okay, so this is what, this is generally an alternative to keeping cash as a security deposit. Okay, so the third party who seeks the guarantee, not being aware of the customer's financial standing, prefers a bank guarantee. Okay, so what we are saying here, the third party who does what? Who seeks the guarantee, not being aware of the customer's financial standing. Hana, it prefers a what? It prefers a bank guarantee. So that will be covered here. Okay, so bank guarantee is kind of a non-fund based credit facility in which bank actually not lend money to the customer, but they lend their name to the customer, and that name of a bank gives the better credit worthiness to the customer. Okay, now in turn, the bank, which understands the financial standing of the customer well, undertakes to guarantee customer's financial commitment or performance of the contract by him. So what bank does? Bank actually take responsibility, or bank actually give a kind of support to the customer by involving in the customer's transaction, by providing or by lending their name to the customer, in which they says that this customer will perform better services for you. Okay, like they are giving for the customer's financial commitment. Bank is giving bank guarantee for the customer financial commitment, that no matter what, if the payment have to be done in a future by the customer, the bank gives the guarantee that yes, this customer will make the payment of your transaction in the future. Okay, and also the performance of the contract, like the whatever the contract have been signed between the two parties, bank takes the responsibility of that, or banks gives the guarantee on that, that this contract will be fulfilled properly by the customer. That's how bank increases the credit worthiness of a customer, okay, by providing them the bank guarantee. So the bank charges a commission for this service, which depends on the security available and the financial stability of the customer. So definitely, if bank is lending their name to the customer, bank will charge something about it. So bank will take simply a commission, and the amount of commission depends case to case basis, like how much financial stability the customer have, how much capability of a customer is there. On the basis of that, bank decides the claim, or we can say the commission. Okay, now the parties to the contract, how many parties will be there? The person who gives the guarantee is called surety. Okay, the person who gives the guarantee is called what? Surety. The person in respect of whose default the guarantee is given, called the principal debtor. Okay, we are saying the person in respect of whose default, like the person who defaulted actually, and because of him we have given the guarantee, that person is called as a principal debtor. The person to whom the guarantee is given is called creditor or beneficiary. So we have three parties. Let's say Mr. A is there, Mr. B is there. Okay, one is a seller and one is a buyer. Okay, and they have taken a bank guarantee from Punjab National Bank or any other bank, let's say for example. Now this PNB will give the guarantee. This PNB is the surety. Okay, the person respective of whose default the guarantee is given, so that person will be Mr. B, that's a principal debtor. Okay, and Mr. A, he will become the beneficiary, or you can call him the creditor. Okay, because now B is going to the Punjab National Bank and asking for a bank guarantee, and Punjab National Bank is giving bank guarantee to Mr. B, and B is a buyer, so B have to make payment in the future of Mr. A, but Mr. A actually become the beneficiary here, because he will get the benefit of the bank guarantee. And if the buyer defaults, it means Mr. B defaults, still Mr. A will get the payment because the bank guarantee have been given to him. Okay, so this is how the bank guarantee works. Now, Section 128 of Indian Contract Act 1872 provides that the liability of the guarantor is coextensive with principal debtor. So the Indian Contract Act is Section 182 is saying that simply it provides the liability of the guarantor is coextensive with the principal debtor. Okay, so what we are saying, principal debtor means the person who have to make the payment and the person who might be defaulting in the future. With that person, the liability will be of a guarantor as well. Like the bank also have liability. If Mr. B defaults in the future and do not make the payment to Mr. A, then bank's liability is there that bank have to make that payment complete. Okay, that's why we are saying that the guarantee, liability of the guarantee is coexistence. Okay, with whom? With the principal debtor. Now, RBI also wired its circular dated September 2014 on willful defaulter. Willful defaulter means those defaulter who have sufficient amount of money to repay the loan of a customer or to perform the certain transaction, but they willingly not doing so. That's the willful defaulter. So clarified that when a payment default is made by the principal debtor, the bank is entitled to proceed against the guarantor or surety, even without exhausting the remedies against the principal debtor. Okay, so what we are saying that simply it have been clarified that when a payment default is made by the principal debtor, the bank is entitled to proceed against the guarantee or surety, and even without exhausting the remedies against the principal debtor. Okay, so because bank have given their name in the guarantee, so if the principal debtor defaults, the bank have to make that transaction complete. Okay, that is covered here. Now, principle of contract to be compiled. So all the principles and rules which apply to other contract, like what can form consideration, what would be valid contract, also apply to a contract of guarantee. Okay, these all principles will apply. Also, injection against encashment of bank guarantee without establishing fraud or irretrievable injustice is not granted. In case of Dotsal Limited versus Kinshuk Bharti Cooperative Limited. In this case, that we are saying that injection against the encashment of the bank guarantee without establishing a fraud or irretrievable injustice is not granted. So bank guarantee only becomes active when the buyer defaults, or we can say the principal debtor defaults. Okay, now an unconditional irrevocable bank guarantee provides inter alia for encashment on demand without demur. Okay, so if we have an unconditional irrevocable bank guarantee, then it will give encashment on demand without any demur. Okay, now bank guarantee. So as per section 126 of Indian Contract Act 1872, a contract of guarantee is a contract to perform the promise or discharge the liability of a third person in case of default, that we have seen. Like other guarantee, bank guarantee is also a trilateral contract between the principal debtor, creditor and the surety. Okay, so bank guarantee is also what? It is also a trilateral contract where the principal debtor will be there who will ask to make the bank guarantee. The creditor or beneficiary will be there who will get the benefit of that bank guarantee, and the surety, it means bank will be involved who is giving the guarantee. So these three parties will be there in the bank guarantee. Okay, so the term bank guarantee briefly states that a guarantee given by a bank to a third person to pay him a certain sum on behalf of bank customer on the customer failing to fulfill any contractual or legal obligation towards the third person. Okay, so simply as I keep saying that bank guarantee is your guarantee which becomes active once the principal debtor defaults. If principal debtor is not defaulting in the transaction, then the bank guarantee do not have to be fulfilled. Okay, so that's what we're talking about here as well. Now, the parties to the contract of bank guarantee are first applicant borrower, that is the principal debtor, the person at whose request the guarantee is executed. So you can call it a applicant borrower, you can call it a principal debtor. Then beneficiary, you can call it a creditor as well, the person to whom the guarantee is given and who can enforce it in case of default. And the guarantor bank, that is also called as a surety, the lending bank who undertakes to discharge the obligation of the applicant in case of his default. So the guarantee is a collateral contract consequential to a main contract between the applicant and the beneficiary. So this is what the parties to the contract of bank guarantee actually means. Okay, now if we talk about the types of bank guarantee, we have three types of bank guarantee. One is talking about financial guarantee, that gives the guarantee for the financial transaction in the particular trade between two parties. Then performance guarantee is there. Performance guarantee is simply, it talks about that whatever standard have been given in the contract, like this kind of way have to be done, the work have to be completed, or this kind of transaction have to be completed, then the same type of performance have been completed or not, that talks about the performance guarantee. Then deferred payment guarantee, like an installment payment guarantee we are talking about. So financial guarantee, performance guarantee, and deferred payment guarantee, these are the three types of guarantees we have. Now issuance of bank guarantee, like precautions that have to be taken. First, amount guaranteed, like what amount of money you are allowing or you are providing the bank guarantee to. So the first you have to check the amount guaranteed or not, like the amount you are agreed to give the bank guarantee, is it actually available or not, or actually will be coming to you or not in the future. Period of guarantee, for how long you will be providing this guarantee, like this transaction is going for 1 year, for 5 years, for 10 years, whatever the duration of that particular transaction between the two parties. Okay, that you have to check that what period of guarantee they are asking for. Claim period in a guarantee, when a party is ready to claim and after how much time the party have to go and claim for their money. Amendment to section 28 of Indian Contract Act and its effect on bank guarantee have been done. So the section 28, the amendment happened, that have to be followed, and the counter guarantee and other securities have to be taken care of. Like if any other counter guarantee on the same transaction is going on or not, and the other securities have been given for the guarantee or not. Like definitely if you are providing guarantee to someone, you have to take something as a security, so that if the principal debtor defaults and you have to fulfill the liability, in that case you will also have some security to recover your money. That's why the counter guarantee and the other security have to be taken care of. Okay, so these are the points that have to be taken while you are providing any kind of bank guarantee, right? So this is the bank guarantee and contract of indemnity. Now the types of bank guarantee, financial performance, and the deferred payment, we have to cover all of these in detail as well. Okay, so that you can check on the detailed batches of ours, in which we will be studying these chapters and these units in very detail. So now let's move forward and discuss one or two questions about the same chapter. The first is saying the person in whose favor a bank guarantee is issued called a or an dash. Like the person on whose favor we are issuing the bank guarantee is called as or an what? An issuer, a banker, an indemnifier, a beneficiary. What will be the answer of this question? A, B, C, or D? Which one will be correct? Let me know. A, B, C, or D, which one is correct? So simply the question is asking that in case we are saying the person in whose favor a bank guarantee is issued, whose favor the bank guarantee is issued. Okay, the person in whose favor the bank guarantee is issued called as called a or an. Simply it's a beneficiary. You can call it a beneficiary, you can call it a creditor. So right answer will be D. Creditor or a beneficiary. So right answer will be your D option. Okay, so because in whose favor you are issuing, so in whose favor you are issuing for Mr. A, let's say for example. So Mr. A will be the beneficiary or the creditor. Okay, now in bank guarantee the bank makes payment on dash. In bank guarantee the banks make payment on dash. First, being convinced that the beneficiary has incurred loss, being sued by the beneficiary, the guarantee being invoked after seeking concurrence of the debtor, merely on demand by the beneficiary. So which one is correct? A, B, C, or D? Okay. So we are saying bank guarantees, the bank makes payment by convinced that the beneficiary has incurred loss? No. Being sued by the beneficiary? No. The guarantee being invoked after seeking concurrence of the debtor? No. Merely on demand by the beneficiary. That's the true answer. So right answer will be again D option. Okay. Right answer we have is the D option.
When we talk about NPA, that is non-performing asset, we talk about one thing only, that is the asset which has been created thanks to the credit disbursal. Fine. The asset of the bank which has been disbursed to a particular individual or the business entity, it is now non-performing. For what? For the bank. It is non-performing for the bank. And when we talk about non-performing, how you can measure it? Because bank has provided the credit to the customer. Now, not only the principal amount is being recovered, not being recovered, but along with that, rate of interest, which was the profit of the bank, is not being delivered to the banking channels. That is why we term such loans where not only the principal but no interest is being repaid to the quantum what was imagined by the bank while lending the particular credit. Okay, so when we talk about the background from where the classification or the importance of classifying a particular loan account into NPA started, let's see one by one what the book says here. In line with the international practices and as per the recommendations made by Committee on Financial System, which was headed by Mr. Narasimham, the RBI introduced in a phased manner prudential norms. Now this term, that is prudential norm, this term you must know that what is the exact meaning of this term, because only after the introduction of prudential norms, we the bankers, we are able to know for sure that whether a particular loan account is turning into a bad asset or not. So these norms were prescribed by the RBI for income recognition. What is the income recognition parameter there? Then asset classification. What type of asset is there, and we are classifying it on various basis, and provisioning for the advances portfolio of the bank. So keep this thing in mind. Whenever I talk about the prudential norms, they are for the advances. That is the first thing which we must remember, whatever advances the bank has delivered. Secondly, the most important part of prudential norms is IRAC norm or IRAC rating also you can say, because nowadays banks provide some rating, right, from 0 to 9. And this IR in IRAC stands for income recognition. And when I talk about the AC, it stands for asset classification. As we move further in this chapter, you will come to know that what do we mean exactly by the IRAC norms. Okay, so if you have not subscribed yet our channel, it is highly recommended that you should subscribe the channel. And if you have any kind of doubt, I'm just watching your questions also. Meanwhile, you can ask me in the comment section as well. Okay, so when I talk about the most important part of this chapter, you must know that what is a prudential norm. We'll be looking into that elaborately in the classes, in the paid classes, but shortly in an overview manner in this particular lecture also. And these prudential norms were there introduced by the RBI to move towards greater consistency and transparency in the published accounts. Fine. Published accounts are those accounts which have been opened by the banks. Fine. Already opened by the banks. Now, when we talk about NPA, what is the exact definition? The simplistic definition here we have seen that non-performing and asset, these are the two words from which we have defined the NPA. What does the exact definition of NPA says? Let's see. An asset, including the leased asset, becomes an NPA when it ceases to generate the income for the bank. Fine. Simplistic definition is more or less written here again, because the generation of income of a bank was based on the rate of interest, not the principal. Principal is already with the bank. Fine. They wanted to earn more via rate of interest. But since the asset is not providing that income, that channel of you can say income enhancement of the bank has not been so fruitful as it should be. That is why we are telling that now a particular loan account has turned NPA. When I talk about the various definitions, the technical definitions of NPA based on various types of loan accounts, let's see them one by one. First of all, let's try to define the NPA in case of term loan. So term loan, as you know, that 90 days norm is there normally. NPA, I hope at least this much everybody knows that for the commercial banks, the norm is that if the repayment is not happening in a particular loan account for more than 90 days, then we term a particular loan account as NPA. Simple. But what is the further classification based on the CCOD account or for that matter bills? Let's see. Term loans, the interest and or the installment of the principal remaining overdue for a period of more than 90 days. No repayment has been credited to the loan account from the borrower's end for more than 90 days in a term loan. Then we will say what? The account has turned NPA. Second, the type of account is overdraft, which is also known as OD account, and cash credit, which is also known as CC. Here, the account remains out of order for a long duration of time, because when we talk about the credit which has to be delivered by the borrower in these types of accounts, CCOD accounts, it is not in a regular manner as it should be in the term loan. Fine. In term loans, mostly we have the EMI concept, but here the credit should be provided within a stipulated time period. That is it. No need to provide on monthly basis according to the usage of that cash credit or for that matter overdraft. You will be repaying the amount to the bank. Fine. So if it remains out of the order, then again it has become NPA. The third important classification is bills purchased and discounted. So all those bills purchased, the activities which are happening based on the bill. So bill we have seen in the earlier chapters of PPP that supposingly X and Y enter a particular transaction, that X has provided some goods and services to Y, and Y has promised to pay 100 crore in future, but X wants to have some money. Fine. So it will be providing a bill to Y. Now this bill will serve a benchmark for both of these parties, for X also, for Y also. Both of them can negotiate this bill based on their requirement. What X can do, X can approach the bank, a particular bank, and based on the bill that yes, my repayment will be done within, let's suppose, 2 months, fine, of 100 crore. I want you to give me at least 99 crore and I will discount 1 crore for you. I am in urgent need of this money. Via this, X can get certain amount of money. If Y is not having any kind of money, but the party Y is willing to pay back to X in real time, what Y can do? Keep this bill and approach its bank, and via that bank channelize the money in the account of X. Okay. So this is how the bill purchase works, as well as the discounting of the bill. So the bill remains overdue for a time period of more than 90 days. Then we will be saying that a particular bill purchased and bill discounted scenario or the mechanism has turned into a NPA. Now, when I talk about the term loans, oh, okay, this is done. When I talk about the various loans pertaining to agriculture, the agri loans, there, when we talk about long term loans refer to the Kisan Credit Card mostly, fine, KCC accounts. These accounts are more or less being adjusted on a seasonal basis. Once the cultivation is done and the harvesting has been completed, then the bank will require to have the limit renewed by the customer. Not the annual renewal, no, the renewal based on the season. Let's just see what happens in case of agri credit when we talk about the NPA. So two crop seasons for short duration crops. Fine. Whenever we say that short term crops we are sowing and we will be reaping the harvest on 6 month basis. So for that, two crop seasons will be calculated. For long duration crops, just a single season will be there as the benchmark. So for two crop season for the short duration crop, installment of the principal or the interest thereon remains overdue for two crop season. Fine. For the two crop season, because this was the time period within which the short duration crops will be harvested twice, but still it is not being done. So after the two crop season has passed, we will say that this loan account has become NPA. Next, when I talk about the long duration crop, installment or principal or the interest remains overdue for one crop season. Fine, single season here, it will be termed as NPA. Then securitization transaction undertaken in terms of RBI direction on the securitization of the standard assets. Fine, if we talk about the immovable assets, or for that matter, the liquidity facility which has been provided by the banks to a particular customer, if the amount of that liquidity facility remains outstanding for more than 90 days, then also what will happen? The loan account will turn into NPA. For the derivative transactions, although the time period of 90 days is calculated as a standard, but some important aspects are also there beyond the 90 days concept. The overdue receivables representing positive market to market value of a derivative contract, if these remain unpaid for a time period of 90 days from the specified due date for the payment. So always remember, in the derivative transactions, if due date, fine, if the due date has been passed for the past 90 days, supposingly the due date was in February, fine, 1st of February, that the payment of the derivative must be made by 1st of February. But the month of March has passed, fine, March, then April. So 28 days here, 30 here, and you can say 31 and 30 here. So more than 90 days have passed and still no payment of the derivative has been made. So I will say what? This derivative transaction has been since overdue for a longer time, more than 90 days. That is why the particular asset which was being delivered from the bank side has turned non-performing, and we will term the account as NPA. Okay, now what is this out of order status? As we were discussing in CCOD accounts, that if the particular CCOD account is out of order, then we will say that account has been turned NPA. So here out of order means the outstanding balance remains continuously in excess of the sanction limit or the DP, that is drawing power. Always remember, in CCOD limit, you will be having some drawing power with beyond which you are not allowed to draw. If you draw beyond this drawing power, you have to take into consideration the banking norms. And when we talk about the overdraft, if it is regularly having some outstanding beyond 90 days, then we would say NPA has occurred. Outstanding balance in the CCOD account is less than the sanctioned limit or the DP, but there are no credits continuously for 90 days, or the outstanding balance in the CCOD account is less than the sanctioned limit or the drawing power, but the credits are not enough to cover the interest debits during the previous 90 days. Supposingly DP was 2 lakh and the borrower has utilized the entire 2 lakh, fine. So it will become what? Zero. Drawing power will be zero for that time. Now the borrower comes and say that, okay, let's just credit rupees 1 lakh here, and the DP now will stand at 1 lakh. But whether this drawing power is equal to the original one, answer is no. And if this happens continuously for 90 days, then we would say account has turned NPA. And this drawing power, although in most of the accounts is calculated annually, but for quarterly basis as well as semi-annually, we have certain mechanism of calculation, and it depends from bank to bank as well as depends upon the type of accounts as well. Okay, so out of order, I hope now you know for sure that what do we mean exactly by the out of order status. Next, when I talk about the income recognition policy, how you will be recognizing a particular income, that yes, the IRAC norms which are part of prudential norms. So IRAC norms, we were just discussing these. Here, IR is what? The income recognition. What is the exact policy for the income recognition? Let's see. So internationally, income is not recognized from an NPA on an accrual basis, but is booked as income only when it is actually received. Fine. So income of the bank will be recognized only when you have already repaid the entire amount. Fine. That is very, very important to know. The basic norms are to be followed for income recognition, starting with the banks should not charge and take to the income account interest on any NPA, including the case of government guaranteed accounts. Fine. So banks cannot charge or take to the income account any kind of interest on the NPA. So if a particular bank account has already turned NPA, the banks cannot just say that whatever additional income I will be having because of the rate of interest not fulfilled here in the NPA account, that particular income is not a part of this income recognition. First point. The interest on the advances against the term deposit, NSC, IVP, Kisan Vikas Patra, life insurance policies are taken to the income account on due date, provided adequate margin is available in the accounts. If the margin is available in those respective accounts, then only you can say that yes, the particular income which is generated has been recognized as the income of the commercial bank. The fees and commissions earned because of the renegotiations, the rescheduling of the outstanding debts should be recognized on accrual basis. Fine. Accrual basis means once a particular transaction has been done, after that you are having some particular right over that income which has been generated over the period of time covered by the renegotiated or rescheduled extension of the credit. So if just in case the NPA account, a particular account has become NPA or is in line to become an NPA account, then banks can intervene via credit monitoring, which we have studied in our unit number 24. Fine. So if a particular bank is engaged in credit monitoring, regular credit monitoring is going on, then some repayment schedule tweakings will be there and the particular account will not be turning into NPA. But the income generated between those activities is not the income of the bank. Okay, it is the income adjusted because you are already going for the NPA provisioning norms. Next is reversal of income. In the case of interest income, it should be reversed or provided for if the same is not realized. So it will be reversed or refunded, you can say. Fees as well as commission. In respect of NPA, the fee or commission plus any other similar income, the charges that have accrued will cease to accrue in the current period and reversed or provided for with respect to the past periods if uncollected. Okay, so it will be reversed. Always remember, which is known as the reversal of income. When I talk about the appropriation of recovery in NPAs, there one interest application is there. So when I talk about the interest application, the banks will be reversing the interest already charged and not collecting by debiting the profit and loss account, that is P&L, and stop further application of the interest as well. However, the banks may continue to record such accrued interest in a memorandum account in their books. So they will be recording that yes, this particular accrued interest has been charged over a particular account. We have not collected it by debiting the P&L account. Still, we are just making a record. We are keeping the record of this accrued interest. That is how the banks function. Reporting of the NPAs, the banks are required to furnish a report on NPAs on the 31st of March each year after the completion of audit. Fine, that is the timeline. You always remember reporting of NPAs, they are done on 31st of March every year. When we talk about indemnity as such, where have you heard it mostly? In the insurance, right? Because insurance, you might have understood one concept there while reading the insurance concepts, insurance companies concepts in IFS also. that indemnity refers to something related to loss of a third party. If a particular, you can say individual or a business unit, it is having certain kind of losses in the businesses, or for that matter, personal loss, and if it has a coverage based on the insurance contract, then you can say that the indemnity is in play. And according to the Indian Contract Act 1875, what is the exact definition of indemnity contract? Let's see. So section 124 of the Indemnity Contract Act defines the contract of indemnity as a contract by which one party promises to save the other from loss caused to him by the conduct of the promiser himself or by the conduct of any other person. It is called as the contract of indemnity. And why we have taken the example of insurance? Because supposingly you are having a car insurance with you. Okay, the car is being insured by one insurance company, and you incur certain loss due to one accident. Fine, unfortunate accident happened and you incurred certain loss on the physical part of your car. Fine, the damages are physical damage. Now, since the car has been insured, a contract of indemnity has been signed by you as well as being pledged on your behalf by the insurer also. So you can directly fulfill whatever loss has been incurred. Why? Because you have entered into this indemnity contract. So when we talk about the unit number 1, where we have studied the various customer and banker relationship, there one term was indemnifier and indemnified. This type of relationship is also enjoyed by the customer and the banker. Between the customer and the banker, this type of situation or this type of relationship is also there. There also, we have seen that bank is the indemnified or the indemnity holder, and the customer will be the indemnifier. Bank will be providing these services. So whosoever is providing the service, that particular entity will be the indemnified or the indemnity holder, and the customer or the individual for which that service is performed will be known as the indemnifier. So contract by which one party promises to save the other from the loss caused to him by the conduct of promiser, that is the particular person, the customer himself, for any or for the conduct of any other person also is known as the contract of indemnity, that we have seen here as well. When we talk about the examples, so examples will be the transaction of issue of duplicate. In case of the bank, you will say that the transactions including the issue of duplicate demand draft, the DD, right? If supposedly you have issued, the bank has issued one demand draft to you, that is you are the customer. Don't assume yourself as a banker just for now. You are just a customer and the bank has issued one DD in your name. Now, supposedly you have lost that DD. Now, what will happen? The bank will provide you a duplicate DD in lieu of certain fees, certain service charge. Similarly, the FDR, the duplicate FDR, if you have lost the original FDR, the fixed deposit receipt, the bank will provide you the duplicate FDR, but in lieu of some fees. In these cases, the person availing the facility will compensate the other for any kind of loss arising from the wrong or the excess payment. Fine. So that's how the law of indemnity work also. Whosoever has incurred certain loss, here the bank has incurred certain loss, right? Because you have not you have not kept the particular FDR, or for that matter the DD receipt very in a particular original format, and you have lost that. Now it is the duty of the bank, obviously, because they are providing the services to you, so they will provide a duplicate DD or the FDR. In the contract of indemnity, the promise is to compensate for any kind of loss incurred due to the action of the indemnifier or any other person. Fine. So the customer, as we were saying, it is known as the indemnifier, and the particular bank or particular insurer also who is performing the duty or providing the service to the customer is known as the indemnity holder or the indemnified. In case of the contract of guarantee. See, parallelly we will be understanding the difference also between the contract of indemnity and contract of guarantee. Why? Because sometimes we feel that contract of guarantee is more or less similar to the indemnity contract, but it is not. So here in contract of indemnity, the compensation for any kind of loss incurred will be done by the indemnified or the indemnity holder. Whereas in the contract of guarantee, the promise is to perform any obligation or pay for a liability in the case of default by the third party. So payment is at stake, not the entire asset. The contract of indemnity involves two parties only, that is the indemnifier and the indemnity holder, whereas the guarantee involves debtor, creditor, and the surety. Fine. So the perfect example or the difference via which you can easily understand the difference of contract of indemnity and guarantee contract is the car loan. Fine. In car loan, what happens? Sometimes we take a guarantor. Fine. So the primary holder of the account will the primary applicant of a particular account, that is of the car loan, will be there, and that particular primary applicant will be assured by the guarantor that yes, if you are not paying the money back to the bank, I will on your behalf repay whatever the amount is due. And this particular guarantor will be having a direct contract with the bank. Whereas in case of the contract of indemnity, what is happening? In case of contract of indemnity, only the bank and the customer directly are linked, or for that matter, for this car loan only, the same case. Let's just uh, utilize this particular example only. In case of car loan, you will have the insurance also. Fine. In insurance, you will find one is the insurer and the another one is the customer. So here the customer will be provided some services directly by the insurer without any third party involved. But in the guarantor case or the case of you can say the contract of guarantee, you will find a third party involved. Okay. Now let's see the indemnity contract with one more example. Supposingly a contract is there wherein A contracts to indemnify B against the consequences of any proceedings which C may take against B in respect of a certain sum of rupees 200. So here there are three parties involved. One is A, then we have B also, and after that we also have C. So A has uh, accomplished the contract to indemnify B. So this particular A will be the indemnity holder. Fine. Indemnity holder. And B will be what? The particular individual B, it will be known as the indemnified. Fine. Indemnified. Okay. Or the you can say indemnity holder. Let's just revisit this particular thing, and let me just rephrase this thing for you. Okay. There are three individuals, 1, 2, and 3. So in A, you will find that A contracts to indemnify B. So A has contracted to indemnify B against any consequences of any proceedings which a particular individual or entity C may take against B. So C is taking any task or any action against B. In this particular illustration, what will happen? The person giving the promise, fine, A is giving the promise, so that person will be the indemnifier. The person to whom the promise is being made, that is B, is known as indemnified or the indemnity holder. So in this particular case, B will be what? Indemnity holder. But when we were talking about the bank, see here, bank was the indemnity holder for this particular case. Fine. Because the particular bank is not at a, you can say is not defaulting in paying the services or in providing the services, but the particular customer has defaulted on the basis of losing the FDR or the demand draft. But here we are talking about the another example more suited for the insurance contract. That's why it was the promise made by A will be termed as the indemnifier and B will be the indemnified or the indemnity holder. So whosoever is providing or giving the promise is known as the indemnifier, that yes, you provide me the duplicate FDR, I will be providing you with the required fee. And bank which is providing the services will be known as the indemnity holder. But when we talk about the insurance, for the insurance, B is the customer and the customer will be known as the indemnity holder. Okay. Now, when I talk about the distinctive features of indemnity contract and the guarantee, you will find two things. First, the number of parties to the contract. Second, the contingent risk involved. Along with that, there are two more. That is what is the nature of liability and what is the exact purpose of this contract, whichever you have, gone into the particular setup. So the number of parties to the contract, it defines two things. In a contract of indemnity, there are two parties only, the indemnifier and the indemnified. I hope now it is very, very clear to all of you that what is the difference between indemnifier and the indemnified, or for that matter, the indemnity holder. In a contract of guarantee, there are three parties, that is the debtor, creditor, and the surety. Surety is the person who provides the guarantee. When we talk about the guarantee, the contingent risk, in indemnity, the risk is contingent, fine. You will be having a direct relation with a particular second party, first party, second party, but not the third party. In a guarantee, liability is subsisting, fine. You cannot just say that if a particular person has defaulted, I won't be able to get my funds back. No, there is a guarantor involved. Nature of liability for the indemnity, indemnifier is required to make good the loss as soon as it occurs, whereas in the contract of guarantee, the surety's liability is secondary and the principal debtor is primarily liable. Okay, so liability lies with the guarantor in case of the contract of guarantee. Fine. Then we have the purpose of contract. The indemnity is for the reimbursement of a loss, whereas the guarantee is for the security of the creditor. Fine. So when we talk about the principal debtor is primary liable here in case of the guarantee, but the ultimate guarantee will also be applicable to the guarantor also in contract of guarantee. But here the purpose of contract, you will find that indemnity is for the reimbursement of a loss. Right? Some loss has occurred and now you are providing certain service against that loss. On the other hand, on the contrary, when we talk about the particular security for the creditor, it is the only case for which we provide the guarantee. Right? So the contract of guarantee will have just one thing, that it must provide the security to the creditor. Next, when I talk about the rights of indemnity holder, in this case, the indemnity holder will be having certain rights. And again, I'm reiterating this fact. In case of banks, who will be the indemnity holder? The bank will be the indemnity holder. Fine. And in case of the insurance companies, fine. In case of insurance, who will be the indemnity holder? The customer. Fine. Okay. So all the damages which he may be compelled to pay in a, that is the particular right, that yes, I have paid premium for this particular insurance and I will be having all the damages covered. All the costs which he may be compelled to pay in any such suit, any cost which is involved there, all the sums which he may have paid under the terms of any compromise of any kind of such suit. So all these things will be paid by the insurer. Just
keep one example in your mind, things will be more clearer. Then we have the factors affecting the claims of indemnity holder. What are the factors? Fine, which will be responsible for affecting any kind of claim which the indemnity holder claims. So the damage, what is the type of damage, whether it is included in the insurance policy or not. The liability commences only when the indemnity holder actually incurs loss. Fine. It's not like that you are paying premium. So after 1 year or whatever time period is there for your insurance policy, you will be repaid the entire premium along with the rate of interest or along with the interest payment. No, nothing like that. Only if there is a damage or you have incurred any loss, then only you will be having the money. So costs, in case of cost, we have to, the cost paid to the solicitors, that is the lawyers who are involved, traveling expenses, and also the cost reasonably incurred in resisting or reducing or ascertaining the claim may be recovered. Various policies, you have n number of policies, they will be having these details. Then sum paid on compromise. This is defined specifically in section 125. So as per the section 125, if the indemnity holder acts within the scope of his authority, then he is entitled to recover from the indemnifier all the sums that he may have paid pursuant to a compromise in a suit. So supposingly in this example of insurance only, the particular customer is not having any kind of support from the insurer at first place. So he has to pay some money, right? Now this person, let's suppose A, approaches the court. There, the settlement will be done in the favor of person A or the individual A, and whatever he or she has paid will be recovered by the court and adjusted in the account. Then what is the scope and application of indemnity contract? To the banks. So the customers of the bank who have lost any DD or a traveler's check are required to give an indemnity. So the customer will be providing the indemnity in case of bank before the issuance of a fresh instrument in return of the lost one. Indemnity bonds are also insisted by the bankers while issuing the FDRs, settling the death claim to the heirs, or while issuing the duplicate pay orders. That's it. Nothing else is required from the end of banks. Directly, one particular indemnity bond will be there. But nowadays, when we talk about the practical banking, indemnity bond is not there, but yes, one letter is being signed by the customer acknowledging that yes, the particular FDR or for that matter DD has been lost at. When I talk about the letter of credit, it is not only a part of your JAIIB examination, but in CAIIB also you will find it mentioned. So if you understand from the basic, from the scratch, you would be able to decipher the very obvious part in the CAIIB as well. I think that in CIIB, in BFM, it is covered. So let's introduce the letter of credit. When we talk about credit, you might have seen that banks provide some types of facilities under the head that is credit. Some are the fund-based facilities, fine, and another type is non-fund-based facility. So fund-based facility, everybody knows that where the bank is providing some funds to the customer. Bank is acting as a creditor for that particular debtor. But when we talk about the non-fund based facilities, there no type of fund is involved, no money is involved as such. Although if the recovery is initiated for these non-fund based facilities, then again money will be involved. But prima facie, primarily, there is no money involved. That you must be very, very clear. And in the previous chapters, we have seen the types of non-fund based facilities, starting off with the guarantees, the bank guarantees for that matter, and some other forms. Plus, we have also seen one term that is letter of credit. Today, we will be defining this term elaborately. Fine. Briefly, we have discussed in the previous chapter what is letter of credit. Today, let's define it from the scratch. So letter of credit is also known as the documentary credit. Although
the more prominent name is the letter of credit LC, but yes, DC is also one of the synonym of your letter of credit. It is a very common instrument used for trade settlements across the globe. So mind it when I say that letter of credit is not available for the domestic trade. Directly you can eliminate that option if in the question it is being asked. So domestic trade does not have any type of letter of credit mechanism involved. But as we talk about the international trade, there only the particular, you can say, concept or mechanism of letter of credit is initiated. And what is the basic here? The basic phenomena why the letter of credit is initiated is the lack of trust. Fine. Lack of trust is the only thing because of which letter of credit as an instrument started off in the international trade. And lack of trust, you might be thinking that lack of trust is on the side of the seller or the buyer. Mostly we see that in case of bills of exchange, the sellers are having lack of trust and they want to quickly recover their money, and that's why they exchange their bill discount their bills. But here in the letter of credit, not only seller, but the buyer is also having some apprehensions. The buyers are also having a certain lack of trust that whether whatever goods or the services for which we have summoned the seller, we will get them or not. So both the parties, seller as well as buyer, they are having some trust deficit in their trade. That is why we introduce the documentary credit or the letter of credit known as LC. So what is the definition of this LC or documentary credit? Basically, this letter of credit involves majorly four parties. Fine. The minimum parties involved are four. And what all four parties are there? One will be the seller, another will be the buyer. Then we have the seller's bank, and one we have the buyer's bank. These are the minimum parties. So all these four parties will be involved. Apart from them, two more parties can be there, or I would say one bank of the seller and one additional bank of the buyer can also be there. So more or less, you would see max to max six parties are involved. And how we define the LC? It is a signed or authenticated instrument issued by the buyer's bank. Always remember, the buyer's bank will be issuing the letter of credit, embodying an undertaking to pay the seller a certain amount of money. Why? Because seller has provided the goods and services. Fine. Upon representation of documents evidencing the shipment of goods as specified and compliance of other terms and conditions. Okay, so the trust deficit or the lack of trust which I was talking about, it stems from this, that whether the buyer is apprehensive that whether the shipment of goods for which the payment will be made in due course is going in line with the term and condition or not, whether the buyer will receive the shipment of goods or not. That is the apprehension from the buyer's end. And seller's end, as that it is quite obvious that seller wants the money because it has supplied some goods or services. An undertaking issued by the bank on behalf of the importer. So seller is what? Seller is the exporter who is providing the goods. Buyer will be the importer. So interchangeably these terms are used. So don't get confused whenever there is a case study in the exam. Instead of seller, they can write exporter, and instead of buyer, they can write importer. Why? Because we're talking about international trade. In favor of the exporter, that if the specific or the specified documents showing that a shipment has taken place are presented to the issuing bank or the nominated bank within a stipulated time period, the exporter or the seller will be paid the amount specified. So the buyer's bank will initiate the LC, the issuance of LC, and ultimately the buyer's bank will communicate with the exporters or the seller's bank also that yes, whether the shipment of goods has been done or whether it is in the pipeline or not. And once the bank is satisfied, it will inform the buyer, that is the importer, that yes, now you can release the money as well because the shipment of goods is in line with the terms and condition which you have signed. Okay, so it starts off with the buyer's bank, that you must remember.
what all parties are involved, let's see one by one. When I talk about the number of parties, as stated in the previous slide also, more or less minimum parties are 4. It can go beyond 4 also, and max to max 6 parties in the practical scenario you will see. First of all, you will have the importer or the buyer, who is also the applicant of this LC, letter of credit. Applicant is the buyer or the importer, on whose behalf the LC is opened. And who will open this? Whether the buyer will open it? No, the bank of the buyer or the importer, which is known as issuing bank or the opening bank. So along with the bank of the buyer, or for that matter, bank of the importer, you should also remember what is the designated name of this bank. It will be known as the opening or the issuing bank in the importer's country, who establishes the LC. So LC will be established by the issuing bank or the opening bank, and this bank is having the banker customer relation with the importer or the buyer or the applicant of LC. Next, we have the exporter. The another party is exporter, who will be selling certain goods or commodities, and he or she will also be the beneficiary of LC. Fine. So on whose behalf LC is open? On behalf of buyer. Who is the beneficiary of the LC? It will be the seller. The advising bank is the second bank involved in the entire setup, and this particular bank is also known as confirming bank and the negotiating bank. These can be same. All of these can be same. Advising bank, then you can term them as confirming bank or the negotiating bank. They could be same or they can be different also. If they are same, then we would say that only 4 parties are involved. But if they are different, that is confirming bank is different, negotiating bank is different, and advising bank is different, then we would say number of parties involved are 6. Okay. So all of these parties, they reside in the exporter's country. So always remember, one bank is in the importer's country, and the another bank, that is bank 2, is in the exporter country. So importer, who will be the importer? The buyer will be the importer, right? And also known as the applicant. And when I talk about the exporter, it will be the beneficiary of this letter of credit. Okay. Now let's see what is the role of the advising bank. Opening bank, so I hope everybody knows that opening bank means a particular bank, a particular banking institution that will open up the LC, that will issue the letter of credit. And to whom it will be issued? It will be issued to the to the exporter, fine, on the saying or on behalf of the importer. So advising bank, the bank at the exporter's end, it acts as an agent of the issuing bank and authenticates the LC. See, this issuing bank, mostly we have seen that it has direct relationship with the advising bank also. And relationship in the sense, trade relationship. Many LCs are there flowing from one country to another, and the trade activities are going on from between one country and another country, and mostly the banks are involved. Fine, all of these LC operations are opened up by a particular bank, and they already have tie-ups with various banks in different countries, and mostly this opening or the issuing bank will be having direct contact with the advising bank. It acts as an agent of the issuing bank and authenticates the LC, that yes, the LC which has been issued by the opening bank, whether it fulfills the term and condition of the contract which was initially signed by the importer and exporter. When the payment guarantee is taken by the advising bank, it becomes the confirming bank also. So confirming bank, if it is different from the advising bank, supposedly for the advising bank, we have the HDFC, that just for the example. If the HDFC bank also confirms that yes, whatever information has been provided by the issuing bank is okay, and the payment guarantee I take, HDFC takes the payment guarantee also, then it is confirming the payment, and this confirming bank will be the HDFC bank also. Fine. So advising bank and confirming bank will be the same. The confirming bank undertakes to pay on behalf of the issuing bank when the exporter is not satisfied with the assurance of the issuing bank or the additional guarantee of undertaking of the issuing bank. So see, exporter, why exporter is not satisfied?
exporter might think that the fee which has been levied by the HDFC Bank is too high. So rather than providing HDFC the opportunity to act as a confirming bank, let me hire ICICI Bank for that thing, because ICICI Bank is providing me those similar services at a lower fee. Right? So the exporter, if it is not satisfied with the assurance of issuing bank, then you will have the confirming bank in the place of your advising bank. Fine. When we talk about the yes, confirming bank, it undertakes to pay on behalf of the issuing bank when the exporter is not satisfied with the issuing bank or the additional guarantee of the issuing bank. Then one more type of bank is there, which is known as the negotiating bank. Now this bank is again at the side of exporter only. So exporter or seller's bank or the bank nominated by this opening bank. Always remember, if there is a third bank involved in this setup from the exporter's end, that will be nominated by the opening bank. Fine. So it is always nominated by the opening bank, which is from the importer's end. It negotiates the payment terms and documents in case of specific demand from the exporter. So exporter might have a demand that yes, I do not want to pay exorbitant fee to you, as well as I want my shipment to be very streamlined towards the importer, and I want my money within a particular time period. Next, one more additional party beyond the sixth party we have as the reimbursing bank. Now, this reimbursing bank is the one which will reimburse the negotiating or the confirming bank. Because see, these two banks, the confirming bank or the negotiating banks, they are not paying anything. Fine, they are not paying anything. They are just negotiating or confirming the payment on behalf of the advising bank. Okay, so chances are there that a particular reimbursing bank will also be aligned by the exporter if it is a big exporter and it takes care of its business with multiple LCs. Then reimbursing bank can also come into picture, which will reimburse the negotiating or the confirming bank. So I hope that the parties involved are covered, which are covered here. They are more or less very clear to all of you, because see, if the parties are not clear to you, you won't be able to understand the mechanism which we'll be talking about here. So the stepwise coverage, let's start with the importer and exporter. That is the first ground or the first step of any LC. So the exporter and the importer will have the agreement on a particular contract which has some terms and conditions. Fine. And when I talk about the importer, it will be importing something. Fine. So it will be buying something from the seller. So it will be the buyer, and the exporter will be the seller. Fine. Now the letter of credit will be applied by the importer, that we have seen. So second step will be the importer will apply the LC to the issuing or the opening bank. This is the issuing, or you can say the opening bank, this one. I hope that it is visible to all of you. Fine. This is the issuing bank here. Next in line will be the issue of letter of credit. Now the issuing bank will provide the letter of credit to the advising bank, which is the bank of the exporter. After the letter of credit has been issued to the advising bank, the advising bank will verify all the records, all those term and conditions which are being signed in the step one between exporter and importer. It will verify the LC and forward it to the exporter. Now, once the verification of LC is done, exporter in the fifth step will streamline the shipment towards the importer, and the goods will be shipped. As soon as the goods are shipped, exporter will inform via documents to its advising bank that yes, I have provided the shipment, the shipment is in line, and the same will be forwarded to the issuing bank by this advising or confirming bank. Once the issuing bank has all the documents, it will verify those documents and send it to the importer. Okay, importer will now have the final documents which are required to complete this setup or mechanism of letter of credit. Okay, it starts off with the credit card. Most of us are using the debit card, and some of us are also having the access to credit card.
And being a banker, I assume that all of you are knowing the basic definition of credit card. A credit card is what? Basically, you are being provided with with an amount of money that is known as your limit, up to which you can spend using a particular card, or for that matter a particular plastic card. And how your limit is determined? It depends primarily on your credit worthiness. And how the credit worthiness is determined? Some people will ask me. The credit worthiness is directly proportional to the loan accounts which were held by you in the past, which you are holding right now. Along with that, it also has a component of your current salary, how much you are earning, and from where you are earning, what is the source of income. All these things clubbed together, you will find a particular limit which has been attached to your CIF, that is customer identification number. And mostly there are numerous offers on these credit cards. Why there are offers on credit cards? That we must remember, that we must analyze. Being a banker, we must know that customers have a particular demand, that is demand of credit. And to fulfill that demand, we have primarily two options. One, the loans and advances which we give. Secondly, the credit card. So more lucrative offer with which we are coming for a particular credit card, or lower rate of interest in case of loans and advances, more public will be attracted. And we as bankers, we will be enabling our bank, our financial institution, to earn more interest, more rate of interest, more money, more profit via these lucrative offers. Because the lucrative offers not only will be appreciated by the customers, but also word of mouth will spread across those customers also who right now are not using these products. Fine. So in banking, always remember, marketing is equally important, and credit card plays on this thing only, that is marketing. Every time we go online for shopping, you will find some or the other credit card of a particular bank is aligned with those e-commerce websites. Reason is very simple, so that banks can gain profit. Fine. So enough of the introduction, I hope. Now let's move on to the core part and see what is to be what is to be discussed in the actual syllabus. Fine. So let's start with the definition. Fine. According to our book, credit cards, they are issued to approved clients for purchase of goods and services from authorized merchant establishment on the guarantee of issuer of the credit card for payment. So always remember, the clients will be having lucrative offers, or for that matter, they will be having some limit attached to their CIF. Fine. And this particular limit will be utilized by the clients, by the customers, for purchasing something, purchasing either some goods or services. And of late, it has become a trend that the credit card companies are providing you with the direct access to the EMI options as well. You can pay using the flexi pay structure of various banks, so that you are more attracted towards spending, and in turn the banks, or for that matter credit card companies, will earn more profit. So the parties which are involved in credit card, they are the card holders, the card issuers, the merchants, merchant acquirers, that is the banks, and the credit card associations as well. So who are the card holders? You are the card holder. Fine. Right now, so you are a banker, just assume that you are a customer. Card issuers, whosoever is issuing you the card. The merchants via which these cards are issued. Merchant acquirers, that is the banks or the NBFCs. Credit card associations, they will be either Visa, MasterCard, RuPay. These are the three major aggregates, we would say aggregators, and they provide settlement services for their members, that is credit card issuer as well as merchant acquirers. So the credit card associations, they are responsible for providing the settlement services as well. So the parties involved in credit card, they are defined how? on the basis of the type of services they are providing. Next, when I talk about the benefits of credit cards, simple. It is beneficial for the credit card holders, for the merchant establishments also, and for the banks as well. The card holders will have certain credit on regular basis. They need not to panic in case of the month end. To merchant establishments, it will be beneficial. How? Because of the profit. To banks, it will be beneficial because ultimately these merchant establishments are more or less the subsidiaries of the banks itself. What are the disadvantages? See, if you are not a wise spender, if you are not an informed customer, you will end up overusing this particular type of limit. So credit card holders may result in overspending. Fraudulent withdrawals can happen thanks to the online crime which is rising. It may fall in debt trap credit limit. So chances are there that these flexi pay offers, fine, there are various flexi pay that if you are having supposedly a big kind of transaction, let's suppose rupees 11,000 has been spent by you on a particular transaction, you can convert this transaction into EMI and pay this amount in installments in upcoming months. It will do what? It will involve a debt trap for these clients, for the customers. Next, when I talk about the guidelines which are being issued by the RBI time and again, they are very, very important. For our examination also, always remember whatever guidelines are there provided by the regulator, they automatically become important, whether it is from the RBI, IRDAI or SEBI. On 21st April 2022, RBI issued master directions on the issuance and conduct of the credit cards and debit cards as well. When we talk about the scheduled commercial banks other than RRBs with net worth of rupees 100 crore and above, they can undertake the credit card business departmentally, that is by establishing specific department for credit cards or through a subsidiary or in a tie-up arrangement as well with the other card issuing bank or the NBFC with approval of their boards. So direct involvement of RBI is not there, but the approval of bank's respective board is important. So always remember, scheduled commercial bank with a net worth of 100 crore or above can have the credit card businesses as well. Now what about the sanction of credit card? How you will be giving a particular limit, providing a particular limit to a borrower, to a customer. So the decision for issue of credit card shall be made by the card issuer. Right? So the card issuer will be the merchant only. Fine. The merchant who is providing this service to the customer. Assess the credit risk. You have to assess this credit risk as a merchant. You must know that if I am providing a credit limit to XYZ borrower, what are the chances that this particular credit limit will be recovered by me thanks to the credit worthiness of the customer. You must assess the total credit limit also. Supposingly a credit card is there with the limit of rupees 2 lakh. Fine. Now whether I should provide this 2 lakh to a customer with an unstable income or I should give it to a government employee, that is at the prerogative of the merchant. You need to assess the total credit limit whatever you are providing. Then KYC requirements must be fulfilled, be it the Aadhaar card or PAN card. And lastly, you must have certain terms and conditions which are specified by your board. Okay, so all the banks, they have respective boards and the boards will provide for these terms and conditions. What are these T and C? Normally, it will be certain insurance offers provided by a particular bank. It can be the type of card that we will be having 3 or 4 variants for our credit card, and these variants will be provided to the customers based on their level of income or for that matter their credit worthiness or which department they are working in. Similarly, issuance of cards will be for a particular benchmark. A benchmark will be there that we will be providing you the credit card only if you are our customer. Fine. If only if you are having a bank account in our bank only, then only we will be issuing the credit card. Then term and conditions will be specified for the credit card statements also, that whether monthly statements will be given to you, or for that matter fortnightly statements will be there. Can you have the access to the credit limit as well as the credit card statement in real time using the application or not? All these things will be mentioned in this T and C. Interest rates and other charges, as soon as the RBI is informing, or you can say modifying certain guidelines based on the interest rate of credit card, or for that matter your bank's board policy has modified the interest rates, you must inform the same to the customers in real time. Then most important term and condition is this wrongful billing. Right? When we talk about the regulator, that is the RBI, wrongful billing has been termed as the biggest blunder in the Indian banking system, or for that matter Indian credit card system. Why I am saying this? Because most of the cases, most of the complaints which has been launched by the customers using credit card is for the wrongful billing only. Documentary evidence to the customer within a maximum period of 30 days of complaint. So the evidence must be there in order to specify that whether the wrongful billing has been done by the merchant to us, to the customers or not, and the TAT or the turnaround time has been decided by the RBI as 30 days. Within 30 days you have to respond to this type of complaint. Fine. So these T and C's are very, very important for a banker. Fine. So all those who are here, one second. Okay, I thought there was a question. Fine. All those who are here for the first time, I would highly recommend to subscribe our channel, that is JAIIB CAIIB English Medium, because we tend to give you most important topics in the most crisp manner, right? Be it the JAIIB examination or for that matter the CAIIB examination. We have n number of sessions lined up for all of you, wherein you can have a particular topic in your mind and we will be delivering you in the real time. You must be having certain inhibitions, for example for the credit card only, but after attending today's session you will be in a position to answer all the questions related to this topic. Similar pattern is followed by the other subject faculties as well, be it for the JAIIB or CAIIB. So always remember, do subscribe the channel which is providing you the quality content. Now when we talk about these grievances, how you will be addressing the grievances. So redressal of these grievances which has been raised by the customer, a time limit of 60 days may be given to the customers for preferring their complaints or grievances. Fine. So today is what, 18th. Fine. From today, if today is 18th and some transaction is there which is not done by you and you want to raise a complaint in the case of credit card usage, you can do so within 60 days. Bank or NBFCs should constitute grievance redressal machinery within the bank or the NBFC. There must be a grievance redressal mechanism. And when we talk about credit cards, mostly we have seen that online complaint will be preferred. Right? Most people, they right now have the mobile application, they have the smartphones. So the merchants also prefer to resolve the complaints in real time if they are forwarding the complaint from the official application. If a complainant does not get satisfactory response from the bank or NBFC within the maximum period of 30 days from the date of his lodging the complaint, he will have the option to approach the banking ombudsman. Fine. Integrated ombudsman scheme is there with the RBI IOS. The grievance redressal process shall have a provision for automatic escalation of unresolved complaints from a call center or base level to the higher authorities. Fine. If you have ever complained regarding the usage of your credit card, you must know that if you are just complaining via making a call, or for that matter to a person in the call center, after particular days, I think after 2 or 3 days, the same will be escalated to the nodal manager, the nodal head of that particular call center. And if that particular nodal manager is not responding within 4 days, it will be ultimately raised to the regional head of your credit card merchant. Fine. So like that, automatic escalation also happens. Next, when we talk about some recommendations of RBI, so RBI had recommended issuing the cards with photograph of the card holder. That is just a recommendation. Fine. Do not feel bogged down by this statement. It is just a recommendation. Then cards with pin and signature laminated cards also. That's a recommendation from the RBI, so that you can have a sense of belonging. The customers should have the sense of belonging with their credit card. They will be spending wisely. Also, they will be having an additional security on their cards. So cards with any other advanced methods. Now the cards with EMV chip based and pin is mandatory. So EMV chip is there, and when we talk about the EMV chips, the chip based cards are there. Along with that, pin must be generated. Only then your credit card will be functioning. If you are not having the pin set right away, then you won't be able to access the online services as well. For the card not present, the CNP transaction, two-factor authentication has been mandated by the RBI. So always remember, the CNP transactions, you must have two layer of protection. The merchant of the respective merchant of these credit cards must provide two-factor authentication to the customers. Then we have tokenization, one term which is fairly common in the credit card topic. Okay, so tokenization refers to replacement of actual card detail with an alternative code called as token, which shall be unique for a combination of the card. Just an additional security measure where a token will be provided. What is token? It is just an additional code for using your credit card, and the process via which the token is provided, it is known as tokenization.
Start our discussion with the definition of priority sector. When I talk about the priority sector, as the name suggests, something is given priority. Right? What kind of priority is being given here? So the priority sector, basically, it is a concept which has been evolved over a period of time. Fine. In the 1960s, the concept started off with a discussion between the RBI and the government of India, and the government was very apprehensive of the conditions which were prevailing in the rural India, the conditions of credit. Fine. So non-institutional credit was at large available in the rural areas, in the semi-urban areas, and the sectors which were unable to gain the growth thanks to this huge amount of rate of interest charged by the private money lenders, they had the potential which was seen by the government. Fine. The government felt that yes, the section of society, or for that matter, these type of industries, especially the small scale industries, we have a potential which can overcome the import export deficit which is there in our country. Along with that, it also felt that there are certain weaker sections in the society which, if we provide loan to them, if we provide credit to them, they can act as a facilitator at some time, at some point of time. They will also act as a catalyst in our economic growth. That is the reason why RBI stakeholders and the government of India sat together and they figured out a particular mechanism via which they will be disbursing loan advances at nominal rate to these particular sectors, and all those beneficiaries will be acting as the prime importance, as the prime target of the public sector banks in this priority sector lending. Okay, so the priority sector lending comprises only those sectors that have substantial influence on the vast portion of the population, especially the weaker section and the sectors that are employment intensive, fine, where the level of employment is high. Okay. The current framework of PSL dates back to 1967 when the Banking Laws Amendment Bill 1967 was introduced, and it had one particular aspect, that is social control over the banks in India. So it introduced the social control over the banks in our country. What is this social control? If anybody can tell me in the comment section, fine. This will be your homework. If you can, just let me know that what is this social control over the banks. Fine. We have time and again discussed the concept of business entities, and many a times I have referred banks as the business entities only. What is this social control over banks? Do let me know in the comment section. This is just a hint for all of you. So RBI mandated the following benchmarks to determine the PSL targets. Now PSL, priority sector lending norms are okay, but how you will be providing with the PSL targets? What will be the benchmark? Decide that this particular percentage of your credit or your net bank credit should go towards agriculture. This percentage should go towards MSME. A particular percentage must be linked to the education sector. So there were two benchmarks decided by the RBI. Earlier, it was only based on the total outstanding of a particular bank's balance sheet. But now we have CEOBE as well as ANBC, whichever is higher of these two, you will be lending based on that particular benchmark. What is CEOBE? It is credit equivalent of off balance sheet exposure. It is not a credit. Mind this, very, very important, because normally the benchmarks include the fund based facilities, but here non fund based facilities will be considered as a benchmark, where the exposure of the bank or the risk involved in the banking industry is not directly linked to the credit or the advances. No, they are in proportion to the non-fund based facilities only, like the letter of credit, like the bank guarantees. Fine. Directly credit is not disbursed in bank guarantee, or for that matter in the letter of credit. What is going on? Certain amount of assurance is provided by the bank to the borrower, to the multi parties who are involved in that setup. So all those non-fund based facilities, they hold a certain value in the market. Fine. So what is the credit equivalent of that particular exposure? It is defined as the CEOBE, off balance sheet exposure. Why? Because these are not recorded directly in the balance sheet of the bank. They are just taken as a note after the balance sheet. Fine. Supposingly this is the balance sheet here of the bank, and somewhere down here you will find asterisk marked as note, and in the note you will be recording all the exposure that is not fund based. Next, we have the benchmark as ANBC. It is adjusted net bank credit. This you can directly see in the banking industry. You can observe for sure because these are in numbers. You can see the bank credit. What is the number of bank credit? What about the bills rediscounted with the RBI? What is the number there? Fine. So bank credit subtracted from the bills rediscounted with RBI will somewhat give you the bank's net credit. But what is this adjusted net bank credit? It has some more, you can say, components to it. After you arrive at the bank's net credit, you will have to add the non-SLR category bonds or investment and subtract the loans from the RBI. Right? So A and BC, let's have an elaborate discussion on this, because question can be asked in the examination that calculate the ANBC of a particular bank based on the data provided. So this adjusted net bank credit, mostly you will find in the books also, it is not defined as a particular formula, but here we will be deciphering it using a formula only. So RBI introduced the Bills Market Scheme, which is known as BMS, in 1952, which was later registered as the New Bills Market Scheme, NBMS. Now, what is the basis of this NBMS? Here, RBI will be providing discount to the banks on already discounted bills. Bill discounting we have seen, fine. So already a particular bill has been discounted by the bank for the particular customer of this bank, but the particular bank which has discounted the bill, it will approach the RBI under the NBMS and it will rediscount this bill. Fine. So all the bills which are rediscounted, they form a part of ANBC, one part of ANBC. This bank credit, when I say bank credit, it involves the overall credit which is floating in the market of a particular bank. Supposingly 100 crore is the credit or the advance amount which the bank has floated in the market via various loans, and out of it, right now, currently, when we are calculating the ANBC, it is able to recover 70 crore. Remaining 30 crore right now, whether it is to be recovered or it is ongoing loan only. So that particular amount, 30 crore, we won't be adjusting here. We will consider the bank credit as 70 crore. So second part will be bank credit. First one, bills is rediscounted. Then we have bank credit. Plus one more component will be there, which is known as non-SLR bonds. See, there are certain bonds known as the SLR bonds, where there is a statutory limit defined by the RBI that yes, a bank must have this amount of assets sidelined for the time when the economy will be in a slump. We will be using these type of assets, these reserves at the time of a slump in the economy. They will act as a reservoir for a bad time for the economy. So apart from these SLR reserves, whatever bonds are there, they will also be included in the calculation of ANBC. So third component will be non-SLR. Fourth one will be your investments under the priority sector lending. So in total, there are 8 plus 1 sectors in the priority sector. Fine. And these 8 sectors clubbed with 1, they form the total 9 priority sectors. Whatever investment a bank has already made in these PSL under the PSL norms will be the fourth component of your ANBC. Lastly, the fifth component, which normally bankers know already, it is the outstanding deposits under the RIDF. So, Rural Infrastructure Development Fund, what is the role of RIDF here in the ANBC? All those obligations which are supposed to be fulfilled by the banks but were not fulfilled for one reason or the other under the priority sector lending, they will be redirected by the RBI in the fund known as RIDF, so that it will be again taken care of or again accounted for while calculating the ANBC. So these 5 components you must remember: 1, 2, 3, 4 and 5. So from the bank credit, you have to subtract the bills rediscounted. Fine. Otherwise, what will happen? In this bank credit, already discounted bills will be added. So duplicacy will be there. So you have to subtract it. Then add the non-SLR bonds and the investments under PSL and the outstanding deposit under the RIDF, and you will arrive at ANBC. This is written here also, that bank credit, which is the amount which has been recovered from the customers till date. That is this 70 crore, the example which I was giving you, minus the bills rediscounted with the RBI will give you what? Net bank credit. So in total, when I talk about the entire circle, you will find what? These two, 1 and 2, that is bank credit, and your bills rediscounted, they will form a part of these two club together, they will form a part of net bank credit. This part is known as your net bank credit, that is NBC. Fine. Now add non-SLR category bonds and other investments that come under PSL and the outstanding deposits under the RIDF, where the unused obligation under the PSL will be deposited by the bank and outstanding amount under the PSL targets minus the loans from the RBI. Fine. So the loans from the RBI will be subtracted at arriving for this particular number. Okay, so this is how you will be calculating the ANBC if a question is there at all. And when I talk about the computation of ANBC, In the case of the definition provided by the RBI, it has various components. So the bank credit in India is one component. Then we have bills rediscounted with the RBI. Then net bank credit. Fine, these two we have seen already. Outstanding deposits under RIDF. Again, we have seen this. Then eligible amount for exemption on issuance of long-term bonds for infrastructure and affordable housing. This we must remember because the direct question can be asked where the amount for the exemption is already given. So if you know that the issuance of long-term bond for infrastructure and affordable housing will provide certain exemptions to you, that will be added here. Advances extended in India against the incremental FCNR NRE deposits qualifying for exemption from CRR or SLR requirements. Then when I talk about this particular 8th and 9th, yes, this is 8th, this is 9th, right? This one is 8th and this is 9th. Other investments eligible to be treated as priority sector, subtract them from the face value of securities acquired and kept under held to maturity category under the TLTRO 2.0. See, these figures will be given in the exam. You have to only subtract or add various components. So always remember this 8th one, 8 minus 9 will be the criteria for calculating the A and BC for UCBs. Bonds or debentures in non-SLR categories under the HTM category. Again, non-SLR bonds will be there. For UCBs, investment made after August 30th, 2007 is permitted. Non-SLR bonds held under the held to maturity category. So HTM category for this type of structure will also be added up. Fine. So mostly the question revolves around this classification of A and BC. But yes, if you are a newbie, you do not know how the exemptions will be provided or how the exemptions will work, then always remember this particular outstanding deposit under RIDF, that is 4th, you have to subtract it from the exemptions on issuance of long-term bonds, that is 4 minus 5. This is 5, this is 4. Okay, the rest all will be added up. Fine, you can see that this one third, as we have already seen here, it was what, 1 minus 2. The bank credit will be subtracted from the bills rediscounted and you will get the third. Okay, so A and BC other than UCBs you will have 3 plus 4 minus 5. What is 4? 4 is this one, RIDF, outstanding deposits under the RIDF, minus the exemption on the issuance of long-term bonds. Plus you will be adding 6, 7, 8 and finally subtracting this 9th one as well. That is the face value of securities acquired and kept under HTM category. And lastly, you will add the non-SLR bonds as well. Okay, that will give you the A and BC other than UCBs. Fine. So I hope that now you will be able to handle a numerical if there is any in the exam based on the A and BC. When I talk about COBE, direct numerical is not there. The scope of asking numerical from COBE is very limited. And here for all of you, a reference sheet has been attached, which is an old one, very old, 2003, 2004. That's what we can gather for you so that you can have a look that how does this COBE looks like. So here you can see off balance sheet exposure of the scheduled commercial banks. So forward exchange contract, guarantees given, acceptance, endorsements, all these things will be there in the off balance sheet exposure. So in total, they are not a part of asset or liability in bank balance sheet, not classified in loans or for that matter deposits, but they create income for the bank. Income will be created. Like LCs, you will be having as a banker certain income based on the charges. The service fee will be levied to your customer. It represents the potential credit risk, not the direct credit risk, but the potential credit risk. That is the credit equivalent arising from the bank's off balance sheet activities like unused loan commitments, subtracting the outstanding principal from the loan commitment. So whatever loan commitment was there and it has been fulfilled from the banker's end, but the customer has not fulfilled the same to the importer. Fine, the amount has not been provided by the importer to the exporter, and the goods and services are not provided to the importer by the exporter. Anything can happen. Fine. So CEOB, always remember, it is just a credit equivalent of these off balance sheet exposure, mostly given under the head of letter of credit, or for that matter, bank guarantees. Fine. Now, when we talk about the priority sector lending, we have a good amount of discussion based on the ANBC and CEOBE. Apart from this, you have to remember that what all priority sectors are there. So when I talk about the agricultural uh, laborers, or for that matter, the agriculture sector as whole, it forms one part. Then we have the MSME, then export credit, social infrastructure, housing, education, renewable energy, others, and your weaker section. All these clubbed together will be what? 8 plus 1. Fine. This is education. Then we have renewable energy, and lastly we have others category. By mistake, it has been written in the one column only, but nonetheless, fine. These are the three different priority sectors. Okay, this others category mostly includes the corporates. Fine, the corporates to which loans will be disbursed on priority by the scheduled commercial banks, as prioritized by the, as obligated by the RBI under this particular master direction. This is the master direction which was revised by the RBI in March 2025, which gives the total priority sector, agriculture, micro enterprises, and advances to weaker sections target to the various banks. Types of banks involved are domestic commercial banks, excluding RRBs and SFBs. Why they are excluded? Because they have been categorized separately, the regional bank and the small finance banks. Then we have the foreign banks with less than 20 branches as a different category, and the domestic commercial banks are clubbed together with the foreign banks with 20 branches and